environment for nominal growth, and that is an environment that is particularly supportive for equities.
Hey, Max, still bullish, and it's good to catch up. Max Kentner there of HSBC with your equity market at all-time highs. We talked about the FMS, the Fund Manager Survey, coming from B of A a few times. The biggest jump in global growth expectations since May 2020, driven by the US, driven by China. 76% of investors say soft landing. Lisa, only 8% say hard landing.
And what you have is people deploying cash. When you start talking about cash on the sidelines, the cash level fell from 4.2% in this survey to 3.9%. So they're acting on it. When people say that they're bearish or worried, take a look at what they're doing, because it's very different. And I think that's what we keep hearing.
Just a little bit softer in the equity market this morning, down by not even 1/10%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Google has signed a historic agreement with startup Teros Power to invest in the development of nuclear energy, with ever-growing interest in powering AI data centers. 7 small nuclear reactors will be constructed in the U.S., from which Google will buy power. The companies are targeting a goal of 500 megawatts of nuclear power by the end of the decade. Hundreds of anti-Israel protesters gathered at the New York Stock Exchange just ahead of the opening bell on Monday morning. The group staged a sit-in on the streets just outside of the building entrance on Broad Street. Over 200 people were arrested, with several protesters handcuffing themselves to the building's doors. The event coming just over a week after Israel marked 1 year since the October 7th attacks. NASA has its set sight on Jupiter. The administration launched a $5.2 billion mission to the planet's frozen moon Europa to determine if it has conditions that could host life. After over a decade of preparations, the spacecraft lifted off aboard SpaceX's Falcon Heavy rocket in Florida on Monday. The vessel will come within 16 miles of Europa's surface and is scheduled to perform around 50 flybys over 4 years. And that's your brief. John.
Hey, Danny, thank you. You'll hear more from Danny in about 30 minutes' time. Up next on the program, driving home the economic message.
Under my economic plan, we will bring down the cost of housing. We will lower the cost on everything from healthcare to groceries.
You've been eaten alive with inflation, and all I'm doing is getting you back to even. We're going to get your prices down.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Two-day winning streak on the S&P 500, just a little bit softer this morning. We're down about 1/10%. The bond market reopens for business with a bid. Yields are lower by 3 or 4 basis points, just north of 4% on 10s. The standout move this morning, crude. Lisa, it's a break of 70. WTI down by more than 5%.
A report in the Washington Post that Bibi Netanyahu was conceding to requests from the United States, basically saying that they weren't going to go after oil assets or nuclear assets, but rather military assets. That said, so much remains to be seen. Also, you have, of course, the IEA coming out and saying demand is going down. We're not necessarily going to see that surge up. How much of this is noise and how much of this is reality?
So it feels like it's the Biden comments coming out of that risk. But to your point on what the IEA said and what we've seen over China, especially over the weekend when the Chinese finance ministry didn't really excite everyone about what is happening within domestically in China, it's that demand picture in China. Those fundamentals in the supply and demand picture, they're not changing, and they're negative for the price of oil.
It's a 5% move on crude this morning. More on that move a little bit later this hour. Under surveillance this morning, driving home the economic message.
Under my economic plan, we will bring down the cost of housing and help first-time home buyers, giving them $25,000 for down payment assistance. We will lower the cost on everything from healthcare to groceries.
You've been eaten alive with inflation, and all I'm doing is getting you back to even. The farmers are very badly hurt. The farmers in this country, we're going to get them straightened out. We're going to get your prices down. By the way, no tax on Social Security benefits for the older people.
Here's the latest this morning. Kamala Harris and Donald Trump going all in on the key swing state of Pennsylvania with dueling rallies detailing their plans for the economy. This is Harris is scheduled to sit down Wednesday for her first interview on Fox News. And later this afternoon, Trump joining Bloomberg's editor-in-chief John Micklethwait for a conversation at the Economic Club of Chicago. Joining us now to discuss Bloomberg's Saleha Mohsin. Saleha, welcome to the show. Let's get straight into it. What are you looking for former President Donald Trump a little bit later on in Chicago?
He's going to get some pretty difficult economic policy questions from Bloomberg's editor-in-chief. We're going to be asking him about where tariffs could go. U.S.-China policy is really important. The impact of a smooth transfer of power to the rest of the world. This is his second exclusive interview with Bloomberg this year. He sat down with Bloomberg Business Week in June over the summer. And so we've seen that he's not shying away from taking on mainstream media, asking pretty serious and tough questions.
Saleha, we just heard a clip where the former president talked about no tax on Social Security, and the crowd absolutely went wild. But you and I both know to get any of these provisions done, whether Kamala Harris is talking about some tax provision she wants or the Trump campaign, they need Congress behind them. What are you hearing from investors in terms of how they're looking at the composition of the Senate and the House?
You're exactly right, Anne-Marie. Investors are very clear-eyed about where tax policy is made. They realize that it's not just who wins the White House. In fact, the bigger focus should be on how the congressional races create the Senate, right, and the House side. So right now, it looks like investors are betting that that Congress might end up divided, which means a little bit of a slower policy-making path under a Harris presidency that is expected to cause some rough and tumble moments when it comes to dealing with China, possibly tax policy, but also for Trump. Just because you have a Republican in the White House does not mean that House Republicans, which is what the House side is starting to look like it's shaping up to end up. The House side might not be fully on board with Trump's tax policy because they are increasingly worried about the deficit and they want more pay-fors than Donald Trump has talked about. So if investors are keeping a clear eye on what is going on in Congress, then right now it looks like a divided Congress scenario, a divided government in Washington. A clean sweep for either party is less and less likely. So there could be more tensions. Now, on the Trump side, that could also mean that, look, whether you have a divided Congress or a unified Congress, Trump is going to be leaning far into tariffs. But if Congress is dragging their feet, can't agree on across the two chambers on any kind of policy, that means that a president like Donald Trump is probably going to be leaning more on executive orders and administrative actions.
Saleha, what do you make of individuals like Scott Bessent, a key economic advisor of the former president, saying this isn't really carte blanche tariffs, this is negotiating salvos? What are your sources telling you?
It looks like people like Scott Bessent, look, he comes with a markets background, and he is regularly talked about as a potential Treasury Secretary. Bloomberg News was the first to mention his name as being on a list for Donald Trump. We mentioned that as early as spring. He comes with more of a markets mentality, and that's important to someone like Donald Trump, who historically has really cared what markets think about his policies, how they might react. And so if you hear people like Scott Bessent talking about pushing down some of the market concerns around wild policymaking, it means that he would be the kind of advisor to a President Trump that would keep markets in mind.
Saleha, I have to wonder how much we really have a sense of who the cabinets would be around each of these candidates, who they really would put around them to sort of signal how seriously to take some of their proposals. You mentioned that a lot of people in markets just expect that Donald Trump says a lot of things, but ultimately the stock market will provide the check on him. And some people wonder what that check will be from Kamala Harris. Do we have a sense, or is there any kind of coalescing of cabinet members or basically policies that are coming around?
Look, Harris has done far fewer interviews and media appearances with mainstream media, including Bloomberg. She's not sat down with Bloomberg the way Donald Trump has, so we've not gotten the opportunity to ask some of those tough questions about economic and foreign policy. That being said, Bloomberg News, I've reported that a Harris presidency is likely to be a little bit more pro-business than Biden has been. Joe Biden has quite often vilified Wall Street, and he's suffered a little bit from that. He has not had the kind of support from CEOs and corporate executives to really promote and push Bidenomics. And we've seen that message kind of felt flat with voters, as we saw before he stepped off the ticket. With Harris, we should expect, depending on how influential the progressive wing will be in a Harris presidency, a little bit more of a say and sway from the people who represent the business community. She's very close with people like former American Express CEO Ken Chenault. She has frequently spoken to Peter Orszag of Lazard during her vice presidency. Her brother-in-law is an executive over at Uber. So she does have deeper ties over there.
What's the final stretch going to look like? We have about 3 weeks, less than that, left in the campaign season. We've seen a real escalation in rallies, et cetera. We see a number of media interviews, including Kamala Harris, agreeing to interview with Fox tomorrow. What do you expect in the final rush?
I think we're going to see each candidate hit try to reach the constituencies that they're most worried about. You can definitely see that the Harris campaign has some anxiety around Black men, as we saw with former President Obama's messaging and direct comments to that constituency last week. Donald Trump seems to be heading to blue states, and you almost have to wonder if he is now not just hoping for an electoral college win, but also the elusive popular vote win, which he has not secured before.
Saleha, it's good to get your thoughts, as always. Saleha Moss in there of Bloomberg on the latest. I think that interview with Fox News is a big deal. Feels a little bit desperate. This is not somewhere where Kamala Harris would have gone maybe a month or so ago. Bret Baier's the real deal. Down the middle, tough, very fair.
And he's given very tough interviews to the former President Donald Trump. This is going to be a tough interview for Kamala Harris. We've seen her sit down with some local media individuals as she's going through her campaign trail, and also members of the media like MSNBC, very, very friendly. But this is half the country. And if you want to win someone like a Republican that maybe was leaning towards Nikki Haley, you got to go on Fox.
They're certainly taking more risk in that campaign, that's for sure. Up next on the program, we'll catch up with Ken Leon of CFRA as traders await earnings from Bank of America. Those numbers are just around the corner, with equity futures just a little bit softer from New York. This is Bloomberg.
are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
A lot of bullishness out there. 46 all-time highs on the S&P 500 so far this year. This from Bank of America this morning in the Global Fund Manager Survey. The biggest jump in investor optimism since June 2020. The biggest jump in growth expectations, global growth expectations since May 2020. Futures just a little bit softer this morning. Earnings still ahead. Bank of America just around the corner. We're down by 0.05% on the S&P. On the Nasdaq 100, we're down by a tenth. In the bond market, back open for business with a bid. Yields lower by 4 basis points on a 10-year, 4.06%. We're down more than 5 on a 30-year at 4.35. We need to talk about the comments from Governor Waller. We can talk about his view on rates. I thought he did something we were talking about yesterday on this program. We said on this show, when a Fed official is going to come out and lower the bar for payrolls for the month of October. Governor Waller did that, and he put a number on it. The disruptions that come from the hurricane, the strikes from Boeing. He says, I expect these factors may reduce employment growth by more than 100,000 this month.
And basically talking about if current economic conditions continue, they can proceed with moving policy toward a neutral stance at a deliberate pace. He did lower the bar. At the same time, he talked about not moving by 50 basis point increments. He basically was implying 2 more 25 basis point increments for the remainder of this year. That is my interpretation. That's not what he said verbatim. Interestingly, Neil Kashkari had the same type of commentary about the deliberate methodological kind of approach to lowering rates. So it seems like there is a consensus established right now on the FOMC.
Just setting the bar going into November and looking for a messy month of data this October. Let's turn the board, switch the page, and get up to this. Get up to the commodity market and look at what's happening with Brent crude and WTI. Brent crude is down by something like 5% this morning, 73.76. It was a brief break of 70 on WTI, $70.15 this morning. We're down by close to 5%. Under surveillance, the Washington Post reporting Israeli Prime Minister Benjamin Netanyahu has agreed to limit retaliation against Iran. Netanyahu reportedly telling the Biden administration that he would strike military targets rather than Iran's nuclear and energy facilities.
And that's part of the reason why you see oil prices dropping this morning. On top of that, the IEA talking about plentiful supplies when it comes to what is actually happening in the supply-demand market. But that geopolitical risk premium that we've been living with off and on really for an entire year, but most recently after Biden came out, was very transparent about the fact that maybe Israel hitting Iranian oil facilities was actually on the table, and that was under discussion. And now with the Washington Post reporting, that's been put to the side. They're going to go after military facilities per this reporting, and that means oil prices can take a rest.
All I can say is it just shows how much people don't understand what they don't know about the Middle East. That you could see a 5% sell-off just like that over one report. The idea that the top tail risk that right now is perceived in that Bank of America Fund Manager Survey is geopolitics. How do you price it? It is entirely in the commodity market, and you can see it whipsawing as people's sentiments get buffeted around by different news reports.
It can change in big ways day to day. Just to stay on policy, this is some of the latest down in Washington. Sources telling Bloomberg the Biden administration has discussed capping sales of AI chips from U.S. companies to some countries. The policy would set a ceiling on export licenses for certain countries in the interest of national security, with officials focused on the Persian Gulf.
So it's taking the playbook they used from China per this reporting and using it in countries in the Gulf like the UAE and Saudi Arabia, even though Mohammed bin Zayed was just here, and they put out a release talking about that this is one area that they actually want to work together and collaborate with. What is interesting is this story from Bloomberg News, a scoop by McKenzie, our colleague down in Washington, D.C., comes at the same time the Financial Times has an interview with the new head of Saudi Arabia's premier academic institution that works on AI chips, and they are promising to stop any AI collaboration with China that could jeopardize the university's access to U.S.-made chips. Well, potentially that access is not going to be as carte blanche as they were expecting.
There are two issues here that I think are most interesting. The idea of backdoor access to China through the Middle East and how much the U.S. is trying to crack down on this, right? How much is this an effort to prevent shipments from the U.S. to the Middle East to then China? But then also a lack of understanding of exactly how these chips are going to be used for AI developments in the Middle East. An idea of what that surveillance looks like and trying to extrapolate out who our friends are going to be and who the enemies will be. A very difficult kind of needle to thread.
Lisa, I think you're absolutely right about constraining the access between Iran, China, and Russia too.
That's really part of the issue, is that who is your ally? Can you really be confident that the Middle East will not necessarily be a conduit to some of these other places? Because as you pointed out, as you sort of were implying here, we've seen that playbook already with the likes of oil, with the likes of weaponry and other types of supplies.
Wanted to squeeze in an update on Boeing as well. So here it is. The U.S. Acting Labor Secretary, Julie Su, meeting with the leaders of Boeing and striking union workers too. The union saying Su urged both sides to move forward in the bargaining process over a new contract after talks broke down just last week.
So really, the United States, you can tell the government wants to get this done and over with. They want to see these workers back at the plants, especially given the fact that Boeing is just not an important company to the U.S., but it is critical to the U.S. industrial base. Julie Su, though, has not been able to get confirmed at the Senate, yet she's doing a lot of the heavy lifting when it comes to not just what's going on right now at Boeing. Well, it's what happened with the dock workers just a few weeks ago. She was the individual that was able to get that across the finish line. And also October of last year, healthcare workers. So she is the one that's doing all this negotiation as the acting labor secretary.
Like Marty Walsh in the seat before her, union background, which seemed to be the focus of this administration when it came to that seat.
Yes, and potentially that is why maybe she is actually so good at this. She has the support and really the heart of the unions, and they feel like maybe they can trust her. So if she's coming down and saying, come on, guys, you have to give a little, get back to work, let's get it over the finish line, she's been successful in it.
Boeing in the pre-market up by 2.5% this morning. Let's turn to the autos. A major European car maker is getting absolutely slammed this year. The BMW CEO sharing his concerns over the EU's plan to effectively ban the sale of combustion engine cars from 2035, saying it's no longer realistic. Bloomberg's Ollie Crook joins us now for more. Ollie, you've been at the Paris Auto Show. How much of a reality check have these automakers had to confront over the last few days?
Well, listen, John, we talk about crises, particularly in Europe, but around the world, that sort of begin slowly at first and then happen suddenly. And I think that now in the last few months for the European auto sector, we've really entered into the suddenly period of time. And what the BMW CEO is referring to is on top of all the difficulties you have in terms of global demand, you also have these new EU regulations that kick in at the end of this year, which basically require all these car companies to sell about a fifth, 20% of their cars to be EVs in order to be compliant with emission regulations. They're stuck right now below 15%. So there's a huge mismatch between what the policymakers want and what the market wants. And the question is, how do you close that gap? BMW is suggesting that you need to push out the regulations. You spoke to Carlos Tavares yesterday. He says, actually, no, what we need is policy certainty, but we need a little bit of stimulus on the demand side to get things where they need to go. The point is, none of these European automakers are really prepared for these regulations kicking in at the end of the year. The only company really well positioned for that is kind of Tesla, because they have both manufacturing locally within Europe and obviously only produce EVs, so they can actually sell credits to these other automakers.
Ollie, you mentioned Carlos Tavares of Stellantis, who spoke to us yesterday, and he was standing in front of cars that were made with a joint venture from a company in China. How much of the presence did China have at this auto industry conference, given the fact that a lot of different Chinese manufacturers are moving output to Europe to get around some of the potential tariffs?
So, Lisa, this is really interesting because we had a contrast from the car show in Munich last year, in September of last year, the IAA, where you really had this sort of coming out of all of these companies, sometimes for the first time in Europe, BYD, Xiaopeng. These are now staples at these car shows. These are all over the place. I'd say more than 85% of the cars that were shown were EVs, and a huge proportion of them were Chinese. And I think the Leap Motors is an extremely good example with Stellantis, because what they are doing now, basically, the Chinese model is adopting what the German model was in the 1980s in the Chinese market. We're talking about a joint venture. Stellantis owns 51% of that company and their distribution within Europe to basically get into the market. The difference is that the Chinese were very welcoming of this in the 1980s because they had no automotive market. Here in Europe, you have an automotive market, and one of the last sort of industries within Europe that was really sort of considered to be globally at the cutting edge, and that is now being threatened.
Oliver, also we've seen that in the United States when it comes to the Japanese automakers in the 90s. How much time do these companies have? When are we going to start to see actually factories close their doors?
Yeah, so listen, this is a question that is before all of us right now, and the answer is it's happening right now, which is back to the earlier point, the slowly at first, and then suddenly, we're in the suddenly. We have Volkswagen that's talking about closing factories in Belgium, maybe 2 or 3 within Germany. We're cutting about 30,000 jobs. That is happening right now, and this is because this business model is just not fit for purpose for the reality sort of going forward. So you can delay some of these regulations on emissions, keep the lifeline of the ICEs going for a little bit longer, but it doesn't answer the fundamental question, which is how are these companies going to stay competitive? And again, at a backdrop, I'm here in Brussels right now with EU policymakers really grappling with the question of how to keep this continent competitive and really not be sort of cast out to the sort of irrelevance of sort of economic obsolescence. And the car sector is really at the forefront of this, really on the front edge of this, and they really don't want to be the textbook case of how Europe lost all of its industry.
Ollie, appreciate the update, sir. As always, Bloomberg's Ollie Crook on the ground out of Brussels this morning. We've mentioned this on this program a few times. In fact, this conversation goes back a number of years. They have really screwed up the auto sector in Europe. Policymaker after policymaker burying their head in the sand, virtue signaling around green and environmental issues. And I'm not here to say that they shouldn't have been focused on. They should be, clearly for very real reasons. But these targets were always unrealistic. And they've always been unrealistic without the state aid to go along with them. Never mind the infrastructure that these kind of automakers demand at the moment. And they go on programs like this and repeat again and again and again. But the capacity issue now, we're at this point where they've got to make a decision. And we heard that in the voice of Mr. Tavares yesterday of Stellantis. We're talking about months before we get serious cuts to capacity across the Euro auto sector.
And what I really felt yesterday, and I'm glad that you went there, this feeling of urgency on that side, but not real clarity when it came to any consensus on what those policies would be. And oh yeah, there is a bit of hands being tied with respect to the fiscal oversight of some of this, given where we have just come from.
The quote that stood out to me with both your guys' interview with the Stellantis CEO yesterday was, "We're not seeking to sell any of our brands right now. We're not seeking to sell brands right now." Clearly, this is something that potentially they're thinking about, because how do you make money in this type of environment? They're looking at potential options.
We showed some of the stock prices, absolutely brutal so far year to date for the likes of Stellantis, for the likes of BMW. Big bank earnings continue to roll out today. We'll get Bank of America in just a few minutes' time. Goldman Sachs and Citi reporting later on this morning. Ken Leon of CFRA joins us now for more. Ken, we're waiting for BofA. It's just minutes away. What are you focused on when those numbers drop?
We're looking at a lot of things. The first lens is really banks have been an important part of the financial sector, which has moved with the S&P 500 very strongly. So we want further confirmation that the business is good. The economy, everyone will be looking at the consumer, where generally we're not seeing credit risk fall off the cliff. And third will be the dynamics of rates. Rates from the standpoint that for Bank of America, 54% of their total net revenue is net interest income. So that the flywheels for that are simple. It's the economy, which is really loan growth, and then of course rates coming down. So I think in totality for Bank of America, they're mostly going to be talking about not only corporate, but also the consumer being still pretty healthy. Additionally, it's kind of window dressing is back a year ago, they had over $100 billion of unrealized net losses. And this was the mismatch, related to their unrealized bond losses. with rates coming down, that's going to benefit that. But that's not really a key mark for looking ahead. So banks, again, I think what we're looking first is these three areas. And then as we have Goldman Sachs later today, Morgan Stanley tomorrow, whether there's a separation of performance between the large commercial banks, if you will, Bank of America, or clearly what we've seen with Wells Fargo from these type of banks.
We're just minutes away, Ken, from getting Bank of America. Then the calendar looks like 45 minutes later, Goldman Sachs. John, we are getting some numbers right now, but to me, very curious to see the separation, as Ken was saying, between the behemoths like Bank of America and the likes of Goldman Sachs.
When these numbers drop, you just get a ton of numbers. So we'll work through them headline by headline. Lisa, I'll go first of all to what you see from the likes of investment banking. Revenue coming in at $1.4 billion, the estimate $1.24 billion US dollars. So a big upside surprise there. That's investment banking for the third quarter. Revenue $1.4 billion, the estimate $1.24. Lisa, what else do you see?
Net interest expenses, non-interest expenses came in just a little bit light again. You see FICC trading revenue coming in at $2.94 billion. That exceeds expectations of $2.77 billion. You can see also a beat for equities trading of $2 billion versus the estimate of $1.8 billion. This is the key number, net interest income. And it is a beat, and this was what a lot of people were looking for. Almost $14 billion, $13.97 billion versus the estimate of $13.9 billion. Basically, the same thing we've seen across the board when it came to JP Morgan and for the most part, Wells Fargo. These banks are doing well with a yield curve that is disinverted and a consumer that seems like it's pretty strong.
Trading revenue, upside surprise. Investment banking, upside surprise. Net interest income, upside surprise. Just to repeat that net income headline once again, $13.97 billion US dollars, the estimate 13.9. You're going through the same numbers, Ken. What's your take this morning?
We are. So they hit the big metrics, which is great. And then looking further into the results, what we're going to be seeing is whether there's continued confidence in terms of generating non-interest income or service revenue. There's a lot of businesses that Bank of America have that generate revenue and earnings that are important. They're in areas of treasury services, custodial services. You know, this notion to get higher stock prices is having durable recurring revenue. And obviously that doesn't really, you can't control rates, but certainly the other businesses and serving their customers is critical. I think the cost side will be another factor. There's a lot of investment for Bank of America in technology. Some of the other banks besides technology has been regulation. So the efficiency ratios and their ability to have revenue outpace costs will be important, especially as rates come down.
We did see across the board for the headline numbers pretty much beats. This was sort of interesting to me just in light of what we saw from JP Morgan, that provisions for credit losses in the third quarter came in just a touch above the expected $1.53 billion. It came in at $1.54 billion. Ken, are these big banks building reserves because they can, or because they expect weakness, or because they're being more aggressive with the loans they're making?
Yeah, it's a great question. And JP Morgan Friday, I think, was $3.1 billion. They're building reserve partly and partly taking some credit losses, but it's mostly focused at credit card and consumer. For JP Morgan, I didn't see Bank of America, but JP Morgan, it was about 85% of that reserve was related to credit card. So again, Bank of America has a great franchise there. But my comment before, it's okay to build reserves and take some credit losses in credit card, providing the flywheel of loan balance activity increases is not flat to down. That's a sign of a healthy economy and consumers that are still spending, hopefully prudently.
Hey, Ken, stick with us. Stay close. Ken Leon there of CFRA, following numbers from Bank of America. Stock is down by 0.8% of the pre-market. Bit of context. Some recent moves. Friday was up by something like 5%. off the back of the numbers we saw from JP Morgan and Wells Fargo.
Yeah, this is basically a bar that got kicked upward pretty dramatically after JP Morgan and Wells Fargo. To Ken Leon's point about loan balances, it came in basically in line. So 1.08 trillion versus the estimate of 1.07 trillion. How much is that basically? They just didn't beat enough. Is that essentially what we're seeing?
Quite a few beats across the board elsewhere. Bank of America right now, just a bit softer in early trading. We're down by something like 0.5%. With an update of stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg reporting that Chinese tax authorities are moving to collect overseas investment gains from the country's ultra-rich. They've begun to ask individuals to come in for payment evaluations or request a self-assessment. The government has been urgently trying to expand its revenue sources. Land sales have tumbled while growth has stalled. EV chipmaker Wolfspeed will be awarded $1.5 billion in grants from the U.S. CHIPS Act and the private sector. The grant will come from the CHIPS Act, will cover a portion of the over $6 billion in planned spending for factories in both North Carolina and New York. The Biden administration says that those projects could create over 5,000 jobs. The grant spurred a wave of financing from the likes of Apollo, who will match the CHIPS Act's grant of $750 million. And in sports, the Mets secured a much-needed win in the second of the NLCS at Dodger Stadium. After dropping the series opener 9-0, the Mets responded with a strong showing led by star shortstop Francisco Lindor. And the Yankees are off to a promising start in the ALCS, winning Game 1 by a score of 5-2. Yankee starter Carlos Rodon delivered his best performance in pinstripes so far, with home runs from Juan Soto and Giancarlo Stanton sealing the win for the Bombers. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. This Subway series is a very real threat, isn't it?
Oh, yeah.
This rivalry between the two of you.
It might get pretty ugly.
Let's just remember the last World Series, Subway Series in 2000. Who won? Yankees swept the Mets.
Yeah, but right now they're doing a
4-1.
little bit better and they look good.
Okay, this is going to be great if this works out. Up next on the program, I'm not picking a team. I've got a team, but I don't care enough to share it. Big bank earnings rolling out on Wall Street.
I suspect that given the volatility that we've seen, especially in the equity markets, I think broadly speaking, you'll see potential upside surprise in trading this week.
Another upside surprise, this time from Bank of America. That conversation up next.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weekdays stories around the world right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
AMH wants me to wear one of those caps that Eric Adams wears. Half Mets, half Yankees.
I think that's a little too soon to really
I really want you to wear
Eric Adams in any way, shape, or form.
I really want you to wear a Yankees cap because I think that hat is
quit it.
appalling.
Just stop it.
But if you had to on this show, you know, you could have the Yankees on the right side of the cap and Mets on the left for Lisa.
Okay, cool. I'll ask Mayor Adams if I can borrow the cap.
Yeah, why don't you do that?
Yeah.
We'll video that.
See if he gets back to me. Under surveillance this morning, big bank earnings rolling out on Wall Street.
Broadly speaking, both trading and banking dynamics were a little bit better than expected at JP Morgan. They're the best in class. I suspect that given the volatility that we've seen, especially in the equity markets, I think broadly speaking, you'll see potential upside surprise in trading this week.
You got another one this morning. Here's the latest from Bank of America. The results dropping just moments ago. The company with a slight beat on net interest income, an upside surprise on trading revenue. We'll get Goldman and Citi a little bit later this morning. Ken Leon of CFRA is back with us. Ken, 7:30, Goldman. I think 30 minutes after that, Citi. What are you focused on for those two names in the next hour?
Well, that's our call. It's really that the capital markets, particularly underwriting and M&A, is going to drive fees. And of course, Goldman, you get that outsized impact as you do at Morgan Stanley versus the banks so far. I think it's enormous that what we've seen so far is no deterioration in investment banking. Actually, we've seen modest growth in the third quarter, even for IPOs. But we're seeing that there's, I think, a realization that rates aren't going to zero, but financial sponsors, which have not really been in underwriting or M&A, the Blackstones, the KKRs, are saying that we can now monetize sizable assets or equity that they have. Sizable means $1.2 trillion have to be monetized in the next 18 months.
Yeah.
All this for Goldman is going to be phenomenal. First, as an intermediary, and second, because they're expanding their business into private equity and private credit. So there's some dynamics of Goldman and Morgan Stanley that you just don't get the same weight or impact for JP Morgan or Bank of America.
Hey, Ken, looking forward to breaking down the numbers with you. 7:30 Eastern Time, Goldman Sachs just around the corner, 35 minutes away. That was Ken Leon of CFRA. Mohammed Al-Ariam writes in, he wants to try and get me on the Mets bandwagon. Only if Stevie Cohen pays.
Yeah, well...
Like a baseball mercenary.
Oh, yeah? So what would be your paycheck that you would need to be a Mets fan, to deign the Mets with your fandom?
I need transport paid and a free suite to take all of my friends.
You're a Yankees fan.
That's ridiculous. Honestly, all I can say is that Uncle Steve has done a great job with the Mets. And I will also say that, you know, if push comes to shove, things will be flying at this table.
I am a Yankees fan. I just want everyone to get along.
What does a fan mean?
I just want everyone to get along.
Fan.
Sarah Hunt of Alpine Saxon Woods joins us next. Tobin Marcus of Wolf Research. Ken Leon of CFRA will be back with us to break down bank earnings. And Stephen Cook of the Council on Foreign Relations.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region. simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The market is sort of punishing the more expensive stocks for the higher rates.
The market is effectively just like the Fed is watching every data point.
Data always matter, but 1 month does not change the narrative.
From the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level.
Whether they cut 50 or 25, last meeting is less important. What's more important is just the steady path.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Lots to work through this hour. Goldman Sachs in about 30 minutes' time. Numbers from Citi, 30 minutes after that. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P just about turning positive on the S&P 500. Coming into Tuesday on a two-day winning streak. The Nasdaq just about unchanged. Good news is good news. What else is good news? No news is good news. And from the banks so far, no bad news at all, really, from JP Morgan, Wells Fargo, and this morning, Bank of America.
I would actually argue it's been pretty much beats across the board with good news. And even when you had Wells Fargo coming out and saying we looked for some consumer weakness and we couldn't find it, that just was emulated by what we saw from JP Morgan as well as Bank of America. Key question, and this is something that Ken Leon alluded to. Look for this in Goldman Sachs' earnings, how much they're partnering with some of the behemoth private equity and private debt companies. This we didn't talk about. Bank of America third quarter debt underwriting revenue was $332 million versus the estimate of $669 million. How much are they losing share to some of these other players?
I'm interested in the bank earnings, just basically the temperature and what's going on with the consumer. JP Morgan's talking about that consumer still going out and spending. Bank of America, when we recently caught up with the individual that's looking at some of the consumer-driven parts of the bank, where are they going out, where are they spending? It's still maintaining. This American consumer is maintaining the idea of going out and spending on services like restaurants. Bank of America is still looking at this giant consumer banking, B of A showing flat total charge-offs for the quarter and actual declines in credit card losses. Still non-performing loans increased modestly, $5.6 billion.
The overall message from the major players is that things are okay for now. We'll wait for Citi, we'll wait for Goldman. That's the overall message from the major players. What do the smaller and more regional-sized lenders look like? What do the Ally Financials look like this earnings season?
The Capital Ones, we heard from Ally Financial. It was a warning heard across Wall Street. Everyone took that more than all of the sanguine commentary from some of the big banks. Still a question mark. That said, we're hearing from across the board not a lot of negativity, which is a reason why good news is good news, no news is good news, and marginally bad news is good news, because that means that the Fed put comes back into play.
All news is good news. Equities at all-time highs on the S&P 500. Why do we even have a show? Futures on the S&P up by not even 0.1%, just about turning green. The bond market back open for business with a bit of rally. Yields are down by 3 basis points, 4.07%. The standout move on the screen right now, crude, down by almost 5%. Earlier on in the session, it was a break of 70. AMH, the focus on a Washington Post article overnight.
That's right. And this focus from this article is that they have reporting that Israel may avoid targeting Iran's nuclear oil facilities, oil infrastructure. So that eases this geopolitical premium we've seen put into the oil price. And then the oil market is just focusing now on the supply and demand picture. And what do we see? There is ample supply in this market.
To the degree that people are looking for bad news, which we heard marginally that they are, which is also making people bullish because they're still looking for bad news, the geopolitics has been it. And when you take that off the table, or at least lower the temperature, how much does that just open the door to a 47th record high on the S&P 500 or a 23rd record high if you look at the equal weight?
Down more than $3 this morning, $70 and about 30 cents. I love that you're counting equal weight all-time highs now.
I'm never going to let that go. You actually caught me that I didn't know.
It's a question you didn't know the answer to.
I didn't know the answer to it, and I was emphasizing the importance of the equal weight, so I need to live by my words.
It's 22.
Well, it has been 22. This will be 23rd if it goes today.
Okay. 22 and counting.
Yes, correct. Thanks.
Coming up this hour, Sarah Hunt of Alpine Saxon Woods with US stocks at record highs. Ken Leon of CFRA with results from Goldman Sachs due later this hour at 7:30 Eastern Time. And we'll speak to Stephen Kirk of the Council on Foreign Relations on that move in crude. We begin this hour with US stocks at all-time highs as earnings season resumes on Wall Street. Sarah Hunt of Alpine Saxon Woods saying, with earnings multiples at robust levels, any faltering in the growth story could have negative consequences, even if it is more of a stable outcome versus a deterioration. Earnings growth is key for equities. Sarah joins us now for more. Sarah, good morning.
Good morning.
It's good to see you. What do you make of the banks so far? Big week of gains last week off the back of JP Morgan and Wells Fargo. Numbers from Bank of America about 20 minutes ago.
I think that that is a good start, and I think that that has obviously been heralded fairly well. I mean, you saw the other financials besides JP Morgan move higher on Friday. I think to your earlier discussion, it's going to be very interesting to see how the credit companies do, or how the banks do with the lower credit score folks, because I think that that's where you're seeing much more pressure and pain than you are seeing in the upper end. So it's going to see, we'll see how that goes. But I think that the fact that you're seeing enough spending and that the consumer looks good, and even if you're looking for it, you're having trouble finding it, I think that's good news.
Sets up retail sales on Thursday as well. Any reason to think that we come in soft on retail sales, given where the consumer is?
I think that's hard to see right now, but I mean, you might have some areas of softness, but I think in general, people are still spending fairly well. It's too early to catch up for all the economic disruption that the hurricanes had. So I think that you probably are going to see reasonably good numbers.
So this is what a lot of people are expecting, that the consumers have plenty of money and that any degree of weakening, even in the savings rate, has been really tampered down by some of the recent revisions. What's stopping you from just going full bull?
Well, I think there's still a lot of things that we don't know. There's a lot of uncertainty out there. We've got an election coming up. Yes, it seems like things have calmed down a little bit in the Middle East, but is that calm going to remain? And just because we've got reports of that doesn't necessarily mean that we know what the outcome is going to be yet. So I think that there is enough out there that you could be concerned about. And I think that you have next year a big expectation in earnings growth, so you want to see that economy continue to roll along fairly nicely. And I think that there's, like I said, there's enough out there that you could get yourself upset about or scared about, including the deficits and things that we're not talking about right now. But at the moment, that's not the focus. So right now, that's good for equities.
You're basically describing the story of my life. I can go home and worry about a lot of stuff, but you come in the next day and nobody really seems to care about it. I am wondering whether we are seeing the risks getting skewed to the upside in terms of economic growth. We were talking to Max Kettner, who was talking about the real tail risk to him is actually an upside to inflation and a reignition of some of the price increases that we saw, that this could actually create the doomsday scenario that could actually stop some of the euphoria that we're seeing in equity markets. Is that the risk to hedge right now, given the lack of visibility of any other risks, particularly with respect to the consumer?
I think it's a big issue. I think the fact that oil prices have come down so sharply, that helps a little bit on the inflation front. But I think that that's one of the areas that if you see, you saw an upward CPI print, just a little bit, and all the directionality sort of shifted. And is it a full shift? Is it a small shift? I think that is one of the bigger risks, because that's going to keep the Fed from acting as decisively as it could if you have any weakness in the labor market.
So where do you want to be in equities right now? What's your favorite place to be?
I think you want to be sort of across the board, which sounds really boring and annoying.
Is that Lisa's equal weight?
Well, I don't think you want to ignore the equal weight the way that you did the last time, right? So before it was all about technology stocks, and if you were underweight technology stocks, you were underperforming really badly. I think at this point, the diversity and the fact that you need technology, but you also want to see what else is going on in the economy, I think that's really come back. And I think that that's why you want to be somewhat across the board as opposed to having all your eggs in the technology side.
Is there a theme that you want to run with? This is what Mike Wilson of Morgan Stanley was talking about on this show, that we moved from GLP-1s to AI, this big NVIDIA move over the last few years. Is there another theme you want to run with that works right now?
I think that it's good to understand what is going on with thematic investing. I think that what you're seeing with the European car makers right now is they're saying, hey, hang on a second, we're not going to be able to go full EV in 10 years. That's not going to happen. I think understanding the fact that you're going to have an and on the energy front is going to be important. I think it's important on a thematic sense to look at companies that have continuously good balance sheets and can really generate cash, because that's what's going to be more problematic. Even if rates don't come down dramatically but stay a little bit higher, you're going to start to see some of those companies that can't survive on their own have more problems. And it hasn't really been an issue yet, and credit spreads are really tight. But I think that focusing on companies that are able to do things like buy back their shares and pay dividends is going to continue to be very helpful.
You mentioned the U.S. election. In your notes, you talk about the political risk and volatility for equities. What happens when we don't know the outcome for potentially days or weeks?
I would not like to see that happen. I don't think markets would like to see that happen. I think if it looks like any kind of protracted fight, I don't think that that's going to be healthy for equity markets. But at the same time, we're almost, inured is not the right word, but we have had problems before and we have gotten through them. So to the extent that we've had challenges and yet we've all come back to a point where there is an acceptable answer, I don't think it's as bad as it could be, but I do not think that equity markets would like that very much at all.
But are they even pricing in this probability right now?
I do not think that. No, I don't think so. I think that they're not even pricing in a probability of a sweep of one side or the other. I think they're still pricing in a probability of a mixed government, because that's generally better for equities because things don't move as fast, right? You can't make changes as quickly.
So the equity market is pricing in what they would like to be the outcome, not potentially what is going to be the outcome.
Mm-hmm.
Yeah, that's pretty
dangerous.
And
that's very equity market-like, though, isn't it? I mean, isn't that what equity markets do? It's like, what do we want to happen? We're going to try to telegraph that and make it happen. You know, if we keep moving this way, maybe thus it will be so.
We are deep in the heart, we're getting to the heart of earnings season. Which sector are you most interested to hear from? We've already heard from some of the banks. We're going to be done with basically the big bank earnings by the end of tomorrow. Which really will be the company or slew of companies that give you the best sense of whether people are a little bit over their skis in terms of risk?
If you think about what's going to drive what we think about the consumer, you're going to be looking on all the consumer side stuff. But if I think about the entire economy, I want to hear what the industrials have to say. And I want to see what they have to say about margins, what they have to say about labor costs, material costs, because that's going to set us up for 2025. And that's, I think, the big question is like, okay, we've seen some really good earnings growth in 2024. We're expecting more earnings growth in 2025. Do we have the underpinning ability to do that and to get those earnings through? Because if we do, then the bullishness is not wrong. But if you're starting to see cracks in that, and you saw individual, is that idiosyncratic? Is Nike having a problem because Nike's having a problem? Is this having a problem? If we see broader problems like that, I think that then the question starts to come, what's happening next year? If you don't, and you see much more stability, and you see companies saying, hey, you know what, we've really got a handle on these costs, and we're able to push prices just a little, just enough to keep margins in good shape or growing a little bit, I think that's going to be important.
Is there any sector that you're just completely avoiding?
Not at the moment, but I think that there are places where you want to be careful, and you're always looking for companies within individual sectors that have their own dynamics. But at the same time, I think some of the consumer, you have to be a little bit careful for reasons like Nike and the individual idiosyncratic problems that you can see. But I don't think that there's anything that you would say, absolutely, I want to stay away from here. I mean, it's interesting that the IEA is taking numbers down for demand, and yet we're taking global growth numbers up for China, right? So one of those things is not correct. Where you go from there, I don't know. Materials have certainly been hit pretty hard on the back of both oil coming down and some of the other stuff. But I don't think that you want to be completely out, because there's still places to make money in those sectors.
Sarah, it's good to see you. Sarah Hunt of Empire Saxon Words, looking ahead to the rest of earnings season. Tech players always dominant. Big focus on that. You mentioned Capital One, October 24th. And then the likes of Target, back end of November, going into the shopping season for the holidays. Going to be a big, big theme for us going into year end.
And you start to wonder how much we're going to hear lots of idiosyncratic stories. Sarah was talking about that. We really, I think, need to focus more on the consolidation of market share in the biggest players as they get an increasing amount of power just because of the data and their tech types of networks. I'm thinking of Walmart in particular, how much that's going to be a piece of the earnings as well.
Consumer and consumer credit.
Yes.
Seems to be where a lot of people are focused on this earnings season. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Boeing plans to raise as much as $25 billion, filing a shelf this morning as a precursor to a possible equity raise. It also announced a new $10 billion credit agreement to shore up its balance sheet with the strike still ongoing. Boeing is working to hold off potential ratings downgrades from both Moody's and S&P, both of which have threatened to downgrade Boeing to junk status. The S&P estimates that the strike is going to cost the company more than $1 billion a month. And German investor confidence has improved for the first time in 4 months. Expectations index by the ZEW Institute rose to 13.1 in October. It was at 3.6 the previous month. Hopes for stable inflation and future interest rate cuts by the ECB were both factors in the rising optimism. And panda diplomacy has returned to Washington, D.C. A pair of giant pandas are en route from southwest China to the Smithsonian's National Zoo, where they will stay for 10 years. The 3-year-old male and female pair named Bao Li and King Bao will be the first pandas that reside in the nation's capital since last November. It's unclear when exactly they arrive, but China's Wildlife Conservation Association said that the food prepared for the trip includes cornbread, bamboo, and carrots. And that's your brief, John.
Danny, thank you. TikTok and pandas. A threat to national security.
Well, yeah, they're pandas. Honestly, there's a lot of passion around pandas. I get it. They look like stuffed animals, but they also don't really move very much and tend to...
Oh, you're not a panda fan?
Well, look, how can you not be a panda fan? They're adorable, but like, there's a lot of focus on them. I'm just saying.
I brought my nephews to see the pandas before they went back to China, and they were moving. One of them was running around. It was amazing. Also, you know what this means? Panda Cam is coming back.
Oh, exciting stuff. Okay. Up next on the show, not that. Seeking a battleground edge.
Under our plan, we will lower the cost on everything from healthcare to groceries.
Everything's going to come. It's going to be beautiful. You're going to have a house. Just wait a little while. Give me a little while. Let me get in.
A conversation up next, live from New York City this morning. Good morning.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Equity Market Bull writes in, next time I'm on, I won't say who, ask me about the pandas next time. Makes me even more bullish having seen that now.
All I can say is, well, first of all, look, they're cute. I'm getting a lot of hate mail. I just want to let you know they are cute, but they kind of have failed Darwin. Just want to say.
Propaganda machines.
Okay.
That's what they are.
Okay, really, we're just going to get lots of email.
Influencing international views of China at a time where there is serious tension between China and the United States and the Western world. What else are they?
You're going to die on this one. Keep going.
I'll take you there when it comes to TikTok, not when it comes to the pandas.
You don't think pandas are being used to influence diplomatic relations at all?
Potentially, it's a friendly diplomatic olive branch.
Okay.
But
to reshape views and opinions of China?
I think we're reading into the pandas way too much.
Okay.
They're adorable. You can go to the museum. We'll now have a panda cam back, which I'm very excited about.
Kung Fu Panda.
And that's really the end of it.
All right, I'll come with you. Futures right now on the S&P 500, just about unchanged. Under surveillance this morning, seeking a battleground edge.
Under our plan, we will lower the cost on everything from healthcare to groceries. Look, I'm going to take on corporate price gouging just like I've done before. I'm going to do it again.
Everything's going to come. It's going to be beautiful. You're going to have a house. Just wait a little while. Give me a little while. Let me get in. 1 year from January 20th, we will have your energy prices cut in half all over the country.
That is quite a claim. Here's the latest this morning. Kamala Harris and Donald Trump promoting their economic plans in key swing state, Pennsylvania. With more remarks on deck. Fresh on the schedule, Harris sitting down Wednesday with Fox News for the very first time. Tobin Marcus joins us now for more from Wolf Research. Tobin, welcome to the program, sir. I want to get to that interview on Wednesday. It feels like this campaign is taking more risk on the Harris side. What do you think is behind that?
Yeah, I think they've correctly assessed that they are not going to win this election by playing prevent defense and sitting back and, keeping her out of the spotlight and hoping that Trump will self-destruct. Trump's favorability is higher than it has been in cycles past. So I think he has vulnerabilities. He's certainly beatable, but it's going to require them to keep reaching out to voters, trying to win votes. Polls still show that a lot of voters feel like they have questions about her. They need to know more about her policies, about what she stands for. And then there's this sort of meta objective of showing that she's willing to stand up to tough questioning, that she, can go into adversarial environments and hold her own. So, I think that's the calculation. These interviews she's been doing in this recent media blitz have not been flawless, but I do think that the strategy or, the strategic assessment is correct, that she needs to make the attempt to go out there, reach more people, do more things, and let the chips fall where they may.
Tobin, when she sits down with Bret Baier, Fox and Bret said last night in his show that they're going to air the entire interview 30 minutes straight, even though they're pre-recording it. The one concession they said they gave was basically just the timing of this, that they would pre-record it the 5 o'clock hour and his show's at 6. What part of the electorate, though, is she going after with this interview on Fox?
So, again, I think part of the objective is showing she can do it. So it's a message that's sent even to non-Fox viewers. And of course, it will be clipped and consumed by people who are not sitting down and watching linear Fox in the primetime slot every evening. But, I think there are swing voters out there. It's not a big slice, but, you think about, for example, kind of college-educated white voters who may have been Republican voters in cycles past, like that type of voter in the suburbs of big cities, the suburbs of Atlanta, for example, they've been drifting left. Those are winnable voters for Democrats, but not a bloc that Democrats have completely locked down. So, even though obviously it's a conservative-leaning viewer base, I do think that there are potentially persuadable voters for both Harris and Trump within most slices of the electorate, which is, why we see them doing this pretty diverse mix of media outlets that both of them have been doing, including non-traditional stuff like podcasts.
Tobin, what we saw after 2016 is that the polls continuously discounted and underweighted that Trump vote. Is there a chance that polls are underestimating Harris right now?
Yeah, I mean, my view has always been that the possibility of polling error is basically symmetrical. Like some kind of error will probably be in the polling. It's unlikely to be completely spot on, 100% perfect. There's been a lot of conversation about the possibility of another error underestimating Trump, which is a very real possibility. But I would not be at all surprised to see polls underestimate Harris either. I think if so, it's largely probably going to come down to turnout. I don't think that the story is going to be that there are a bunch of quote unquote shy Harris voters. But Trump all cycle long has been relying more heavily than Biden and then Harris on lower propensity voters. These inroads he's been making among Black and Hispanic men, for example, that have gotten a lot of attention, that's largely among kind of relatively less politically engaged people who are thinking about voting based on pocketbook considerations, and they might turn out for Trump and they might not. So, if we do see a little bit lower turnout, I think that's probably how we would get a polling miss that turns out to overstate Trump's support rather than understating it.
The vice president is going to go on Charlemagne the God today. And over the weekend and yesterday, we talked about her talking about economic opportunities specifically for Black men. One, is any of this possible? And two, is it going to land?
You mean, is it possible in terms of actually getting it enacted?
Yes.
Yeah, so I mean, some of the elements of the policy agenda that she's rolled out, sort of specific little package of policies aimed at persuading Black men who have, where again there has been some erosion. There's a lot of attention, for example, yesterday to her promise to protect digital assets. That's kind of a promise not to do anything. That's a promise she probably can keep, to the extent that there are folks in that slice of the electorate who are concerned about their own crypto investments. I think trying to neutralize the advantage that Trump has had there is something that she can credibly do. But across most of her agenda, a lot of it is promises she's not necessarily going to be able to keep based on the composition of Congress. But of course, she has to run on something. I think she wants to hold out a vision. I think it does matter to voters to hear kind of what you stand for, what you would like to do, even if you're not necessarily going to be able to do it 100%. But if she does get elected, it's going to be a really interesting couple of years with her likely facing divided government as she, does not succeed, I think, in getting done a lot of these ambitious fiscal proposals, and then also have to see how voters react to that sort of mixed record.
The blitz has been ongoing and continues for the next few weeks from both what we hear from Trump as well as Kamala Harris. What do you ascribe to this shift that we've seen in prediction polls, where now suddenly Donald Trump seems to be outperforming Kamala Harris?
Yeah, so there's been a little bit of a tightening of the polls. So, the polling models have moved a couple points in Trump's favor. The prediction markets have swung more dramatically in his favor. We do just see vibes in prediction markets sometimes. In late 2022, so in the October before the last election, for example, we saw prediction markets buying more into this red wave narrative than it was ever showing up in the polls. That's something I was skeptical of at the time. And we ended up in a situation where prediction markets were much more confident the Republicans were going to flip a whole bunch of Senate seats than the polling models were, and turned out to be wrong. So, I think that there are probably some big players who have recently become more convinced of Trump's path to victory. I do think there's been some shift in the conventional wisdom. Anecdotally, Democrats are more nervous. Democrats tend to get nervous a lot. So I don't know how much that says about the objective state of the race. But, I think there were in some quarters an expectation that Harris would keep expanding her lead. We see some of the commentary and it's like, oh, her campaign's plateaued. Her momentum has stalled out. But I don't think it was ever realistic for Democrats to expect her to open up like a 5 or 6 point national lead. I've always thought this is going to be a close election. The polling that we're seeing now, I think, is not that far off of the realistic best case for Democrats. Yeah, I think we're headed for a tight one. And to the extent that people think tight polling means Trump's going to win, I think that's what we're seeing in betting markets.
Hey, Tobin, good to hear from you, sir. As always, Tobin Marcus there of Wolf Research on the latest state in the race for the White House. Just getting some numbers now from Goldman Sachs, just to share them with you briefly. Net revenue coming in at $12.7 billion US dollars, the estimate $11.77 billion. So that is a big upside surprise. Fixed sales and trading revenue, $2.96 billion, in line with the estimate of $2.96. That stock is higher in the pre-market. We're up by about 2%. Already this morning, we've had numbers from Bank of America, from Goldman. In about 30 minutes' time, we'll get numbers from Citi. We'll recap these numbers in just a moment. Goldman Sachs up in early trading by more than 2%.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people,
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
2 days of gains on the S&P 500 to close out last week on Friday. Decent day to kick off this week on Monday. Decent day of gains this morning, this Tuesday. Pulling back just a touch on the Nasdaq. We're down by 0.1%. The S&P 500 almost totally unchanged. Let's get to these numbers from Goldman Sachs. And these numbers look pretty good. In a pre-market, a stock is up by more than 2%. It's a beat. It's a beat on revenue, 12.7 billion. The estimate, 11.77. Fixed sales and trading revenue in line here, Bramo, but investment banking revenue much better than expected.
And stock trading business, Goldman stock trading business had the best performance going back to the start of 2021. They reported a 45% increase in quarterly profits. Net interest income, $2.6 billion versus the expectation of $1.8 billion. So a really big beat across the board. A real question here, as you talked about this with JP Morgan and the fact that they lowered the bar and then beat the bar. We heard from David Solomon the trading revenues were likely to drop. They beat that bar. They actually rose by 2%. So a similar story here when it comes to some of the performance and some of the previous warnings that turned out maybe not to be true.
So let's talk about those three warnings. So Dan Pinto of JP Morgan warned about net interest income, said that maybe analysts were a little bit too optimistic. Net interest income on Friday looked totally okay. You mentioned David Solomon again, trading totally fine. The other warning was Ally Financial when it came to auto loans and credit there, and I wonder if that's going to be dismissed a little bit later this earnings season too.
That's actually the bigger one because it's a different kind of risk, which is a deteriorating consumer that we have not seen anywhere else. Is it that we're just missing something? And evidently people do have enough worry to still be looking for what they might be missing. And if they are missing anything, Ally Financial and Capital One might have the keys to provide.
Goldman Sachs up in the pre-market. Still with us, Ken Leon of CFRA. Ken, you've had a few moments to go through these numbers. What's not to like relative to expectations looking at Goldman this morning?
Yeah, we went to a strong buy from buy a couple of weeks ago, and I think for investors, it's what's next. And what's next is the following. We had very strong results today, but that's mostly driven by the U.S. markets. Still, this Goldman Sachs is a global bank, but they're getting 75% of their revenue or so from the U.S. So there's opportunity if Europe gets a little bit better, what happens in Asia, perhaps China. That's number one. Number two, the equity underwriting surprisingly was stronger than I thought, but it really wasn't IPOs. It was equity intermediaries, and then M&A is lagging. The record area was debt underwriting. So you put it all together, Goldman Sachs has $3.7 trillion of assets under supervision. So it's a large asset manager. That gets to David Solomon talking about recurring durable revenues. They're getting into private equity and private credit. And what we see ahead is really higher risk-taking now that everyone knows kind of where rates are going. And of course, they don't have the exposure of the larger banks, because only 14% of their total revenue comes from net interest income. So it's a pretty exciting dynamic. The one thing we didn't talk about, and I looked so hard in the releases, is what are they doing with the failed consumers' assets that they still have. Earlier today, it's expected that the General Motors credit card that Goldman was operating goes to Barclays. The bigger one was with Apple. But I didn't see it in the release. That question will come up from the analysts.
So, Ken, there's a ton to unpack there. There's a piece of that puzzle that I want to just focus on just for a moment going into 2025. RBC's Laurie Calvert-Senior was with us around the table earlier on this week, and she made the point that a lot of businesses are waiting for the election to clear before they start making some big decisions. We've seen M&A be held back for very specific reasons down in Washington, D.C. The IPO pipeline hasn't been great. Ken, do you see that improving in 25, and is there good reason to expect it to?
No, I think you're absolutely right. And certainly, you run for bonuses if you're an investment banker starting in September, but I think the tone is the election creates a stall. But I think CEOs, as they look at what they want to do for next year, and as it comes into either capital raising or M&A, they're really looking to see, well, what will be that environment? They know kind of where it's going for rates and cost of capital, but what does it mean in Washington? So I think we're not going to be in a high risk on environment, but last year we hit the trough in terms of investment banking, and I see an upward view for next year. That's positive for Goldman Sachs.
Ken, there are a number of different aspects to this story. The reason why we haven't seen IPOs pick up to the same degree, and part of it has to do with something else you alluded to, which is the increasing dominance of private credit and private equity. You mentioned that Goldman Sachs really beat on the debt underwriting. We saw a miss with the debt underwriting of Bank of America. How are the different banks handling and either benefiting from or suffering from, losing market share from, this increasing dominance of the big private equity and private debt players?
I think to your question, it's really private credit. And Jamie Dimon now every quarter speaks to it. It works brilliantly for smart firms that I cover, like Blackstone, Apollo, Ares. But what happens when you have systemic risk or something goes wrong? We're seeing, it's an old term I use, co-opetition, which means that the firms I just mentioned do work with the JP Morgans or the Goldmans as perhaps sometimes funding them in the transactions, but additionally, they are competing. And the one term that you would hear for 20 years as a bank analyst is the growth of bank syndicate loans. We're not really hearing that anymore. And that's what the commercial banks have to do when you're looking at deal sizes of loans over $1 billion. The private credit business is operating into those areas, moving from middle market to larger transactions. I like it. I think private credit is great because, as Apollo says, we don't want the customer. We're just going to look at what the measured risk is and then decide whether we want to invest or not.
I guess to underscore the point here, are some of these big private credit players really taking business away from the big banks? Because it looks like the big banks are doing just fine.
Well, they are, but there's a mismatch of assets and liabilities and duration. We've been through that story for over a year ago, but it's still there. Those assets, secured assets, which have long-term tails. The regional banks really can't hold on to those, so they're going to be parlayed over to the alternative asset managers. And the area where they're all going to compete is in wealth management and retirement. And again, I mentioned these recurring revenue businesses like annuities and insurance. Those are great businesses, and that's where the opportunity, I think, is for all these banks.
Hey, Ken, it's good to hear from you. Ken Leon there of CFRA. Look at these moves in the pre-market. Let's get that board up on the screen once again. Big shift higher on Goldman Sachs in the pre-market, up by something like 3%. Nice move as well on Bank of America. Numbers from them a little bit earlier this morning. We'll get Citi in about 23 minutes' time. Citi at the moment up another 1%. We had some big moves on Friday off the back of what we saw from Wells and JP Morgan. Those moves continue this morning off the back of these numbers too.
With beats across the board, and it comes to net interest income, it also comes to wealth management and what's going on there. It also has to do with trading revenues. I keep going back to the idea that the bar was lowered And then they handily kicked over that line. Was there something that they were seeing that somehow changed in the past couple of weeks, or is it just that they were trying to gauge people's sentiment so that they could look good?
I think there's certainly a big dose of that. I think when it comes to net interest income, 2025 still a bit of a mystery. Looking for guidance there, particularly with the Fed's rate path still pretty uncertain. We spend the whole show discussing that most days, what's going to happen with Federal Reserve policy. They don't know the answer to that either. You brought up a big structural issue that I think is really important. We heard this conversation with Mark Rowan of Apollo just a couple of weeks ago, and Mark made the point that fewer companies are going to go public, and we're seeing that already. There's some big structural headwinds to the story in investment banking. Things are changing. Private credit's a big piece of that, and I'd say the regulatory headline is another big piece of the puzzle when it comes to mergers and acquisitions, and I don't think it's going to be too different based on what we've heard from one campaign to the other as we have this race for the White House this year.
Well, not if you look at how the FTC is currently operating under Lena Khan, who we have seen Trump's running mate, J.D. Vance, talk about her, how she's potentially one individual in the Biden administration he actually agrees with. Regulatory, when it comes to just big banks, big tech, this is something that both camps are looking to really needle at.
Certainly a decent morning for Goldman so far, that's for sure. Under surveillance this morning, Goldman Sachs rising in the pre-market as bank earnings continue to roll in. The bank beating third quarter net revenue and net interest income. Results from Citi still ahead at 8 a.m. Eastern time. That's about 21 minutes away. That stock is higher by 3.7%. Elsewhere, Nvidia coming into Tuesday at record highs. Shares boosted by continuing demand for its Blackwell chips. The CEO, Jensen Huang, reassuring investors that product delays have been smoothed over. Things are improving.
What I find fascinating is that the shares are up even with some of the concerns around limits on how much the U.S. can export in terms of semiconductor chips. To put this into perspective, NVIDIA shares are up almost 14% this month. We're like not even halfway through. Okay, today we're halfway through. Halfway through the month, they're up 14%, 2.4% gain yesterday. A real question of whether we are actually even underpricing a story that has been one of the main drivers of returns so far this year.
Already the Biden administration has some of these controls or these caps on about 40 countries throughout the world when it comes to NVIDIA. But the demand is so insatiable, it doesn't matter. You could put more countries on that list. You can cap more of this. There is massive demand just right here in the United States.
NVIDIA making another move in the pre-market today. Look out for that rally. More on that story, 8:15 Eastern. We'll have a conversation about that single name and a rally we've seen so far. I want to turn to this slightly controversial story on Tesla. Reportedly remotely controlled some of their capabilities of its Optimus robot prototypes at its showcase event just last week. Sources telling us here at Bloomberg that while the robots were able to walk without external control, employees stationed elsewhere oversaw many of the interactions between the machines and attendees. Not clear how much progress we've actually made.
I love this story. It reminds me of The Wizard of Oz, when you sort of pull back the curtain and there's a guy there kind of operating all these different steam engines. There's a question here about whether this is actually ready to go or whether this is maybe looking like more of a promise. And Elon Musk has a history of making big promises with ambitious timelines. Even he has conceded that. And so it really raises a question, since that was the star of the event, a lot of people said.
What can it do, Musk said? It could be a teacher, babysit your kids, it can walk your dog, mow your lawn, get the groceries, just be your friend, serve drinks, whatever you can think of it will do. He was talking about the robot. I will say that knowing that, to your point, like the Wizard of Oz, the humans basically controlling what it was doing behind the scenes, it gives his whole title of the event, We Robot, a whole new meaning. Yes, we, as in humans, are controlling the robots.
Someone behind the curtain, literally, as you said.
Yeah.
Controlling things, making your dinner.
Yeah, well, I mean, you know what?
A Tesla employee.
I actually am okay with that. If a Tesla employee wants to come make me dinner with a robot.
Remote controls the factory robot, yeah.
I'm okay. It depends on if you're a good chef or not, but, you know, we could discuss.
We can have that discussion. Depends what they can cook, Bramo. What they're programmed for, that depends on the subscription and what you're willing to pay. It's all subscription-based, of course.
Can you imagine?
Yeah.
Sort of like the Applebee's base.
One recurring revenue, don't you?
Versus the, you know.
How much have you spent on your software for your robot versus to the house next door, you know?
And that depends on how well they cook. Actually,
exactly.
That would be brilliant.
There you go.
I would get into
It's the future of chefs and Michelin star.
Exactly. Saturday night is the new
Michelin's going to rate your robot. Let's get you an update on stories elsewhere before this goes too far. Let's get your Bloomberg Brief with Danny Berger. Here's Danny. Hey, Danny.
Hey, John. J&J shares down by about 1% this morning. It did report stronger than expected third-quarter earnings. That beat was driven by surging sales of its cancer drug, Darzalex. However, J&J lowered its full-year guidance to account for a medical device acquisition. CFO Joe Walk said that they are still seeking smaller tuck-in deals, but also remain open to larger acquisitions. On the other side of things, Ericsson shares surging to their highest level in 2 years, up about 11.5% over the past 3 days, after its deal with AT&T helped push third-quarter earnings above analyst estimates. North American sales for the telecom equipment company grew by 55% year-over-year. Sales in Europe also saw growth despite facing a challenged market for network technology. Tensions between Canada and India are escalating. Prime Minister Justin Trudeau accused Indian diplomats of backing criminal harassment against Canadians. It compounds a dispute that began last year when Trudeau suggested that Indian agents were involved in the murder of a Canadian Sikh activist. Canada expelled 6 officials yesterday. It said India refused to waive their diplomatic immunity for questioning over a number of violent incidents. India has rebuked Canada and expelled 6 of its senior diplomats in response. And that's your brief, John.
Danny, appreciate it. More from Danny again in about 30 minutes' time. Up next on the program, crude uncertainty.
These attacks have claimed the lives of many Israelis, including yesterday. Israel has every right to defend itself against Hezbollah and will continue to do so.
That conversation up next, live from New York this morning. Good morning.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Goldman Sachs in yesterday's session closing at all-time highs. Even before this move this morning, year to date, that stock was up by more than 35%. That is where the outperformance has been from the big banks on Wall Street. Goldman up again this morning by 3.4%. Bramo, it's another big meet.
And a lot of it has to do with net interest income pretty much across the board. Net interest income for Goldman Sachs came in at $2.6 billion versus the expectation of $1.8 billion. It is a good and beautiful thing for these banks when you have a disinverted yield curve, and that is what you're seeing in all the results.
Upside surprise on Bank of America as well earlier this morning. That stock is up by 2.4%. You'll get numbers from Citi in about 13 minutes' time. Under surveillance this morning, crude, uncertainty.
Israel is not fighting UNIFIL. It's not fighting the people of Lebanon. It is fighting Iran's proxy Hezbollah, which uses Lebanese territory to attack Israel. Hezbollah attacked Israel last year without any provocation on October 8th, a day after the Hamas massacre. And it's continued to attack us ever since by launching over 10,000 rockets and missiles at Israel. These attacks have claimed the lives of many Israelis, including yesterday. Israel has every right to defend itself against Hezbollah and will continue to do so.
So here's the latest. Oil extending losses on a report that Israel may avoid targeting Iran's energy facilities to limit potential escalation, easing market concerns of a major supply disruption. In a statement, Netanyahu's office said, "We listen to the opinions of the United States, but we will make our final decisions based on our national interests." Stephen Cook of CFR joins us around a table for more. Stephen, good morning.
Good morning.
Do you buy the reporting from the Washington Post? Do you believe that maybe he will pull back and won't go for energy infrastructure in Iran?
Maybe. I don't really put a lot of stock into the Washington Post reporting, if only because these discussions with Israel have been going on for a long time throughout this conflict. And every time the United States believes they have the Netanyahu government in a position where they're agreed, the Israeli government does exactly what Prime Minister Netanyahu said in that statement, that the ultimate decision is up to the Israeli government. So it will be anybody's guess until those planes or missiles are in the air what those targets are.
If this is accurate, though, what is the United States and what is Israel getting in return?
Well, the Israelis are getting the THAAD anti-missile system, which is an incentive for the Israelis not to hit Iran's energy or nuclear infrastructure. The clear fear is if the Israelis go way up the escalation ladder and go after those very symbolic and important sites, the Iranians will respond in kind, and that's precisely what the Iranians have said. The United States would like for this to be an Israeli response and then the end of it. But that is a way to both incentivize the Israelis to avoid those sites as well as to protect Israel from another Iranian strike.
This is a really important piece of technology. It was only deployed to Israel once, and that was just for operational purposes in 2019. They've never actually used it. Wouldn't the THAAD be enough for Israel to maybe agree with Washington in terms of their retaliation?
That is clearly the hope of the Biden administration. But again, throughout, a number of weeks ago, the Biden administration thought that the Israelis had agreed to a ceasefire in Lebanon when the Israelis actually escalated. So once again, we have to listen very carefully to what Prime Minister Netanyahu and his advisors say, which is, ultimately, the decision is up to us based on our own security. And this has been a tension in the U.S.-Israel relationship. The United States has broader concerns, whereas Israel has very, very specific concerns about its security and its adversaries.
They have specific concerns, but at this moment, do they know where it is going?
Well, that really is the biggest question. What is the overall Israeli strategy here? And I think the overall Israeli strategy, although people say, oh, it's a mystery and whatever, is to reestablish Israel's deterrence. They're having actually a hard time doing that. They have been pounding Gaza for a year, yet rockets still fly from Gaza occasionally into Israeli population centers. Israeli forces have to go back into sections of Gaza to fight. They engaged in a number of stunning intelligence operations in Lebanon just a few weeks ago, pushed Hezbollah back on its heels. Yet, since the killing of Hassan Nasrallah, the leader of Hezbollah, I count somewhere in the neighborhood of 2,000 rocket attacks on Israel. Israeli forces are operating throughout southern Lebanon to try to suppress this and secure their border, but they haven't done it.
Given your historical knowledge, where we are right now in this conflict, is it the start of a more longer protracted conflict? I think of where the United States was when they went into Iraq. This is at this point in that time basically decimating the Iraqi military, decimating Saddam Hussein and all of his acolytes. But that conflict dragged on for years. Where are we?
I think this conflict is going to drag on for years as well. Just think about Gaza. The Israelis have no one to hand Gaza off to, so they have to keep going back into parts of Gaza where Hamas reconstitutes itself. Think about a security belt in southern Lebanon. The Israelis had one between 1985 and 2000. They don't have any partners to hand it off to. You can't count on UN peacekeepers. You can't count on the Lebanese armed forces. The Israelis are dealing with a situation where they have to decide on what is the least worst option for them. And right now, it seems they're left to having an extended, grinding counterterrorism operations, both in the south and the north.
You said that the U.S. has a different aim than Israel, that the U.S. wants a more contained and limited kind of strike. Is it just simply because of oil prices, or is it something bigger?
Well, it's clear that the United States doesn't want a regional war because that would affect regional oil prices. But there's also a question of regional security. If there is a larger war between Israel and Iran, it could involve Saudi Arabia and the UAE, which are both extremely vulnerable to Iran's missile forces.
The reason why I ask this is because you think about the Houthis attacking some of the shipping resources. You think about some of these other threats that have raised concerns among the U.S. as well as Saudi Arabia and the UAE. Where would they stand if this conflict were to escalate?
Yeah, I think that ultimately, if it were to escalate, they would close ranks with the United States. But the Saudis and the Emiratis are angry at the United States for not heeding their warnings for about a decade about the Houthis. And now we're dealing with a much greater Houthi threat than when they first started warning about it.
We had a market guest, an investor on this program in the last week or so, who suggested that maybe there was a vacuum of leadership right now, waiting for the election result, and that foreign actors could possibly take advantage. How do you view that situation?
Well, I think it's clear, particularly when it comes to what the Israelis are wanting to do and what we started talking about, is that we're 3 weeks to an election and then there'll be a transition. It sort of gives leaders a free hand to do things. If Netanyahu decides and the security cabinet decides that hitting the oil infrastructure and the nuclear program are in Israel's best interest, the president of the United States is only going to be around for a shorter period of time, so that they essentially have a free hand to do what they want.
Do you think it gets more or less dangerous when we get to November, between November and late January?
Oh, I think that we are in an extraordinarily dangerous period right now, with the Israelis contemplating a major strike on Iran and the Iranians promising that they have no red lines, that they will respond in a very serious way to the Israelis, thus the THAAD.
Given how many things this White House has got wrong over the last 3.5 years, are you surprised that the same people are going to finish this administration as start it? Are you surprised that Jake Sullivan's still there, Finer's still there, Blinken's still there? They've been there the whole time and made mistake after mistake. Where is the accountability in this administration?
Yeah, look, the Middle East is extremely, extremely difficult.
Of course.
No doubt about it. But yes, I think that the administration, and particularly the person of the president, made a number of miscalculations at the outset of this conflict. There has been the idea that a hug of Prime Minister Netanyahu would give him leverage over Israel's military operations. There was also the belief that a new relationship with Iran was possible, rather than understanding the fact that the Iranians were willing to have limited agreements in one realm while sowing chaos in other dimensions.
Stephen Cook, CFRA. Appreciate it, sir, as always. I think we all remember that conversation. Was it Jake Sullivan? Right before the events of early October, that tragic terrorist attack and the war that ultimately came afterwards, saying that it's as peaceful as it's ever been over the last few decades.
Yeah, saying the region's been the most peaceful. That went online as such, or into written copy, and then they were able to edit it online. But those words were still there. And then almost just recently, we saw the same happen with Secretary of State Antony Blinken.
Amazing. Coming up on this program in the next hour, Stephen Orth of Federated Hermes, William Stein of Truist Securities, Kathy Boschanczyk of Nationwide, and Vishal Kanduja of Morgan Stanley. From New York, this is Bloomberg.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. that said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There's a lot of potential earnings upside ahead.
The health of the stock market's going to depend on earnings.
You do need to see earnings estimates continue to rise, we think, in order to support the market.
We're going to see solid, but not blockbuster revenue growth in the third quarter.
Earnings need to do a lot more heavy lifting as we turn the corner into 25.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Coming into Tuesday at all-time highs on the S&P 500. The opening bell 90 minutes away. Equity futures on the S&P 500 just about unchanged throughout the morning. Likewise on the NASDAQ. The NASDAQ 100 right now, negative by just 0.04%. Elsewhere, some decent gains, and I'm talking about some big moves in the banking sector. It's been upside surprise after upside surprise throughout the morning. First of all, it was Bank of America, upside surprise. Stock is higher by 2.6%. Goldman followed, same story. We're up by 3% in the pre-market. Citi, just seconds ago, markets revenue 4.82 billion, the estimate 4.6. Bramo, an upside surprise.
And pretty much it's across the board. If you look at fixed income commodities and currency sales and trading, also beating at 3.58 billion versus the estimate 3.4 billion. You could take a look at markets revenue coming in above estimates, as John, you just mentioned. Equity sales and trading coming in at 1.25 billion versus the estimate of just north of 1 billion. Basically across the board, a couple of hiccups here and there, but just underscoring how much strength there is right now in the banking sector as they face off with an economy that's just fine, a consumer that's chugging along and spending, and net interest income that's coming in bigger than expected simply because, if nothing else, the yield curve has disinverted.
You nailed it, the word strength. You take out a nugget from what Goldman's boss, David Solomon, is saying in his statement. Strength is in the first sentence of his statement to shareholders, and, quote, strengths, plural, is in the second sentence. There is no third sentence. That is where the banks right now, and they're feeling very good, no major drama. I'm interested in what the CEOs have to say about other things happening in the world. Jamie Dimon talked about this on Friday, the geopolitical uncertainty and what that could mean to the global economy.
Look out for the calls throughout this morning. That stock is edging higher, just inching higher just a little bit in the pre-market. Coming up this hour, here's the lineup for you. Stephen North of Federated as banks deliver better than expected results. William Stein of Truist as Nvidia rallies back to record highs. And Kathy Boschancic of Nationwide looking ahead to some messy data. We begin this hour with stocks at all-time highs, lifted by tech as investors stay optimistic about the start of earnings season. Stephen North of Federated remaining cautious, writing bull markets are known for climbing walls of worry. So in some ways, the present batch of uncertainties is not unusual. However, with the market already less than 5% away from our 2025 6K target on the S&P, investors can afford to be measured here. Steve joins us now for more. Steve, good morning.
Good morning, Jonathan.
Decent run for the banks. Backed
Absolutely.
up by the earnings too. Are you encouraged by what you see?
Very important. You got the banks are the big hunk of the value indices where we're overweight, and we're telling people that's where they should be. And this is what we've needed to see. Once you disinvert the yield curve, what's going to happen is rates are coming down. It's helping the banks because it's disinverting the curve. It's not helping. You keep bringing up the idea that, gee, these rates are coming down. That should be, if they don't come down, that should be bad for tech. The 10-year yield, we think, is probably going to stabilize here, as you point out, Lisa, between 3.5 to 4. It's not probably coming down. The curve is disinverting. The 10-year matters for the tech stocks. The curve matters for the value stocks, the bank stocks, and that's what we're seeing. We're seeing the earnings coming through there, and they're trading at 16 times. Large cap growth indices are trading at 28 times. So the gap is quite substantial on both where the earnings growth is heading and where the valuations are.
There's a lot to unpack there. There's an idea of the banks as a litmus test for the rest of the value sector, basically a litmus test on how much this is an economy that's reaccelerating, or really in the mid-cycle or early cycle of another bull market. And I'm wondering whether that's actually accurate, whether these banks truly are a reflection of that, or whether they're telling a somewhat different story than what we might hear from the Ally Financials, from the Capital Ones, from the regional banks.
Well, Allied Financial's telling you, I think, we've kind of cut that to pieces, but, it's telling you that the low-end consumer is in trouble, right? Their problem was on, the car loans for the low-end consumer. Okay, that's where there's weakness in the economy. And we see that throughout the stock market. But the rest of the economy seems to be being okay. I wouldn't say re-accelerating. We're more in the line of it's landing. We had a little bit of a soft patch, so maybe re-accelerating off of August. But we see it as landing, and that should be good enough for a lot of the stocks in the value sector. I mean, I'm not recommending buy the whole index here. I think it's a kind of a stock-picking game there. But
you sound cautious, optimistic, but not necessarily, hair on fire, let's go buy everything because it's going to be amazing. Why the caution?
Just because we've had a huge move. When we set our target of 6,000 back a year ago for 2025, people thought we were a little bit nuts. I mean, at that time, we were going to head into recession, next week at 3:30. Everybody knew it. And we said, look, we think we can get to $300 in earnings by 2025 on the S&P, which sounded like a big number. But on a nominal basis, given how much the inflation has driven up nominal GDP, we thought we could get there. We're still at 300. We think a 20 multiple kind of works. We've always thought inflation was going to stabilize around 2.5%. Not quite at the Fed's target, but I would call it their informal target. If you're at 2.5% on inflation, you're probably at 3 at the Fed funds rate, and you're probably at 4 on the 10-year because you're going to reestablish a term premium. Long-term bond investors have figured out, oh my goodness, we can actually lose 20% in a year. So they're going to want their term premium back. So we've been pricing stocks against a 3.5 to 4% 10-year yield. And when you look at historically where that should be, about an 18 multiple on stocks. Okay, in the interest of being a little more aggressive, we use a 20 multiple. So 20 times 300 in 2026, which you discount back at the end of 25, well, that's, I don't need my summer intern to tell me that's 6,000.
But going back to Lisa's point about these concerns, you write in your own note, bull markets are known for climbing walls of worry, and you outline 5 uncertainties that you really need to tie a bow around in order for this bull market to continue. Yeah. What makes you the most nervous?
Well, I'm actually thinking about writing a piece soon called, 4 out of 5 ain't bad. I wrote a piece over the summer called 1.5 out of 3 ain't bad. But these things are clipping away here, right? The earnings numbers needed to come in first and foremost. Now, let's see how the rest of the season goes. But the banks, which were a big piece of our idea, they're showing strength. That's good. Then you got to get the inflation numbers not to reaccelerate. That's a little bit dicey here, but we still think we're heading for like a 2.5. The PPI was sort of a 2.5, let's call it. So the inflation numbers need to stabilize, but maybe a little higher than the market wants, but we think good enough. Then the Fed needs to indicate not so much the pace, but that they're going to get to the levels we're talking about. All they've got to do is get to 3% on the Fed funds rate, and the rest of the story falls into place. We have a Fed meeting on November 7th. That'll be a big one, just to see the tone of that. If things keep going the way they're going, they probably don't even cut there. But it depends on the tone of the press conference, right? And then you need China to finally kick in. We're seeing that. They're attacking now at a simultaneous level, both Fed, fiscal policy, and monetary. We think that package could be $5 trillion that we're looking at, which would be an upside surprise. And then you need the election to fall into place to help the value trade, because I've always said this, the election is about value versus growth in some ways. I mean, not so much the market overall, but President Trump would be far better for the old economy stocks, if you look at his policy agenda. So in a way, that just adds fuel to the fire, and right at the moment, it seems like we're heading in that direction.
So fall in place for you is a Trump victory?
Yeah, for the kind of the value small cap trade that we've got in place. We think if you look at his policy agenda, deregulation as an example, that helps smaller companies that don't have the wherewithal to pay all the costs of regulation. Lower high-income tax brackets, which affect all the small company businesses that file in that fashion. The tariff agenda, which is probably negotiating one, but certainly probably helps the old economy industrial stocks, a lot of those in the value space. So the Trump agenda is primarily oriented, in our idea, towards more of this value trade. And if that comes into place, that just adds fuel to other existing fires that help that trade.
So if you do get a sense of who wins, then you will be much more aggressive with the trade. Is that basically, are you waiting with some cash to basically figure out whether you're going to put it one way or another, depending on November 5th?
Our old friend Tom Keene, right, always has that cash money market fund.
Triple leverage.
Triple leverage.
Still in it, I'm told.
We've got 2 on the sidelines, 2 points out of 10 in money markets. We're earning 4 or 5% on that, which is not bad right now, but that's going to go back into the market. Maybe when we get to 4 out of 5. It might be before the election. You got to watch the polls here, but they're going in a direction that might cause you to probably, the market's going to try to discount all this stuff in advance. So if you're too cute and, try to wait for everything to fall into place.
That begs the question, are you being too cute?
I might be.
Are you worried about that? Stocks at all-time highs, credit at multi-decade tights.
We're still overweight stocks, so we're hanging in there. Okay,
cautiously bullish.
Yeah, and I guess I'm probably waiting to see maybe if the large cap tech stocks can live up to expectations, other than NVIDIA. NVIDIA's making a boatload. Not going to argue there, but the rest of them are paying money to NVIDIA, and they've got to actually show that they can make money. That might cause some softness in the market.
Steve, it's good to see you.
Likewise.
When you get to 5 out of 5, come back.
I'll give you a call.
Good. Stephen Orth there, Federated on the latest. We got Citi numbers just moments ago. Citi up in the pre-market. We've had a decent run of gains for bank stocks over the last week or so. It started with JP Morgan and Wells Fargo on Friday, and this morning it continued. We heard from Bank of America, we heard from Citi and Goldman Sachs, all looking pretty good. Let's cross over to Ken Leon of CFRA. Ken, Jane Fraser overseeing and delivering a multi-year transformation of this bank. How's it going?
That's right, and I think it's continuing. I mean, there's milestones ahead. They still have to sell off next year their largest non-U.S. consumer bank in Mexico. Additionally, they already had the mark of reducing headcount by 20,000, and we'll get some progress on that and just managing operating costs. Rates are important because 74% of their total net revenue comes from net interest income. They have a lot of good businesses that have durable recurring fees and treasury services and payments. I think Citi looked okay. And then kind of the takeaway from the large banks dealing with the consumer is that the NCLs, or the non-performing credit loans, are in that 3.5 to 3.7% ratio to total loans. So it's those are pretty good, even for all the bank analysts. And I think to the earlier discussion here, the banks are holding their weight in and give us a bullish view with an overweighting of the financial sector. There's about 12 stocks that represent 65% of the financial sector. 4 of the big banks are there, but you got quality in this group with the Visa, MasterCard, American Express, S&P Global, Berkshire Hathaway. But I'm relieved. I think the banks are really going to send us off into a more positive 2025 for the fundamental outlook for these large banks. And our analyst who covers the regional banks is also much more constructive than where we were 6 months ago.
So Ken, just quickly and finally, do you expect more of the same from Morgan Stanley tomorrow?
I think Morgan Stanley is also going to be like Goldman and celebrate how well we're doing in the capital markets, trading, of course, but there's still upside opportunity going into next year for investment banking. That's good for Morgan Stanley. And with the equity markets rising, market values will benefit the largest wealth manager, which is Morgan Stanley.
Ken, good to see you. Thanks for this morning. Ken Leon of CFRA. So far this morning, so far over the last few days, clean sweep for banking in America.
Pretty much across the board beats, and really you can't find many misses. The ones that you do are pretty minor. Our big question here about whether this is just a positive read for the financials or a broader positive read on both the consumer as well as just business sectors, that we're struggling with how high benchmark rates were, seeing them come down, but still seeing their assets perform that are put into longer-term debt.
Citi up by about 2%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some other earnings for you. United Health shares down 3.4% in the pre-market. It lowered the top end of its forecast, a rarity for the insurance giant, which usually withstands pressures that hurt its peers. Higher medical costs and the rising impact of a cyber attack were behind that guidance downgrade. United Health is often seen as a bellwether for the health insurance sector. Oil prices tumbling, down some 3.9% and 4.2% for Brent and NYMEX crude. Reports that Israel will avoid targeting Iran's crude facilities and its expected retaliation for Iran's missile strike 2 weeks ago. The report is easing investor concerns over what many feared would be a major supply disruption. Israeli Prime Minister Netanyahu told the Biden administration the nation plans instead to target Iran's military. The news also comes as the IEA warned this morning that the oil market will face a glut heading into next year. And top U.S. labor official Julie Su has met with leadership at Boeing as the ongoing strike continues to take a heavy toll on the troubled plane maker. Su traveled to Seattle and reportedly urged both sides to move forward in the bargaining process over a new contract. The developments come after the latest talks between Boeing and its largest union broke down last week. Boeing's latest offer was raised to a 30% pay boost over 4 years, which was rejected by union leaders. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the morning calls, plus William Stein of Truist as NVIDIA shares hit a fresh record high. The conversation up next, live from New York. You're watching Bloomberg TV.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
If you're just tuning in, welcome to the program. It's been beat after beat on Wall Street for earnings season so far, and it was no different this morning. We heard from Bank of America, Citi, and Goldman Sachs. Upside surprises here, Lisa, across the board.
Yeah, net interest income coming in strong across the board, and I think that's important to really highlight, given the fact there was a big question. And we were talking about this extensively. Are high rates good for banks? Are low rates good for banks? And as Steve Auth was just saying, it's the shape of the yield curve, which is not what you really want to hear. But basically, when you have long end pinned at 4% and short end coming down, that's a pretty good time for banks.
That outperformance continues for Goldman. That stock is up by more than 35% so far year to date. It's up another 2.76% so far this morning. Let's get you some morning calls. First up, Goldman Sachs downgrading Etsy to sell, adopting a more selective approach to e-commerce stocks ahead of earnings. That stock is down by 4%. Next up, BMO downgrading American International Group to market perform, citing minimal room for growth and soft pricing power. And finally, Evercore adding Airbnb to its tactical underperform list, recognizing potential for a muted bottom line outlook. Let's turn to tech. NVIDIA coming into Tuesday at record highs. William Stein of Truist calling the stock a buy rating. We expect NVIDIA's superior positioning in gaming, server acceleration, AI, and eventually autonomous driving will lead to ongoing structural fundamental growth and stock performance. Will joins us now for more. Well, welcome to the program. Let's talk about this buy rating. There's a lot of people that have still missed out on this run. The stock's got to a record. It's up by a ridiculous amount year to date. What's your advice to people who are out of the stock looking to get in? Why is now the right time?
Yeah, I think the first and perhaps most important thing to recognize is to distinguish between, record stock price and valuation. Just because the stock's up a lot doesn't mean that it's expensive. We don't think it is. And we think there are earnings beats still on the come for this company, and it is not expensive relative to growth semis.
How much of this depends on their ability to produce more quickly and also to get some of the updates up and running in a more expedited fashion?
Sure. The company recently transitioned from a 2 or more year cadence in between these AI specialized GPUs to a 1 year cadence. They announced that relatively recently, and they're starting it going forward as they go from the emerging Blackwell generation to the next generation called Rubin. That's when they're going to be on this 1 year cadence. And of course, being on time helps. They are significantly ahead of the competition. In fact, we don't even really view this 1 year cadence as something that's required in order to distinguish NVIDIA from its nearest competitor. It's really about the full stack of technology that the company offers its customers. It's not just these high performance chips, right? We've talked about three things, a culture of incumbency, an ecosystem of incumbency, a culture of innovation, and significant investment in software services, and now pre-trained models is a big part of the company's business as well.
Some people were surprised that given, yes, there is a lot of good and it's all being priced in, or some of it is, you're saying it's not all being priced in, but there is a potential cloud hanging over the stock, and it comes in the way of restrictions by the U.S. government. How do you see, if not necessarily dampening demand, how do you see NVIDIA being challenged or adjusting its business model in response to concerns about national security?
I think it's a super important question, but it is also critical to understand that this company has dealt with these restrictions for a number of years, as have most of the semiconductor companies in the United States. There have been export restrictions, and let me give one example. We spoke with management a few weeks ago. We hosted a bus tour, and NVIDIA was one of the featured companies, and management was talking about sovereign AI as one of the current significant growth drivers, right? These are national level AI models built in countries that might not speak U.S. English as sort of their main language. So France, other countries in Europe and Asia building their own domestic, or let's say sovereign AI models. And I asked about China, and it was a flat, we're not working with the government of China on this. Let's be clear. These restrictions have been in place for a while. They will continue to be. It's the volatility in what is restricted that's going to challenge not only NVIDIA, but all the companies in this space.
At this moment, though, William, would you say that these restrictions, which you're right, for NVIDIA and for AMD, that's happening about 40 countries around the world, the United States has these caps, are they narrow at the moment?
Well, they're always changing, right? So it's certainly possible that a new restriction could come into place that could make the company's revenue generation more challenging, right? For years, they've had specific products for China that they've rolled out to address that market while not breaching any of the concerns of the U.S. federal government. I think NVIDIA is going to continue to do that. Continue to have a China-specific skew, and new restrictions might make that harder over time. But this market has not been wide open to NVIDIA so I don't think there's massive change coming in this area.
William, appreciate your time this morning. On the stock with a buy rating, William Stein there of Truist. That stock is down by about 0.7%. It's up by almost 180% so far year to date, after gaining the year before by close to 240%. William had a really important distinction. The stock is at a record high. The valuation is not. The earnings have been real over the last year.
Which is the reason why people can justify and say, ultimately, there's no other game in town. That's one thing that he said. Even if they release fewer chips, maybe one a year, they're so far ahead of their competition that it's just hard to see how they're going to lose that share in this race.
The national security concerns are really interesting because this scoop that we have, it remains to be seen whether or not Biden even has enough time to put these kind of caps to the countries in the Persian Gulf they're looking at, say, the United Arab Emirates. Is this something that, obviously, if it's Kamala Harris, it probably would carry through. But if it's the former President Donald Trump, are we looking at this similar type of caps when it comes to these AI companies and their chips?
Quite possibly. NVIDIA right now is down by 0.6%. Up next on the program, Kathy Bosjansis of Nationwide and Vishal Kanduja of Morgan Stanley Investment Management on the data and the bond market. That's up next on the program as we count you down to retail sales a few days away from New York. This is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
60 minutes away from the opening bell. Equity futures on the S&P 500 totally unchanged. Plenty of action beneath the surface as we count you down to the opening bell. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Just digging into some of the earnings bonanza. Really strong showing from Schwab. Shares up more than 8.5%. It is the benefit of lower rates and a booming equity market. New client assets up by 27%. That helped them beat on their EPS 77 cents versus 75 expected. Also helped them write down some costly debt. Another mover to the upside after earnings, it is Walgreens Boots, reporting that they will be closing less stores than expected over the next 3 years. 1,200 stores before they said it would be 2,000. Closing stores, immediate boost. But again, not as bad as feared, up 4%. But just for some context for the stock, it's down 65% year to date. So maybe a low bar for them. The CEO saying that they still have more challenges ahead for the rest of the year. Speaking of low bars and being able to beat them, the banking sector. Here are the three major ones that reported today. Citi, Goldman, Bank of America, all up at least 2%. One of the stars of the show for all three of them was trading. Trading results really strong. Goldman Sachs, their best equity trading quarter since 2021. For Citi, it was their best third quarter trading results since at least a decade. Net interest income, that also fell, but wasn't as bad as expected. So, John, for the banks, the good times keep on rolling.
Danny, they do. Thank you very much. And you'd have to imagine it's a pretty high bar for Morgan Stanley tomorrow after all these numbers this morning.
Especially because Goldman Sachs and Morgan Stanley are in this tit for tat who can actually outperform the other ones. So for Morgan Stanley, they need to come out and show that not only are they beating when it comes to net interest income, but that their wealth management unit really is outperforming, because that is the engine a lot of people are looking for there.
That's one for tomorrow morning. Markets also looking ahead to the big data point of the week. Retail sales on Thursday. Kathy Bosch-Jantic of Nationwide expecting September's print to come in relatively flat. Also anticipating some idiosyncratic impacts thanks to Hurricane Helene. Kathy, welcome to the program. I want to get to the words of Governor Waller, who suggested that maybe we could see 100K subtracted off October payrolls because of the strike at Boeing, because of the hurricane impact as well. Can you put a number on it, or is it still too early?
Well, good morning, John. Well, we know that, in the past, right, there's been disruption, to employment, to production, could also skew higher, prices of construction and used car prices, things like that. It is always difficult to precisely get a handle or estimate ahead of time, but I think it's fair to say it's at least 100,000 or so off of this. Historically, it has been in that range, 50,000 to 100,000, depressing payrolls. And the problem is it comes at a time where it's messy, right, for the Fed. They'd like to get as much clarity as possible on the incoming employment readings, and this just makes it difficult to get that clear view.
So, Kathy, Governor Waller acknowledged this in the speech. The next couple of lines, he talked about this data dropping in the quiet period and how they wouldn't be able to explain to people what was actually going on. Do you see a big mission, a campaign effort now from the Fed officials for the next few weeks to explain how weak this number might be and how little it might mean for the decision they make on November 7th?
I think that makes sense that, you know, especially with Governor Waller starting that discussion. I think that makes a lot of sense. I'm also a little bit concerned about this messages being sent during the blackout period. Maybe they need to shorten the blackout period. That's another discussion. But I do think that's true. And you're going to see that with it in production data as well, and jobless claims. You know, we saw that increase last week. That's probably going to increase another, you know, above the normal trend, and we're going to see it in specific states as well.
What I find interesting is that everybody's looking at an explanation for why the Fed won't be more aggressive with rate cuts, but no one's thinking, oh, maybe they're not going to cut rates at all, even though we saw an upside surprise when it came to inflation. Why was the upside surprise not a big deal in any way, shape, or form for all the people talking about further rate cuts of the likelihood of probably 50 basis points by year end?
Yeah, it's, well, it is just 1 month's data. And I think within that report, there were a lot of idiosyncratic measures where we saw increases, which we don't think will continue. Like apparel was up over 1%. You also saw, you know, odd things like sporting event cost up, you know, 10%, 11% on 1 month. You know, those aren't repeatable. And the overall trend that we look at still looks encouraging, and particularly because we saw shelter costs start to cool down, and we think that will continue to be the case. But it certainly should raise some doubts of whether they will go into November, December. We would agree with that. It's not a sure bet or slam dunk, but we still, in our baseline, look for 2 25 basis point rate cuts. And it's really because policy is still very restrictive at this point. And the Fed has told us, and rightfully so, they want to get back to a neutral rate to help nurture, you know, continued expansion.
I want to pick up on what you just said, Kathy, that it's clear that we are currently in a very restrictive state of monetary policy. There were some doubts raised about that by Neil Kashkari, basically saying the extent to which the interest rate policy was restrictive is, quote, unclear. He was speaking yesterday at an event in Argentina. Chris Waller talking about how it is important to move toward neutral, but we haven't gotten that clarity from the Fed. Is there a precedent of this lack of clarity when it comes to even the range of potential neutral rates that we could be heading toward?
Well, I think it's refreshing and certainly, you know, a bit more transparent in the sense that you never really know what the neutral rate is, and you have your models, you have the Taylor rule that you could use. And you could also observe the incoming data. And that's what they're trying to do is put all of that together. And they really don't know. And then there's a long run neutral rate, and then there's like a current neutral rate. And they really want to kind of guide to both of those. So when there's a lot of uncertainty, and this has been mentioned before by other Fed officials, they go slowly. It's, you know, you're walking around in a dark room. You don't want to trip or knock something over. So you kind of feel your way carefully. And I think that makes sense. But I think by all measures, you know, policy is still very restrictive. You just have to look at the very interest rate sensitive sectors of the economy, with just housing and also autos. And then you look at how much of economic pain the lower income and middle income households are facing. And you can see that rates are too high right now where we are. Now, does it mean that they need to, you know, go more carefully? We're certainly not going to go 50 again. Do they pause? Well, I don't know if they would pause right now, but maybe that pause comes sometime in 2025 in the early part of the year.
Well, we heard from Waller talking about what the impact the hurricane might have on jobs. Kathy, we have retail sales this week. What will the hurricane have and the impact when it comes to those numbers?
Yeah, I think for the month of September, not as much, but you could see some tailing off. You could see in some of the credit card data, there's been a little less spending, especially in the states that are affected. But overall, I don't look for a big impact in the national number. I think there'll be some, but it'll be pretty small. I think it's more the October data where we're going to see a larger impact, and that could just range, particularly in the consumer sector, but it could range also for businesses as well, spending, production, output.
Kathy, appreciate the update, as always. Kathy Porchanti there of Nationwide on the incoming data. Retail sales coming on Thursday, 8:30 Eastern Time. With us around the table, Vishal Kanduja of Morgan Stanley Investment Management. Vishal, good morning. It's good to see you.
Morning.
We've just had a big month of global easing, which you've recognised yourself. We've had a Federal Reserve cut by 50 basis points. We've had China begin to take on more of an easing posture. Is that a reason to buy bonds or sell them?
I think after the reset, absolutely buy them. I think at 250 basis points till 2025, I think it was a tough slog there, and we were backing away from it. At this point, I think we think it's fair value at this point. But I think the market is getting a little bit carried away with the stimulus, as you pointed out, as well as the one or two good data points that have come out. It doesn't change the trend for us.
Well, tell me what the trend is for you, because it's been very confusing for the rest of us. We've seen contradictory data across the board when it comes to the jobs market. You can pick out the employment components of the ISM, weak, the labour differential, not great and getting worse. Or you could look to headline payrolls in America and just say, everything's okay, unemployment's still close to 4%. What is there to worry about? What's the trend for you?
Disinflation is very intact for us. I think Kathy mentioned in the previous slot as well. I think the data points that we're getting within inflation, definitely the ones that are a little bit more volatile are showing up, which we don't think are going to persist for a long time. OER, big component of shelter, is going to drop off, as at least from the indicators that we track. So disinflation is very intact. Economy is still in that exuberant / soft landing phase. So you see the growth perk up from time and again. Labor market being one component of that. We don't think that these cuts that they've announced or they've started off with 50 basis points are anything to resuscitate an economy which is going into a recession. So these are recalibration cuts. They've used that word very, very clearly as well.
Pause. An economy that's going into recession. What signs are we seeing of any potential recession anywhere on the horizon based on everything that everyone's saying, these companies included, about how strong the consumer is?
I think narrative shifts are so severe, and we've seen that since 2022. I think we saw the 250 basis points priced in with two really tough NFP reports, where we started to question whether these are because of labor pool increasing or people coming into the job force, or this is because of layoffs. And then I think the market got very tied up with that for probably about 2.5 months. And now we are coming back into it with one very, very strong labor report that comes out. So yes, consumer is strong. Underneath, balance sheets are very strong. We invest in balance sheets. We have bondholders. One quick point also I would raise is, this is the issue that we will have if a big chunk of the economy is interest rate insensitive, which is because of the stimulus that you put in, and then you ensued a very low interest rate environment where all of us refinanced at 3% 30-year fixed, very similar to what Comcast.
You say all of us. All of us wish we had done that. Not all of us did.
Some of us did.
And some of us did, and one's around this table and very happy about it.
And some people are pretty bitter about it. But I am wondering, you actually are seeing a tick up in mortgage, at least refinancings, as a result of how much things are coming down. The world that you're talking about, with this binary risk of narrative shifts, doesn't speak to a world where credit should be holding in as much as it is. Wouldn't you think, if there was a risk, that in particular high-yield bonds should be just ticking up, showing a little bit of a sign of concern rather than absolutely cratering when it comes to the extra spread that investors demand to own over benchmark rates?
Very fair. We are trying to demand a little bit, and we are getting priced out. So we are at the lowest point of high yield in our portfolios for that one reason. I think if we slot it in the way of how we look at the world, fundamentals, technicals, valuations, fundamentals are strong. You can take a few companies out of that picture who are idiosyncratically going through issues right now. Technicals are fiercely strong, and that is less of a spread buyer, more of a yield buyer that is coming into the market. Real yields are high, and yields are best predictor of total returns analyzed for the next 3 years.
When we look at spreads and spreads exclusively, and we compare them to a different period, and we say they are just as tight as they were back then, multi-decade tights, how different is the index now versus, say, pre-GFC? How different is this one?
Much cleaner. Balance sheets are much, much stronger. Even if growth flatlines from here at 1 to 2% real GDP, I think we will be just fine. As coming back to that homeowner example, I think a lot of balance sheets can have connotations.
So can I just ask an additional question?
Please.
And I know it's difficult, and I don't expect you to have a precise answer, but typically, historically, 300 basis points, 250 on high yield is super, super tight. Do we need to rethink that? Is the new number like 200, 150? What is it?
Could be, absolutely could be, if Triple C's continue the carnage that they've been on probably over the last 2.5 months here. Idiosyncratically, if you take out distress from high yield, it's another 50 basis points already there, to your point, around that low 200s, if you will. We think that spreads are very commensurate to the fundamentals and technicals we are going through. We could be tight and frustratingly tight for a long period of time, but we are not expensive at this point. Now, second statement right after that is, sure, we are at the lowest amount of spread risk in our portfolios in a long time. Highest quality, highest interest rate duration.
Well, explain
and
why.
Steepeners. We don't think that volatility adjusted, you're getting paid for the spread risk that you're taking on. Triple B to double B is the lowest in probably about 2 decades at this point. As a spread investor, I'm always looking for more premium. I need to get paid for that volatility that I'm taking on. So for fixed income portfolios, I can still diversified, high quality, can still spit out probably 5 to 7% total return in the next 3 years annualized. So I'm taking that probability bet higher versus going down below investment grade.
When you take a step back, you said that the technicals are very strong for credit, for bonds just in general. There's a flood of cash coming in. Where is that cash coming from? How much is coming from people who are waking up to the realization that they're not going to get Social Security or some of these other benefits when they're old and need the income, and they're going to need to really be invested and get something more reliable?
Yeah, no, I think the lock-in yield effect is very compelling at this point. I think except for the very front end, the 0 to 2, 0 to 3 year part of the curve, where I think the SOFR should adjust as the Fed comes down from the lofty levels, I think every other part of fixed income curves have already adjusted to be steeper. So the roll down, the traditional way of earning money within fixed income, and sometimes the cliched way of how we put it is the dual mandate of fixed income has high probability to be met for that long-term saver, that you have income total return, and then you have the negative correlation to risky assets, which is back as inflation is coming down.
How do you hedge against the potential for some sort of geopolitical disruption and oil prices surging? I mean, there's sort of this counterintuitive connection between bonds and oil prices that we've seen over the past few months. How much are you really planning for a scenario of that type?
I think it's tough to massively shift portfolio positioning for that one. I think the one way that we are trying to adjust portfolios is that we are overweight risk, we are overweight credit risk, not as much though over the last 3 years, if you will. So we are at the lowest point of our overweight. We still have an overweight posture that if there's geopolitical tensions do flare up even further, which we had a few signs in the last 2 to 3 weeks that it could have, that we have enough potential to add below investment grade risk, which will sell off and react to these geopolitical tensions. And then the back end of the treasury curve is one more, less geopolitical, more deficit situation that we are significantly underweight.
Are you worried about the deficit?
We are nauseous about it. In terms of the biggest post-war, again, we can throw out stats all day long, but I think the way it affects is you need to grow out of it, or you need to do something, as some of the European countries are already getting onto, is be fiscally responsible and going through some tough times.
Do you actually think Washington would do something?
Very tough. I think that is one thing that they are, deficits in China is one thing, how common those two campaigns are on and how aligned they are, unfortunately, at this point.
If the deficit is one of your biggest concerns, especially surrounding the U.S. election, does it... Well, I guess what matters more for you is probably the composition of Congress. How are you thinking about that?
I think the base case, I think we are looking at the same numbers that you guys report on the terminal, et cetera, as well. Dead heat, but then, Senate and House will be split, which is actually not a bad thing for deficits. We might be looking at a Goldilocks, even treacherous Goldilocks type of scenario from
That's the least bad outcome. The least bad outcome. Split Congress because they won't make it too much worse. That's basically it, but not fix it.
Yeah.
Vishal, it's good to see you. Appreciate it. Thank you.
Thanks for having me.
Vishal Kanduja there of Morgan Stanley Investment Management. Equities right now just about unchanged on the S&P 500. Lots of bank earnings through this morning. We've had beats across the board from Goldman, from Bank of America, and from Citi. And those stocks, Bremo, doing nicely in early trading.
As you would expect them to do. A lot of people saying this was one question mark. Steve Oth saying that essentially this was one of his pillars that would make him bullish. If the banks were performing well and weren't raising any questions about the consumer, there are no questions. So for people, treacherous Goldilocks. You picked up on this. That's sort of how we feel, because it seems like every day people are saying, oh, but what about geopolitics? Oh, what about the deficit? Oh, but I'm going to buy anyway.
But what about? There's always something. Morgan Stanley, The one lone bank still to go. They report earnings tomorrow morning. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to get into some of the specifics of those big bank earnings, as you said, Bank of America, Goldman Sachs, Citi, all in the green pre-market. Bank of America faring slightly worse, just up 1.8%. They all had gains across the board. Citi's market investment banking revenue topped estimates. Both Goldman and Bank of America's Wall Street operations outperformed in the third quarter. For Goldman, it was their best quarter for equity traders since the end of 2021. All of that just pushing the bar that much higher for Morgan Stanley, which reports tomorrow pre-market. Boeing plans to raise as much as $25 billion, filing a shelf this morning, a precursor to a possible equity raise. It also announced a new $10 billion credit agreement to shore up its balance sheet with the strike still ongoing. Boeing is working to hold off potential ratings downgrades from both Moody's and the S&P, both of which have threatened to downgrade Boeing to junk status. The S&P estimates that this strike is going to cost the company more than $1 billion a month. Now, according to a press invitation from the State Council Information Office, officials from Chinese Housing Ministry, PBOC, Finance Ministry, and the National Financial Regulatory Administration will be holding a briefing at 10 a.m. Beijing time on Thursday. The focus will be on promoting the steady and healthy development of the property sector. It comes just a few days after Finance Ministry officials promised efforts to back the real estate sector over the weekend. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead and the rest of this week. Live from New York City, this is Bloomberg.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
38 minutes away from the opening bell. Equity futures totally unchanged, have been all morning. After posting another all-time high in yesterday's session on the S&P 500, the standout move cross-asset has been crude. Of 70 earlier on in the session, following a Washington Post report that maybe the Prime Minister in Israel, Benjamin Netanyahu, might spare energy assets in Iran.
Now, Stephen Cook poured a little bit of cold water on this, basically saying he thinks Israel will do what Israel wants to do. But look what happened on the weekend. The Israelis are about to get a THAAD. This is a serious piece of equipment. There's only 7 that the United States actually has, and they're giving one to Israel. This is the first time ever that this is happening. When you have that piece of equipment, maybe you're going to listen to the administration.
Brent crude 74.38, WTI 70.69. Down across the board by something like 4%. As we count you down to the opening bell, let's get to the trading diary. The rest of the week, the calendar, the schedule looks a little something like this. Do not miss this one. Lisa sitting down with San Francisco Fed President Mary Daly later on. Tomorrow, more earnings from Morgan Stanley. Thursday, we'll get an ECB rate decision plus retail sales and another round of jobless claims and more results from Netflix and TSMC on Friday, housing starts and building permits. Bramo, the floor is yours. Mary Daly coming up a little bit later.
I'm really looking forward to speaking with her because she tends to be very thoughtful based on the conversations she has as she tours her entire region, and she calls it qualitative data. It's not anecdotes. It's trying to have set qualitative understandings of how people are feeling. I want to know what the destination is. I want to understand what neutral is and what the goal is of the Federal Reserve, which does have a dual mandate of both inflation and employment. Longer term, what is the healthiest balance for an economy? And to really get into that, because right now, that seems to be an area that this market is struggling with, given how much bonds have been fluctuating all over the place.
Apart from trying to find out if they were bullied into voting for 50 basis point rate reductions at the last FOMC meeting by the chairman, I'm sure that might not come up. Let's park that. I want to talk about financial conditions. If you speak to the CEOs of asset managers from the CEOs of banks, they seem to have a very different opinion on the level of interest rates that's required right now because financial conditions are so easy. We just had a conversation about how tight credit spreads are. We've talked repeatedly about equity markets at all-time highs. How do they think about that piece of the puzzle?
Especially because financial conditions for big companies, the most creditworthy borrowers, are very different than the financial conditions for particularly lower income and middle class individuals and families. That has been restrictive, and you have seen that start to soften. But how do you dovetail those two when you want to both cater to a certain cohort that's definitely struggling while also not creating frothy conditions in a market that is much more immune to rate increases and decreases? And that's a real struggle that I'd love to hear her thoughts on.
We are 3 weeks from the election. Do you think she's going to dive into you with what 2025 might mean if the Fed is actually starting to think about it? Is she an the deficit person, or does she care?
I would guess that probably she has her eye on it, but most of them are trying to steer away from that, looking at what the parameters are of current conditions and extrapolating that out.
I imagine you're planning to read an Adam Posen quote to her about 2025 and the prospective rates and interest rates.
Is this possible? Yeah, and she probably will say, anything is possible. We deal with the conditions as we see them. I'm just telegraphing what I expect to be.
Look out for that conversation with Lisa and Mary Daly, the San Francisco President, a little bit later. San Francisco Fed President, get my words out. Coming up tomorrow, Julian Emanuel of Evercore ISI, Keith Lerner of Truist, Charles Myers of Signum Global Advisors, and we'll catch up with Howard Lutnick of Cantor Fitzgerald. Looking ahead to all of that, as we count you down to the opening bell, equity futures on the S&P, just about positive from New York. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And You know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
All right, futures are now a little bit higher, bouncing back and forth between gains and losses. We have 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment, and Bloomberg Open Interest starts right now.
Coming up, capping chips. The U.S. May limit the amount of sales or continue to limit the amount of sales of AI chips to other countries. We'll analyze that and what it means for American companies. Meanwhile, looking under the hood of big banks, B of A has a beat. Goldman's profit jumps 45%. It's a big beat. We'll bring you all the headlines everybody's beating on trading. Plus, bolstering Boeing, the struggling plane maker, files to raise as much as $25 billion in a bid to boost its liquidity. Is anyone buying, though, is the question that we'll ask. First off, let's take a look at where markets are trading after the 46th record high on the S&P 500. Right now, futures are up just a bit. They have been down earlier in the session, so you could see some fluctuation there as we head towards the open. NASDAQ futures are equally unchanged right now, and the bond market is back after celebrating Columbus Day yesterday. We have yields down 5 basis points, but still on the 10-year more than 4%. Katie?
All right, let's take a look at some individual names. We're talking about bank earnings names because they came in strong this morning. You have Goldman, Bank of America, Citigroup, all higher in pre-market traders. Of course, traders stepping up in a big way at the big three. Meanwhile, Schwab surging after an earnings beat. The bank said it cut down some of its expensive debt, also beating on earnings. Shares currently up about 8%. And Boeing. Matt, you know I really want to talk about Boeing. And the story just gets more interesting because, as you said, planning to raise up to $25 billion to shore up its balance sheet and get through the current production strike, as well as maybe fend off potential ratings downgrades from Moody's and S&P Global. The stock has been bouncing around all morning, at least for right now, Matt, currently up about 0.8%.
All right, and I mean, we are going to get to Boeing. Don't worry, Katie. We'll talk about this iconic American company in free fall, I promise. But first off, take a look at this. There has been, as we've been talking about, a broadening out in terms of earnings support. The blue lines here are Magnificent Seven year-over-year net income growth. The white line is I guess, the S&P 500 at large, its year-over-year net income growth. And you can see that for a while, the Mag 7 had been leading. The middle of the chart is really 2024. So starting in the June quarter, it turns around, and hopefully this broadening out will continue. The rest are estimates. But we are kicking off earnings season.
We certainly are. And it's nice to see, of course, that those white bars are getting bigger. I think that's good news. I do want to bring your attention to Bank of America had a fund survey out, a fund manager survey. In October, it showed the biggest jump in investor optimism since June 2020 on Federal Reserve cuts, what's going on in China, soft landing, et cetera. I thought that was interesting because they're talking about positioning here. You think about what Cole Smead told us yesterday, that positioning is looking a little bit exuberant. You added together with what we learned from Bank of America, and you could sketch a bear case right now, Matt, if you wanted to.
Yeah, all right, I was listening to a bear on radio this morning. I want to talk a little bit about what
was his name?
He said. Mike Wilson was talking to us this morning about the rally being driven in his reading of it sheerly by multiple expansion. I want to bring in JP Morgan Asset Management Global Market Strategist Stephanie Aliaga. And Stephanie, I want to ask you about this. You know, Wilson, of course, he's a known bear, but he was saying this is all about multiple expansion. We're not seeing an increase in earnings that's driving prices up. But you point out something that this chart just showed us as well. We've seen a broadening out in earnings.
We have, and we think that that broadening out in earnings is also just getting going. You know, this year, or this quarter really, we do expect that the Mag 7 will continue to dominate just overall S&P earnings growth. But underneath the hood, there's some really significant bifurcation happening. You have other areas of growth. You have, you know, healthcare, communication services also showing really solid 10+% earnings growth expected this quarter. And then looking beyond, we're really expecting to see that broadening out take greater hold. And that's just because when you look at the overall market landscape right now, you have some really significant tailwinds underway. You have interest rates coming down. That's going to help many other areas of the markets that have really underperformed recently, particularly financials. You also have a resilient consumer, a resilient economy, the potential for perhaps manufacturing activity to also pick up going forward. And then you also have the AI theme, which has been the wind behind the sails of these Mag 7 companies. That story is also now showing a much broader set of beneficiaries that are on the receiving end of all of this CapEx, areas like utilities, industrials, and that is also very nascent. So we think, looking at those drivers, we have more conviction that this broadening out in earnings growth really has more room to run, and that is providing a more durable support for the markets right now.
When do we expect to see a return on investment in the AI space? Because so many billions of dollars, tens of billions being thrown at it, and the question has been asked for the past couple of quarters, when are we going to make money on this?
It's an important question, and I think it also hits at one of the biggest uncertainties around the AI theme right now, is that we're talking about a secular technology. AI adoption is going to take time. It should take time. And it could take some time for the ROI on some of these investments to really take hold. But what gives us more conviction that this is not an overextension in terms of investment is if you look at the hyperscaler spend as a share of their operating cash flow, it actually hasn't grown that much, and it isn't expected to grow over the next 2 years. While CapEx is growing, these companies are just so profitable, they have so much cash on hand already, that they're able to use more of that cash to invest in R&D and CapEx. And while, you know, those companies have reached record high concentration in the S&P 500, what's also really significant is that the top 10 companies account alone for 40% of S&P R&D. And that is really backed by really solid cash balances amongst these names.
Should that make me nervous, or is that a reason to spend money on those names? I mean, the narrative is out there that you want to buy the companies that other companies are spending money on rather than, you know, focusing on these consumer stocks. But how are you threading that needle?
I think it is such an important distinction when looking at the quality makeup of the top tech companies leading the way right now versus the last time we were in the midst of a transformative technology. Let's think about, you know, the dot-com era. There you had this ragtag group of startup companies, didn't have any really real business plans for profitability. And now what you have are these large tech incumbents. They've been spending a lot, but that spend, I think, gives us greater conviction that they can maintain that pricing power, those barriers to entry, those competitive moats for longer, because they have that ability to really be more experimental and be broader with where they're investing that.
Yeah, it's a great point, of course, with all these comparisons that we get to the tech bubble. This time around, we're talking about very mature, very profitable companies, so an important distinction there. Let's talk about that broadening a little bit more, though, because we were speaking to Jess Menton yesterday, and one of the notes she had for us that for the rest of the S&P 500, beyond the Magnificent Seven, that profits are expected to climb 1.8% in the third quarter. I'm used to the Amazons of the world. 1.8% doesn't sound that impressive to me, but...
It's true, and underneath the hood, there's as I mentioned, a lot of bifurcation. But I think in many of the sectors this quarter that are expected to see year-over-year declines in earnings, or even roughly flat, it looks like that is set to inflect higher really in the fourth quarter because of some of those tailwinds, because of lower interest rates, and really a more improved demand backdrop going forward. So we're a bit more constructive, and I think this quarter we'll just kind of have to see, how some of those sectors really fare.
Hey, it's Tuesday.
It is.
Only 3 weeks until the election.
Yes.
And your birthday.
And my birthday on the same day, November 5th. In terms of the election, I mean, I've heard a lot of people saying recently it's still fiscal, right? We still have a huge drive there. And that's obviously not going to change regardless of who wins. Both candidates want to spend a ton of money that we don't have. But do you make any other portfolio decisions, investment decisions based on your expectations for the outcome?
Right now, we think it is really far too soon for investors to make any decisions or pivots in portfolios around the elections or any kind of election outcome, because we just don't know. I mean, you look at the polling data, this race is neck and neck, and it's not only a question of who the next president is going to be, but what the makeup of Congress is going to look like, when that president is in office, what their priorities really end up being, because oftentimes that can be different than what they're talking about on the campaign trails, who they staff their cabinet with. Once we have more clarity around all of those, I think we can have a better sense around the direction of policy going forward. But to your point, there are still some of these more secular trends that are related to politics that are likely going to prevail regardless of the outcome. Things like deficit expansion, things like geopolitical tensions, or just the restructuring and reshoring of manufacturing activity. These are secular trends that are likely going to remain intact. It's just a question around, on the margin, how things really change over the next few years, given who this next president might be.
Well, it's a good reminder, too, that there's a lot of overlap when you take a look at the Venn diagram. Stephanie, great to see you. Really appreciate you taking the time. That is JP Morgan Asset Management Global Market Strategist Stephanie Aliaga. Meanwhile, let's take a check on futures right now. About 20 minutes until the bells ring, and boy, is it boring. You have the S&P 500 pretty much flat on the day. An optimist would say that's 0.1% higher. We know we got our 46th record close yesterday. Same thing, too, if you take a look at the NASDAQ 100, just a little bit higher after such a big day yesterday. Taking a little bit of a breather. The Russell 2000, though, decidedly lower, currently down about 0.3%. Let's take a look under the hood now. We'll do that with Abigail Doolittle.
Lots of earnings movers to take a look at, starting off with the shares of United Healthcare, the healthcare giant. These shares are down sharply, the better part of 10%. This after they beat on the estimates for the quarter that was, but they trimmed the top side of the full year outlook. Investors, analysts not very positive about this. Apparently medical costs really higher. Walgreens, on the other hand, up 4.2%, and they raised their 2025 sales view. They also gave more color around store closures, saying that they're going to close about 14% of the store base. That is clearly being cheered for this company. Turning to some stocks that are trading in the opposite direction of what they had been trading within the chips complex. NVIDIA, very close to its all-time high, but today paring back a little bit, just off of those highs. And then Wolfspeed soaring up 30%. They are expecting up to $2.5 billion in additional capital between the CHIPS Act, new financing, and a cash tax refund. And then finally, DJT, the Trump trade, well, it's back. The shares of DJT right now in the pre-market up about 9%, up for a fourth day in a row. If these gains hold on the open, and it's really pretty incredible, Matt, from the recent lows, this stock up about 150%. One way of the market saying, and the betting odds also, the predicted betting odds leaning this way too, that the former president, Donald Trump, that the markets are favoring the odds of his reelection over VP Harris.
Hey, did you know, Abigail, we're going to actually have an interview? Wait, am I camera? I'm camera 5. We just do it today.
You are.
Did you realize that we're going to have the former president of the United States on our air this afternoon?
Did at noon.
Yeah, really looking forward to that. Donald Trump is going to come on.
Former president, current candidate.
Yeah, and talk with John Micklethwaite at noon. That's an interview that you don't want to miss. We are also going to dive into Schwab. Those shares up like 10% in the pre-market. Citi, best third quarter for its traders in over a decade. We're going to talk with about Goldman Sachs earnings. They had a blowout quarter for trading and investment banking fees. All of these big bank earnings. Up next with analyst Gerard Cassidy. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's get now to high interest to look at what's making headlines around the world. Israel says it's weighing U.S. concerns over its retaliation against Iran, while at the same time asserting Israel has a right to act freely. Israeli Prime Minister Benjamin Netanyahu is reportedly agreeing to limit retaliation to military targets and avoid nuclear and energy infrastructure in Iran. Meanwhile, crude prices have been tumbling further in trading today. Right now, Brent crude down 4%, as is NYMEX. Bloomberg has learned that humans were remotely controlling some of Tesla's Optimus robot prototypes at its recent showcase. Elon Musk told the crowd that the humanoid androids would be the biggest product ever, but he didn't disclose the human helpers. The event was intended to generate investor buzz for upcoming products. And Donald Trump's latest town hall in Pennsylvania was derailed after multiple audience members fainted last night thanks to the sweltering heat inside the venue. The Republican presidential nominee had taken the stage 40 minutes before the medical emergencies. Trump pivoted from the usual Q&A format to transform the evening into an impromptu dance party. Trump will, by the way, sit down with Bloomberg's editor-in-chief, John Micklethwaite, for an exclusive interview exactly 3 weeks from Election Day. That's today. The conversation at 12 noon Eastern. Katie?
All right, looking forward to that one. But let's check back in on the bank stocks because they're rising across the board right now, reporting earnings for some of the big ones. And you're really seeing those trading desks capitalize on market volatility in the third quarter. Let's break it all down with RBC Capital Markets head of U.S. Bank Equity Strategy, Gerard Cassidy, who joins us now. And Gerard, just taking a look at some of the headlines on the terminal this morning. Goldman stock traders head to record. Bank of America bankers and traders help earnings top estimates. And then finally, Citi notches gains across the board as trading outdoes expectations. It seems like trading and the big beats we're seeing there are definitely a theme this morning.
You're absolutely right, Katie. The investment banking and markets results were better than expected. You touched on it with the volatility. You might remember back in early August when there was some difficult economic data that came out, markets swooned for a very short period of time. That gave opportunities, obviously, for the trading firms to potentially benefit from that. In trading in markets in particular, volatility is a positive. And if you have some volatility, they normally can capture that with higher revenues, as you pointed out.
What about investment banking, Gerard? I mean, it seems like everybody's beating on those fees as well. Does that mean M&A is back? Does that mean these bankers are charging more money? What do you see in the investment banking landscape?
Matt, what we're seeing is that debt capital markets in particular were strong. We saw some of the banks indicate that after the Fed cut rates, yields fell in the capital markets area for the DCM market, and issuers captured and rushed out and issued debt. But to your point, the M&A advisory fees are also picking up, and I think there's evidence now that if the U.S. economy continues its growth, some folks were calling for a recession in 2024 or a year ago. That's obviously not happening. And so as industrials and corporates gain confidence that there's not going to be a recession, M&A activity could pick up even further, especially if the Fed continues to lower rates. It makes the financing of those M&A activities more attractive to the buyers.
Let's talk about net interest income as well, because we heard from Bank of America's CFO calling the quarter, quote, an inflection point on NII with it growing in the right direction. And maybe that's, of course, specific to Bank of America. But what is the overall narrative on net interest income? Because I thought heading into the quarter that we were expected to be underwhelmed there, but it seems like that hasn't been the case necessarily.
No, you're right, Katie. A couple of banks, in particular JP Morgan, benefited quite nicely due to rising short-term interest rates, and they've pointed out that their net interest income is going to be challenged in a falling interest rate environment. But most other banks, including Bank of America, are actually well-positioned to benefit from lower rates as we go forward into the end of 2025, as their deposits reprice faster downward than their asset yields. Now, that also is going to be driven by the fact that you're going to see maybe a pickup in loan growth next year. The banks have had modest loan growth in commercial loans in 2024. And we think that if the economy grows 2 to 2.5% next year, we get the final regulatory rules known as Basel III Endgame, where banks know where their capital levels need to be, and demand picks up for loans, we could see stronger net interest income in 2025 due to loan growth.
Hey, I wonder about the outlook for consumers, Gerard. I was looking at a chart just now showing credit card delinquencies just continuing to rise. Do you see that coming through in the bank's reports, and what are they saying about, the outlook in terms of the U.S. consumer?
What we're hearing from the banks on the U.S. consumer is that they're healthy. The net charge-offs, which are different than delinquencies, of course, for all the big credit card issuers this quarter, JP Morgan, Wells, Citi, Bank of America, they all declined sequentially, the actual credit losses. And so I think what you're seeing is that there was that surge in delinquencies about a year ago that filtered through to the charge-offs. Now we're seeing some stability in delinquencies. So we think that the charge-offs or the credit picture for the consumer is actually is resilient. I know there was some concern about Ally earlier in September about higher losses in auto lending. We're not seeing that with the commercial banks.
All right, Gerard, great to get your perspective. Of course, that is RBC's Gerard Cassidy. Thank you so much, of course, walking through today's bank earnings, bank stocks rising across the board. And we're not done yet, because tomorrow, tune in for our interview with Morgan Stanley CEO Ted Pick. That's live here on Open Interest at 10:30 a.m. New York time. Now coming up, less red lipstick, more red flags in the beauty biz. Details in our Social Climber segment up next. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves on social media this morning. And first up, CoverGirl parent Coty is warning of a beauty sales slowdown. The company is trimming its sales growth forecast and saying that retailers are tightening their inventories because of weaker sales and demand trends. Next up, some good news. Charles Schwab reporting earnings that topped estimates, saying that it cut some of its expensive debt. Of course, the Fed's rate hikes were tough on Schwab's business as customers look for those higher yielding options. But executives say that the worst of those woes are behind them. It seems like traders agree. Shares currently up about 7% pre-market. And finally, Walgreens is planning to close 14% of its U.S. stores over the next 3 years as consumers increasingly turn to online retailers such as Amazon and discount giants including Dollar General and Costco. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, let's get a check on futures right now. Of course, a little bit of movement, and I stress little because you take a look at the S&P 500, currently up about 0.1%. Of course, we closed at a record yesterday, and if these levels hold, of course, we'll close there again today, but there's a long way until 4 p.m. You take a look at big tech, too, also getting in on the action. The Russell 2000, your small caps, I can't say the same. Currently a little bit lower pre-market, down about 0.2%. Less than 4 minutes until the opening bell. We'll talk through the market action with Janice Henderson's Adam Heads. That's next. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, we are moments away from the start of trading on this Tuesday morning. This is Bloomberg Open Interest. I'm Matt Miller. If you take a look at futures, you'd be tempted to say, wow, this is so boring. I can just turn this off. I don't need to watch any market coverage today. But I would warn against that because the banks have come out with earnings and they have knocked the cover off the trading revenue ball. I mean, it's truly remarkable. We're going to talk with Adam Hetz about that in just a moment. There you hear the closing bells from TGS down at the New York Stock Exchange at the NASDAQ market site, MongoDB, which, 10 years later, I'm still a little bit concerned about whoever chose the name. MongoDB? Seriously? That's a publicly traded company. In any case, in terms of the markets right now, we are probably looking at another record, even if we only inch higher. That's because yesterday we had the 46th record close this year on the S&P 500, and we only need to see a slight green arrow to beat that. Katie, what do we see?
Well, don't take all of my talking points because that's exactly what I was going to say, that it's remarkable in that this is all you need for the S&P 500 to hit that other record, that 47th record. The NASDAQ 100, the arrow is now red, of course. We're talking about very, very small moves here, but think about how far we've come. We're in a little bit of a vacuum now. I know that we're getting the big banks, not necessarily making a dent on the broader levels, but of course, we are ahead of a monster week or two of earnings. Meanwhile, the small caps a little bit lower right now, currently about 0.1%. Let's get under the hood, though, because that's where the real action is. And we start with Boeing, out with plans to raise as much as $25 billion as the plane maker seeks to shore up its balance sheet and withstand a strike that's hurting production. You can see that shares, they've been bouncing around, currently about 0.8% higher. And of course, we are keeping an eye on those bank earnings, and there's a lot of green on this screen. It's cut off a little bit, but maybe if we zoom out, you can see it. But it matches the color of the shirt. In any case, Goldman Sachs revenue, it surged above estimates thanks to its trading desk, capitalizing on volatile markets. Citi traders, similar story, turning in their best third-quarter performance in at least a decade. Schwab, meanwhile, also beat estimates in a big way. That's why shares are up nearly 9%. Citi breaking the trend here, currently unchanged. It had been higher pre-market, Matt, now a little bit lower.
All right, and let's switch sectors for a moment because Johnson & Johnson reported stronger than expected earnings, but it lowered its full-year guidance to account for its V-Wave acquisition. United Health, the insurance giant, lowered the top end of its 2024 forecast and issued 2025 guidance that missed estimates. And as a result, both of these stocks are lower. Let's take a closer look at the healthcare sector with Bloomberg's Abigail Doolittle. Abby?
And that's a pretty sizable decline for the shares of United Healthcare, down nearly 9% ahead of of the open today. Over the last year, this stock up more than 12%. Now you can see it's up just 2.6%, and this really puts this decline in perspective. Investors very disappointed after the stock basically at a record high. Now, some of it had to do with rising medical costs, but in addition, in terms of the premiums retained, this came in a little bit less than expected at 85% versus the expectation. And if we put it into the context of all of the different insurers that have not reported yet, we can see that they're at 85.2%, Cigna, the estimated at 83%, and then some of these other companies higher. So investors are a little bit disappointed there. And then finally, they of course suffered a bit of a cyber attack, so that's hitting their numbers as well to the tune of $2 billion, more than $2 billion. What that could mean for the bottom line, it could be a hit of $2.40 for United Healthcare. So right around the loop, we have investors disappointed there. Those shares of United Health, again, down, Katie, by about 9%.
Yeah, it's pretty amazing. That would be its worst drop since June 2023. At one point already this morning, it was down by more than 10%, looking at its worst drop since March 2020. Really rocky start to the morning, really rocky reception for United Health. We'll continue to follow those shares. But let's broaden out this conversation now and bring in Adam Heads. He is Janice Henderson, Global Head of Multi-Asset, and he joins us now on set. It's great to see you.
Great to see you too, Katie.
So I listened to a podcast over the weekend. It was with Kathy Jones of Schwab, and she said that the Fed basically is in risk management mode right now. And I think you could apply the same logic to the market, that basically, it's October 15th. We have a lot of uncertainty, but it's been a really great start to the year. How do you feel?
I think the Fed was in risk management mode, and we had the 50 bips cut in September, that supersized cut. Then that was backed up by the jobs print that we had a couple of weeks ago, early October. So the Fed went from risk management mode to some reassurance on the jobs numbers. And now the market seems to be in risk on mode. So we're feeling like those cuts and the jobs print did usher in this soft landing environment once and for all we've all been waiting for. And now even no landing's coming into the conversation, which we think is great. We welcome those words coming back in as opposed to hard landing.
Yeah.
But we take that with a little dose of caution because it is still a late cycle environment. We'd much rather maybe hope for no landing and sort of plan and position our portfolios more for a soft landing kind of environment.
But we see, I mean, these markets have run up so far, so fast, right? On the S&P, we're up 23% year to date, up 36% from a year ago. Yesterday, we were talking with Cole Smead, who pointed out that U.S. households hold more stocks relative to other financial assets than they have ever since the St. Louis Fed began keeping records of that sort of thing in 1952. So I think of that because you're multi-asset, right? So are we holding too much in terms of stocks?
I don't know that we're holding too much. It's working so far, but that's one of the risks I think the market's a bit complacent about as we keep notching these all-time highs. So that wealth effect, that historic level of household assets in equities markets, all those exposures have been working. That's strengthening the consumer. It's encouraging more spending, but that will cut both ways because if, or more likely when, we do go from no landing or soft landing, wherever we are right now, to the inevitable hard landing, you're going to see that market drop in that bear market. And the more that households own, the more that's encouraged with spending so far, the more that can swing the other way and really turn sentiment down when those high net worth assets start coming way back down in that 20% plus correction.
Well, let's bring cash into this conversation. Yeah. Of course, we heard from Jamie Dimon last week, and I think it was on his earnings call that he was saying that cash is still a very valuable asset class, and certainly we've seen it's been very difficult for people to actually break up with their money market funds. From your perch, I mean, how are you thinking about cash and the role it plays in portfolios right now?
From the multi-asset perspective, on the one hand, cash is easier to hold than it's been in a long time. For a little while, cash was just a necessary evil purely for safety reasons when rates were at zero. And now you've got cash at really competitive rates. But a year and a half ago, when hard landing was part of every conversation and cash looked really attractive at 5%, people missed out 20% of returns in just that year, not to mention the returns we've had, again, this year over 20%. So that goes back to the point that even if you're seeing 4 or 5% cash rates in a long-term portfolio, I think don't be fooled by that margin of safety in cash. Cash can still be toxic to a long-term asset allocation. There are a lot of other attractive opportunities right now, even with that late cycle backdrop.
What are the most attractive? I mean, given the risks in equities, right? We're hovering at all-time highs. We have to expect a correction sometime soon. Given the risks to holding cash longer term, what do you think the best opportunities are?
Well, the top line multiples in the S&P at 22 times, that's some of the risk. That's 20% higher than long-term average multiples. And you couple that with double-digit earnings projections going forward, this gets into that Goldilocks price for perfection kind of environment. But where we think that this market still has legs is if it's not the Magnificent Seven concentrated passive indices, it's that broadening trade who's had these rate cuts, 50 bips. Maybe don't expect 50 bips going forward, but that drip of 25 bips, 25 bips, rest of this year through next year, that's going to help the more rate-sensitive small mid-cap companies inside.
We're going to keep
the
seeing
US.
that if we get blowout jobs numbers, you know, and 3% growth. Why?
Because we're still in a restrictive environment. So that strength is great. That goes that no landing type argument. Again, our base case is still soft landing. But if you have strong jobs and strong economy, we're clipping along at what, 3% still GDP for fourth quarter. So that's great. That doesn't mean the Fed needs to stay in restrictive mode when CPI is also coming down and inflation is not such a concern. You can get out of restrictive mode back to normal rates and get back to a neutral rate and that kind of outcome.
They're normalizing. They're not easing. That's
right. It just doesn't feel super restrictive to me. Like, where do you look to say, oh man, that's so restrictive?
You look at
the Fed's holding this economy back.
You look at the housing market. You look at car loans, for example.
But that's just because of high prices, right?
Yeah, but no, it's also because of high rates. But in any case, Adam, we've talked about the economy. We've talked about the Fed. Let's talk a little bit more about earnings specifically, because the big banks kicking us off. We got into some of the more interesting consumer-facing names next week, some of the tech firms, and there seems to be this divide between analysts and CEOs. A great story on the terminal is showing that analysts expect S&P 500 firms to report a 4.2% increase in third quarter earnings, but you take a look at guidance by the companies themselves, it implies a jump of about 16%. There's a lot of daylight between those two numbers. Where do you fall?
I think there's a good dose of skepticism in there. It'd be good to be critical. It's still this late cycle backdrop. I think look at financials, what we're seeing this week, and you're seeing what the market did yesterday. We'll see what the market did today. As you said, maybe boring start to the day, but not a boring show by any means. So we'll see what happens today. Yesterday, you saw a big jump in the markets. That relief of the earnings coming through on financials, a cyclical sector, some good news on NII, some good read through on the consumer. So I think you're seeing a good backdrop on earnings, but back to the other point, it has to be a good backdrop. The market's really demanding that to keep these all-time highs.
We are going to interview Donald Trump on this network in just about 2 hours. What would you like to hear from the president? Or what would you like to hear from Kamala? What do you want to hear from the person who's going to be in the White House next year?
The floor is yours.
Oh, thank you. I didn't expect that today. What a luxury. But I think what we want to hear is more certainty around policy from either side. And as we get more certainty in the next few weeks tick by up until the election, up until Matt's birthday, I think there's a lot of reason to celebrate as that uncertainty kind of resides. But in our view, really, elections matter, of course, just a few weeks ahead, and a lot of policy will be very important for the market outlook the next 12 months and beyond. But rates matter more than elections, and the economy matters more than rates. And it's on the latter two where we're getting a lot more certainty already. So I think that puts us in a pretty good situation.
Very cool.
Yeah.
This is better than Lululemon, right?
Yeah, I know.
This is better than Dave & Buster's.
I don't know if I go that far, but it's close.
Yeah, this was pretty good.
Adam, thanks so much for joining us. Pleasure having you in the studio. Adam Hetz there from Janus Henderson. Coming up, chip stocks like NVIDIA and AMD are under pressure as the Biden administration weighs capping sales to some countries. Details next. And as we go to break, a look at some of the big movers of the day, including Walgreens, United Health, and Goldman Sachs. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's time now for top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI is upgrading Bausch & Lomb to a buy. The firm cites potential for the eye company's sale following a report that TPG and Blackstone have teamed up to work on a joint bid for the firm. Next up, Goldman Sachs giving Etsy a DI don't. The analyst there downgrading the online retailer to a sell, saying that he prefers firms less exposed to discretionary spending. You can see shares pretty resilient, all things considered. Finally, we have Apple getting a tactical outperform call at Evercore. The analysts say that bearish sentiment on the iPhone maker is overdone and expects government stimulus to boost smartphone demand in China. Apple, of course, reports earnings on October 31st, Matt. Very spooky.
Wow, fiscal help out of China for Apple. Let's turn now to the latest AI news. This does not involve Apple. Bloomberg sources say Biden administration officials have discussed capping sales of advanced AI chips from NVIDIA and other American companies on a country-specific basis. Let's discuss the implications with Bloomberg Intelligence senior analyst Mandeep Singh. First of all, don't we already do that? I mean, we don't allow NVIDIA, at least technically, to sell its biggest or most advanced AI chips to China.
Yeah, even though there are restrictions in place to not ship the most advanced chips, China is still over 10 billion in sales for a company like NVIDIA because they still ship a lot of their lower versions of the chip. They are complying with all the restrictions, but look, with all these companies, China is still the dominant market when you look outside the hyperscalers in the US. There, the companies are still spending their money on training the LLMs. They're spending a lot of CapEx dollars. And for a company like NVIDIA, once you go outside the hyperscalers, they have to look at sovereigns. So this is where the restrictions come into play, because sovereigns is a low double-digit market for NVIDIA now. And you have to ask yourself, who are the sovereign buyers? Is it Singapore? Is it Middle East? Beyond China? And I think that's where the government is targeting, because there is a diversion aspect to some of the chips, advanced chips, indirectly reaching China, even though they're... I mean, look, it's so hard to control, because if you build a cluster in Singapore, how do you make sure that that cluster is used just by companies within the Singapore region? You could be domiciled in China and still using a data center in Singapore for training your LLM.
Right, although, I mean, the New York Times had a great piece a couple of weeks ago about the fact that there are Chinese companies and military operations in China that are still getting those chips, and NVIDIA really isn't putting up much of a fight.
Well, again, that's where, all the sovereign buyers and they've quantified how big the sovereign kind of buyers are in terms of sales for NVIDIA chips. You have to ask yourself, what are the companies outside of US and China, the hyperscalers, who are training their own LLMs, knowing that LLMs require north of 300, 400 million for one training run, and you have to keep upgrading these chips. So the largest internet companies are domiciled in these two regions, and they're the ones who are training their own LLMs at this point of time.
Well, Mandeep, I'm curious to hear your perspective on the balance of risks here, because, you think about the U.S. position, they're worried about national security. I get that. But at the same time, if you sort of cap NVIDIA here, don't they want NVIDIA to be dominant, to be leading the industry, or are they concerned at all that someone else could come in to fill that void?
Well, so NVIDIA clearly has a lead when it comes to the chip making side, but I think China is building their own chips. We have heard about Huawei's effort to make their own server chips as well. And look, when it comes to LLMs, that's where the race is. Who has the best large language model, whether it's a company based in US or is it domiciled in China? Because that's what everyone is striving for. The latest and greatest when it comes to the large language models and what it can do in terms of intelligence and reasoning. And that's the end goal. Chips is the way you get there, because that's how you're training the LLM. But the end goal is who has the best large language model for all the applications that are getting deployed.
And of course, we're talking about NVIDIA, but just quickly here, I mean, AMD is also part of this report. And of course, AMD is down more mightily currently in the market than NVIDIA is, down about 3%. What does this mean for an AMD versus an NVIDIA, which is so dominant?
Yeah, look, there is more demand than supply for NVIDIA chips. We know that, and that's why, they keep beating and raising their numbers. So even if China is not the incremental buyer, there's some other incremental buyer for NVIDIA. But for AMD, which is a distant second, China would have been a big buyer had it not been for the restrictions, because the incremental buyers are not, the list is not that big as it is for NVIDIA. So clearly, I think China market being blocked or more restrictions does affect AMD in a big way, because they are looking to ramp up that business that NVIDIA already is doing $100 billion in data center revenue.
Yeah, and it's amazing. AMD shares, as we just showed, only up about 8.5% year to date, trailing the broader market in a big way. Mandeep Singh, always great to see you. That, of course, is Mandeep Singh of Bloomberg Intelligence. Now, coming up, it's the segment we've all been waiting for. We're going to talk about Boeing's bid to boost its balance sheet as it faces a second month of strikes. More on that next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a look at the stock market about 22 minutes into the trading day. Green on the screen, just slightly, but green nonetheless. The S&P 500, the NASDAQ 100, currently higher by about 0.1%. The Russell 2000 also mildly getting in on the action, of course, shaking off its pre-market losses, currently higher by about also 0.1% when it comes to the small caps. Let's talk about Boeing, though. Go on.
Did you see Jonathan Gollub's new price target for the S&P 500?
He raised it, I heard.
To 6,400.
That is over the next 12 months?
It had been, I was just thinking about this because yesterday you were talking with somebody and you said, hey, your price target is 50.
I did say, that was Larry Adam.
Exactly, and now we're at 58.53. So Gollub's target was, I think, 58.50 as well, exactly, and he's now raised it to 6,400.
You know, I said at the start that you could sketch a bear case. I guess Jonathan Golub heard that and said, no.
No bear case.
Let's talk about Boeing, though, because you could sketch a bear case about Boeing. It's planning to raise as much as $25 billion. This is the troubled plane maker. It looks to shore up financing as it tries to withstand a prolonged strike. Joining us now, I am thrilled to say we have Bloomberg's Boston bureau chief, Brooke Sutherland. She's the author of the Industrial Strength newsletter. So we knew something like this was coming. Of course, you had plenty in the analyst community saying that they need to do some sort of equity raise here. Talk us through this $25 billion shelf, though, and what we know so far.
Sure. So a shelf filing is really sort of a precursor to raising any kind of equity, and it can be a mix, actually, of stocks or bonds. Although in Boeing's case, they're more likely to issue, lean heavily on stock issuance just because their debt is sort of teetering at that precipice of junk, and they're very much trying to avoid that. You had both S&P and Moody's now warning that they are reviewing Boeing's credit for a potential downgrade in junk. That would make the company the biggest so-called fallen angel ever, really. And it would obviously increase Boeing's cost at a time that they can ill afford more expenses. So this was not unexpected, and this is really sort of a lifeline for them and something that they need to consider, not just to get through this current cash crunch that they're facing while they deal with a labor strike and slower production of the 737 MAX before that because of the issue that happened back in January with that blown out door and extra scrutiny from the FAA. But then also looking forward, Boeing needs to also think about the future. They need to think about a clean sheet replacement for that 737 aircraft eventually if they want to continue to compete with Airbus. And so for Boeing to think about that future, to have that future, they really do need to be thinking about some sort of financial lifeline here.
But of course they can't fail, right, Brooke? Because airlines want to have more than one plane maker, and the U.S. also wants to have its own. Plus, there's only one other, really.
Absolutely. And I mean, the reason why we're sort of in this position to some extent is because there was so much consolidation in the aerospace manufacturing industry in the U.S. And you are right. Boeing is really the only viable maker of large aircraft in the U.S. It is a national champion. It is a major defense contractor. So it is not an option for this company to fail. And the U.S. government cannot let that happen. So there is that backstop there, but that, there are shades of in between there, between a company falling into junk status and getting to the point where we're talking about too big to fail.
All right, Brooke, thanks very much. Brooke Sutherland there talking about the Boeing story that we will continue to cover. Possibly from here to eternity.
Yeah,
right?
I mean, it is amazing. I think it's a great point that there's really only two. You really only have Boeing and Airbus, and this is an industry where it just seems impossible to disrupt. I know that, there's been some mutterings about maybe Embraer will try to step into that space, but it's really hard, Matt.
I mean, the other interesting thing is they've filed a shelf for $25 billion. They don't have to raise that much, right? So you could still see a $15 billion.
But wouldn't it be cool if they did all $25 billion?
It would. Coming up in the next hour, we're going to give you more on equity valuations and earnings expectations with Cameron Dawson of New Edge Wealth.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Click on that live button, and that's where we'll be. A lot of more bank earnings coming out today. We had Citi, Wells Fargo, Goldman. We're going to break it all down with Allison Williams, Bloomberg Intelligence Senior Banks Analyst. She'll be here to join us. Dan Pickering, Chief Investment Officer, Pickering Energy, get his thoughts on oil. Again, I mentioned WTI crude oil off 4.5% today, down to just over $70 a barrel. So some big movements we've seen in global oil over the last several weeks. George Ferguson, Bloomberg Intelligence Senior Aerospace and Defense Analyst, talked to us about Boeing. Boeing, a $25 billion shelf offering. Looks like they're going to look at the bond market and the equity market to shore up their balance sheet as they continue to deal with that strike. So we got a lot coming up in this hour. Let's kick it all off with Mr. John Tucker.
All right, thanks, Paul and Alex. This report being brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on the 2024 elections. Just answer yes or no. Visit ibkr.com/forecast. Get started today. 9 of the 11 major industry groups in the S&P 500 higher right now. Among the best performers, the financials. Power through these. Allison's going to take it apart. Bank of America's Wall Street operations performing better than expected. Citigroup reporting markets revenue for the third quarter that beat the average analyst estimate. Big part of the story of Citigroup. That's a turnaround effort. Goldman Sachs profits soaring 45% in the third quarter. Surprise increase in equity trading revenue. PNC Financial Services pulling in more net interest income than analysts expected. And Charles Schwab soaring after they reported earnings per share that topped estimates as the stocks push higher. Chuck Clow at Clow Capital Partners isn't worried about valuations being too high.
With with businesses generating free cash flow at the rate they are, I think valuation becomes less of a factor. If the private economy is throwing off excess cash, that's going to find its way into the capital market somehow.
Biden administration's officials have discussed capping sales of advanced AI chips from NVIDIA and other American companies in the interest of national security. NVIDIA, among the most active, those shares right now down 1.6%. And Boeing preparing to raise as much as $25 billion in debt and equity to withstand that paralyzing strike. Those shares right now, they're actually up 0.9%. Overall, the Dow down 280 points, S&P 500 up just 3. That's still a record. NASDAQ 100 right now, 18 points higher. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Had to take a big step last night.
Yep.
Yeah.
Just heard the kids complaining. Usually I would say tough it out, but I had to turn the heat on.
Really?
Whoa.
A little chilly there. All right.
What was the internal temp?
It was 50-something, which is fine. But I didn't want to hear it.
50-something?
That's fine.
And you had to be convinced to turn on the heat?
Extra
Heat's
sweater on.
expensive.
50, and then everyone gets hypothermia living in Tucker's house.
Right.
I mean, 72. 72 and below, we're a little chilly. But 68, you're definitely turning on some heat, man.
Meanwhile, my apartment doesn't turn on until it hits 55 degrees, apparently. I just recently found this out. Apparently, we're supposed to freeze.
But then when it does turn on, it'll come on and then swelter you, and you'll be in like a t-shirt and tank tops for like all of winter. You love New York heating apartments. Happy Tuesday.
Absolutely.
I'm Alex Steele. John Tucker. So you all right? Did you turn it off when you left the house this morning?
Yeah, when I'm not there, I turn it off.
This is what I figured.
There are other people living there.
This is just what I figured. All right, Alex Steele, Paul Sweeney here. We have a great show for you, as Paul was mentioning. Former President Trump will be at the Economic Club of Chicago for an exclusive interview with Bloomberg News editor-in-chief John Micklethwait. That conversation begins at noon Wall Street time, but our coverage begins at 11:30 on a special edition of Bloomberg's Balance of Power. You can listen Bloomberg Radio plus Bloomberg TV podcasts and YouTube channel. So we're really looking forward to that conversation. Lots of movers, though, in the market. And one I want to start with is United Health. Wow. Nora Melinda joins us here. Help me understand what this problem is for this company.
Yeah, I mean, United Health is the worst decliner in the S&P 500 right now by percentage. The shares are down for their worst day since the start of the COVID-19 pandemic back in 2020. That's March of 2020. It really saw a really big hit from a catastrophic hack that it had called the Change Healthcare Division. United Health had previously forecasted it wouldn't be as much of a weight on their outcome, but apparently it did have more of a weight on what they were expecting. So some costs responding to the crisis were excluded from adjusted results, but now, of course, are weighing on the stock. Also, we did have the forecast, the 2024 full forecast, falling short of the average analyst estimate. That midpoint didn't impress the way that they were looking for, and we have executives that are emphasizing the targets are preliminary and they aim to outperform them, but it doesn't seem that the market's that convinced.
You know, looking at the Dow, this is really weighing upon the Dow here. I mean, I'm looking at the 260-point decline in the Dow. UNH is 380 points of that. So
my goodness,
overwhelming the Dow Jones Industrial Average, which is down 0.5% today.
If I just paraphrase, are people just on Medicaid or Medicare living longer and having a lot of procedures and getting reimbursed for that is tough? Like, is that what I'm getting from?
That would imply I have any knowledge of the healthcare economics.
Yeah, okay, that's fair. That's fair. At least that's honest. All right, on the flip side, though, we got Walgreens.
Yeah, taking a look at Walgreens, of course we know this has been a pretty beaten up stock. I mean, if you're looking year to date, the stock is down 61% year to date. That's huge, but it is the biggest gainer in the S&P 500 right now. Its shares are jumping for their biggest intraday gain in almost 16 years. We're seeing shares up as much as 15%, and this is after the company said that it has plans to close 14% of its U.S. stores. The company did say that they plan to redeploy the majority of the workforce in stores that are closed, so good for them. But it will shutter about 1,200 outlets over the next 3 years, and people are hoping this should really help with a lot of the costs that they've really been dealing with to kind of alleviate some of those concerns that investors have been worried about here.
Well, I mean, I think just here on Lexington Avenue, the Walgreens, you can't buy anything because everything's behind lock and key.
That's a really good point.
I mean, literally everything. I mean, a toothbrush. So, I mean, it's a tough way to run a business. So maybe they just get out of New York City. I don't know.
Also, then you have to like hire people to unlock it.
Yeah,
it's not like you can cut back on staff because then people are just like waiting there and the ding's going off.
Listen to us. Listen to us.
Yeah,
we can't wait for them to come unlock.
I passed the one on Route 36 in Middletown. It closed earlier this year. It's a relatively new store. It's just depressing.
Yes.
Oh yeah, no, they're really depressing.
Hulking store, like completely vacant.
But also, I do Capsule now. You all don't know about this.
No.
But you can fulfill all your medicine online. They deliver it to your door like same day. And like Walgreens will have a delivery service, but this is just like right through an app. Like you don't have to worry. You don't have to call. You don't have to do anything. I'm trying to get my mom signed up for that puppy. All right. Anyway, we're wrapping it up with Charles Schwab.
Yes. I mean, we're hearing from so many banks now. Of course, the bar is pretty low coming into this earnings season. So when we're looking at it more broadly, it does seem as though a lot of these companies will be able to top those expectations, or if they do, they will be rewarded in a sense. And so we're looking at Schwab, that's ticker SCHW. This is the second biggest gainer in the S&P 500 right now. Shares are rising as much as 9%. That's the most and highest since July. Now, this is after the company topped analyst expectations and did curb some of its expensive debt. It said that the company said that it cut bank supplemental funding by $8.9 billion. And we do know that this company is really emerging from tough times, especially as it was struggling with those interest rate hikes that we did see last year. This was one of the companies, much like many, that struggled here.
All right. Thanks so much. We really appreciate it, Nora. Good stuff. Norma Linda joining us, Bloomberg Equities reporter. So good news for Schwab. You know what's also good news? Man, these banks just crushed it today. I mean, really solid numbers. Although Goldman Sachs stock is now down by about 0.7%. Really? Yeah, that's actually kind of surprising for me. But I'm taking a look at, say, Bank of America. That stock is also down now by 0.8%. But on the surface, these numbers looked really great. Citi stock.
Yeah, I thought, and the capital markets.
2%.
Yeah, the capital markets, the trading business, I thought did very well. But I know the street likes the more predictable fee business, I guess, I suppose.
Yeah, but they didn't seem to care about that when it came to JP Morgan and Wells Fargo. You know who might know the answer to this?
I think I know.
Allison Williams, Bloomberg Intelligence Senior Analyst for Global Banks and Asset Managers. So for my, Luddite read here, there were really good numbers, and then the stocks are down. Tell us why.
They were, and it is all about the expectations. Keep in mind that we did get sort of a change in expectations, not necessarily baked into the numbers with the reports on Friday, the very strong trading and fees for JP Morgan, which set the tone, and the banks delivered on today. Net interest income, which, for JP Morgan, basically they had talked it down in September, then they beat the numbers and raised 4Q guidance. But Jamie's still talking negatively about next year. And for Bank of America, really, they did exactly what they said. Net interest income troughed, the number came in, and they are not going to talk about guidance for net interest income until the next call for next year. So I think the stock is probably fine, just reacting to things coming in basically as good, but versus sort of raised expectations.
What's the expectation here for when you talk to your investors about just regulation of banks? I mean, where is that headwind? Because I know it has been a headwind off and on for really since the great financial crisis. Where are we now with the Basel endgame?
Yeah, it is, and it depends on the election. At this point, right? So if Trump wins, then the rule could be derailed sort of indefinitely. So that would be positive for banks. If a Democratic win, will sort of continue on the same path. So Basel, the rules were very onerous that were introduced last year. Basically, we've gotten the signal that they're going to be lighter. We sort of had those expectations set within the last several weeks, but we're still waiting for that proposal.
When we just break down the broader sort of investment banking, can we say M&A's back?
So,
they seem to be talking good about it. That's not a sentence. They seem to be talking really positively about M&A.
So it is, and so from Goldman Sachs, who's the leader in M&A, very good numbers, and the fact that their pipeline is up sequentially is very good. But fourth quarter does tend to be seasonally strong, so we do have to see, is it just the typical seasonality, or is there a little bit more momentum?
Are all our friends on Wall Street, are they getting paid really well this year?
I mean, bonuses do look good for this year, especially for debt fees. I mean, really, that's
for September alone.
That's a huge highlight.
Good year.
Underwriting, right, was really quite strong across the board. What are some of the questions that you have now? And whichever bank you want to focus on. What's a big glaring...
So, the election is going to be important in terms of what that means for the capital rules. I think that's sort of the big structural question. Markets are strong. Things look good. That momentum is likely to continue in the fourth quarter. I think maybe the next thing that we're looking at is... can we get signs of improving loan growth? Because that is really, net interest income, that recovery is what investors are looking for. Can we get momentum there? The other side of the lending business is credit, and all signs are pointing pretty good right there.
All right, as a former Citi banker, I have an interest in that institution. Where is Jane Fraser in the turnaround of that bank? And does the street believe that she can get it to the point where it generate really competitive returns?
I think, the street has been burned so many times for getting their hopes up on Citigroup over the years. And so Citigroup is delivering on what they want to do. We saw that in the numbers this quarter. They, like the other banks, are getting a lot of upside from markets, but keeping the costs stable. And so for them, it's really, you know, these regulatory headwinds, which are so hard to predict. And, you know, I think the best thing that could have happened to Citi is this, you know, regulatory scrutiny that finally is making them, you know, make a lot of the changes that probably should have been done a long time ago. You know, getting the risk systems together, improving their operating efficiency, which at the end of the day will be helpful in the long term.
On Friday, we talked about Wells Fargo in particular, and you were saying that the big question you have is when do loans pick up? When do loans pick up? And what did we learn from, say, Citi and Bank of America on that?
So it's hard to say. You know, I think it's going forward, right? So the Fed cuts happened in the last couple of the weeks of the quarter, so we're not necessarily going to see the impact of that right away. Maybe the senior loan officer survey will give us a little bit of insight when that comes out in a couple of weeks.
All right, we got Morgan Stanley tomorrow, I believe.
Morgan Stanley tomorrow, they have, you know, really raised the bar for them, all these banks, especially Goldman strong numbers today. So we'll see if they can deliver on that. They tend to be more skewed towards equities trading. That's been the source of strength, so we'll see.
And are they going to be, like past cycles, they being all the big banks, like next week, all issuing debt?
Yep, that tends to be the focus. One more thing I'll add about them, you know, while the institutional, there's a lot of positive momentum, I think it will be all about the wealth flows for them. So they will need to, you know, if they get institutional right and ride this wave with everyone else, that's great. But they do need to deliver and show that wealth business is continuing to gather assets.
Which they always.
You know, the markets should be very helpful on that front as well.
Right, because it's an expanding pie that they're all competing for now, right? It's not like one tiny pie that isn't growing at the end of the day. One more question about Goldman, and this is a little personal for me because I have a Marcus account. For their consumer banking.
They called that out in quarter. They called that out.
Did they? What did they say?
No,
did they say that they're lowering rates a lot? And
they just
kind
said
of
Alex Steele inflows were noted during the period.
Well,
4.1 now.
Yeah, it just went down.
I just got another message.
I mean, come on, guys. Like, they just lowered ones. Anyway, how are they doing on offloading all the risk and stuff for their consumer business? I know that they already offloaded a lot to GM. They took a write-down for it or a charge for it. Where are they in this process?
Yeah, so one step closer with the sale of the GM portfolio. They are hanging on to Marcus, but, you know, Fed lowers rates. That positive for the banks means that there's less competition, less competitive pricing pressure, but for the consumer, you know, not as favorable.
Yeah, you know what I'm going to do? I'm going to find something that is competitive. I'm going to go to those munis. Like Paul's been saying, like, see you later, Marcus. I'm taking my money and run.
Free.
Yeah, but you can't pull your money out at a moment's notice.
Marcus?
No, with munis.
I know, but I'll know, like, in general. I should have known when John Tucker got a Marcus account that was the talk.
Yes.
You're blaming me.
Yeah, totally.
It's my fault.
All right, Allison, thanks a lot. We really appreciate it. Allison Williams, Bloomberg Intelligence Senior, Global Banks and Asset Manager Analyst. All right, coming up, we're going to talk about oil. It is down today. Energy stocks also quite underperforming. Are we taking some geopolitical risk out? We're down by about 4%. It's a hefty downslide. Dan Pickering is Chief Investment Officer at Pickering Energy Partners. He'll be joining us on energy sector and industry trends. He's honestly one of the best in the industry, and also we'll have a nice take on where we're going to see M&A go. Plus, George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, on Boeing raising as much as $25 billion potentially. I mean, there hasn't been a day we haven't talked to George.
There has been. There's airlines, there's Boeing, there's always something.
I talked to him on TV yesterday, too, so there was that. And then, of course, at 11:30, we will begin broadcasting a special edition of Balance of Power. All of that right here on Bloomberg Radio and YouTube. Happy Tuesday. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After yesterday's record close, major averages right now lowered a little change. Chip makers falling, slide in oil, dragging down the energy producers. Right now, shares of NVIDIA among the most actively traded, down 3.6% on news that the administration has discussed capping sales of advanced AI chips. Bank of America climbing right now. Those shares are up 1.4% as earning topped estimates. Goldman and Citigroup, they also reported solid results, but those stocks right now are under pressure. Charles Schwab soaring after they reported earnings per share that topped analyst estimates. They also cut some of their expensive debt. United Health Group lowering the top end of its forecast. You can blame that for the slide in the Dow right now. That's one of the components there. United Health seen as a bellwether for the insurance sector. Right now, S&P 500 is a point lower. Dow Jones Industrial Average down 165 points. The NASDAQ 100 is down 49 points right now. And as we look at Brent crude, down 4.3%. NYMEX crude down 4.6%. And we check the markets view all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right. Thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we are broadcasting to you live from our inactive broker studio right here in Midtown Manhattan. As John Tucker was just talking about, you're looking at crude off by over 4%. And the only headline that you could really find was perhaps Israel will not be targeting Iranian oil infrastructure. So it raises the question, are we looking at geopolitical risk being priced out? Also, the IEA revised slightly down demand forecast for this year and next. Mostly a China story, but nonetheless. Dan Pickering is Chief Investment Officer at Pickering Energy Partners. He joins us from Houston, Texas. He's honestly one of the best in the industry. He's been around a long time. He's kind of seen it all, and he has a great insight into what companies will do as well. What's your take on crude off by $3?
Yeah, Alex, good morning. It's definitely this news that we potentially are not going to see any escalation of violence in the Middle East. If Israel doesn't hit the Iranian oil facilities, then we have kind of continued status quo, which is oil has been flowing out of the Middle East with no problem. And so we're taking the air out of the risk of supply disruption and getting back to a more fundamental market, which has been pretty soft over the last couple months.
What's the fair price, you think, for oil?
Yeah, fair price for oil. I'm an $80 through 2027. That's my forecast. But I think 2025 is going to be tougher. Fair price for oil in 2025 is probably 70, give or take, maybe a $5 band around that. If we have challenges in the Middle East, all bets are off. If it's supply and demand, my expectation kind of 70 to 80, 65 to 75, something like that.
Dan, I always joke or often joke that, my next life I want to come back as an energy M&A banker. Every Monday we come in, it seems to be something on the Bloomberg terminal. Talk to us about consolidation in the energy space. Where are we? What are you likely to see over the next year or two?
Yeah, so it has been a very active M&A market with companies focused primarily on four things. They're adding inventory, they're going for size, they're looking for scale, and it's happening at pretty good values. And so because the market has not been that interested in energy, right, it's an underperformer last year, it's an underperformer this year, because these stocks are pretty cheap, the companies are buying each other. And as they're doing that, they're replenishing the inventory that they drilled up during COVID. They're getting bigger, which is important. Bigger companies are getting more attention from the market. They're getting more profitable, and they're doing it at 3 or 4 times cash flow. All of those attractive things. It's going to keep going.
Yeah, Dan, that's such a good point because, first of all, I want to point out, Paul, you wouldn't want to have been an M&A banker like a few years ago.
No.
There was like a whole lot of nothing happening. But the idea is if you're an investor or you're a pension fund or something, like you can't own a huge bunch of oil stocks. Like your investors are not going to like that. So it's like you have to gussy yourself up to be the top 1 or 2 oil players out there. So to that point, who needs to still buy stuff and who needs to be sold?
Yeah, I think if you look at all levels, companies are trying to get bigger, whether it's Exxon buying Pioneer or you move down into much smaller market caps. So I think that we'll continue to see probably 50 billion as a give or take the point of relevance for the broad markets. And so my expectation is folks that are below that are going to keep buying, trying to get to that size, and that folks that are sort of smaller than Exxon are going to keep merging. So it's kind of across the board right now, Alex. And again, these companies will keep buying each other until the market decides that they're going to buy the stocks.
Dan, you mentioned that energy stocks have been underperformers. What is the bull case out there for energy? Is it simply maybe just valuation here?
Yeah, the bull case is strong yields, very good free cash flow. The companies have turned into real businesses since the shale bust, and so they're throwing off a lot of cash, returning a lot of it to shareholders. The other piece is it is an inflation hedge. Nobody's thinking about inflation right now unless it comes back. And then you have this sort of geopolitical element, which is if things do spiral out of control, you're going to want to own some energy stocks. So there's a bit of a hedge, and then there's value. Those are the two arguments for the energy sector right now.
Do you think that oil producers will keep producing more oil? Let me define that question a little bit. Have they run out of the good stuff? And that's another reason why we're seeing the M&A. And I don't want to underestimate shale players because we know that innovation and technology is huge, but they have a lot of other stuff they need to spend on, particularly in the energy transition. So can we count on technology to make the rock good?
The answer is yes on the margin. There's another leg up in efficiencies that's been happening this year. I think the reality, though, is that U.S. shale is maturing. And what that translates to is likely a sort of an upward push on cost structures and upward push on commodity price. Remember, shale's now over much more than half of U.S. production. The Permian alone is 6 million barrels a day. That is a meaningful player in the global market. And so as those assets mature, there's an upward bias to price. Never count out ingenuity and efficiencies. But as this industry matures, we're going to see a slow upward push on cost and price.
And before I let you go, Dan, how do you think the election is going to affect big oil at all? I know that the talk is going to be like, we want oil friendly, blah, blah, blah. But in reality, they're not going to want drill, baby, drill, because they don't want to do that. They're going to tank the oil price. Materially, do you think the election matters for oil companies?
Simple answer is no, Alex. I think that these companies, it may be a little bit easier or a little bit harder to interact and run the business, depending on who gets elected. The reality is that politicians have proved that they want low gas prices. We're not punishing bad actors globally. We're letting them produce their oil. We want U.S. oil. We're not going to punish this industry too much. And the industry itself is not going to step up and get super active unless there's a price signal. So the election, it matters for sentiment and perception. I don't think it matters a ton for reality.
All right, that's great stuff, Dan. Appreciate it, as always. Dan Pickering, Chief Investment Officer, Pickering Energy Partners. I've known Dan as a voice on energy for 30 years.
Oh, okay.
And a buddy of mine used to work with him, David Bradshaw, my energy investment banker. He's my go-to guy on all things there.
Nice. Well, let's get him on, too.
We will.
All right.
We will. Let's talk Boeing. They are back in the news again. And when we talk Boeing, we talk George Ferguson again. George Ferguson, Senior Aerospace Defense Analyst for Bloomberg Intelligence. George, I like this move. Boeing puts up a $25 billion shelf offering, gives it some flexibility to shore up its balance sheet. I know we have to talk about dilution, but tell us what Boeing is doing here with this $25 billion shelf.
Yeah, so I think Kelly Ortberg went out and brought up the big guns, right? So I think he wants to shore up the balance sheet, I think, so he can show the union that Boeing has plenty of cash to make it through this strike. I think that's part of his strategy to get the union back to the table and get them to rethink probably some of their demands. But that's what I see here.
And what is the sense of their balance sheet? Just give us a sense, George. I know you've been calling it out and highlighting it for us for quarters now. Talk to us about kind of the cash on their balance sheet, the cash burn. How long can they go before they really do need to think about fresh capital?
Yeah, so I think they need capital now, right? So I think it is part of why Kelly Ortberg and Boeing are going to the market because, they just pre-announced earnings for the third quarter. Cash balances were right around $10 billion. That's about what they've told us they need to operate the company. So I think that really put their back up against the wall. As you know, they're managing a dance with the creditors as well because, they're really up against the edge on their investment grade credit rating. So I think it really precluded going to the debt markets here. And so, I guess the question is too now is it's of staying power, right? And how long can Boeing manage with the $10 billion? They couldn't manage very long a strike. And so to get better negotiating leverage with the unions, I think if you put another $10-15 billion in the balance sheet here, I think it gives you at least a quarter, probably multiple quarters of potential cash burn. So you could tell the union, look, I'm gonna wait this out until you bring me some demands that I can meet.
Just hold that thought for 1 second because I want to point out ASML, which is a company that makes lithography machines so you can make AI chips, is now halted after a steep drop and earnings that did not look great. Third quarter net sales did come in higher than estimated, but their third quarter bookings fell below about 2.63 billion euros, substantially below the estimate. They're also taking a look at 2025 net sales, also below estimates. This is quite interesting read-through for AI. Again, they make the lithography machines that help make AI chips, and that stock is now halted after falling steeply after those numbers came out.
That's shocking.
Shocking, right? Let's take a look at NVIDIA, too.
I'm looking at
see what
NVIDIA
they're
down
doing.
4.4% just on that news, just in the last couple of minutes.
Okay, so not only just from the news over the
Yes.
over the night.
Yep.
George, before I let you go, how much time does this buy Boeing?
I think it buys them at least a quarter, if not more. I mean, look, I think if you're negotiating with the union, I'd be really surprised if the average union member is ready to go a quarter without a job. And so, without income, I shouldn't say without a job, they have a job at Boeing, I guess, but without an income. So I think it gives them plenty of staying power. And I think that's what Boeing has to do here, right? If they're going to get the union to come back to the table and negotiate in good faith, they have to be able to say, look, we're not over a barrel. We can wait you out. Now let's talk about some of the issues, especially, I think, the pension plan, right? The unions talked about a return to pension plan. I don't think any major corporation has given back on a pension plan since they've retired them over the last number of decades. So I think they have to be ready to go the distance to not have that happen.
All right, George, thanks so much for joining us. George Ferguson, he's Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. Just kind of talking about the Boeing news here. And this ASML news, I'm not sure what to make of it.
It's not good.
It's not good, and I'm not sure where this is coming from. As again, you think about them, they've been one of the major beneficiaries of kind of this AI boom, and the stock is trading now. It's now down 11% here. The ADR's trading here in the U.S., so we'll keep an eye on that. We'll have some more reporting on that. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. S&P 500 is down 25 points, near overbought levels still from a technical perspective. NVIDIA most active. Those shares are down 6.2%. Walgreens Boots Alliance, second most active, up 11.5%. They plan to close 14% of their U.S. stores to cut costs. Bank of America's Wall Street operations performing better than expected. Those shares right now, Bank of America up 1.5%. Fed rate cuts, good for stocks. And from a fundamental economic perspective, Ian Shepherdson at Pantheon Macroeconomics says the Fed needs to continue cutting interest rates.
And I think we've got some sluggishness in the labor market pretty much baked in. At the same time, we've got inflation heading nicely down to the target, which I think probably will be hit sometime middle of next year. And we've got rates that are, by anybody's measure, they're way above neutral.
Yeah, right. S&P 500 down 25 points. The Dow 164 points lower. The NASDAQ Composite Index 200 points lower. And I know you love it when I do sports. According to NFL Network, the New York Jets have made a trade for Devontae Adams.
That is big.
Long-suffering Jets fans. Yay. And we check the markets for you. And even sports all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
So we like this trade?
Yes.
Yes.
Great receiver, and the Jets need a great
Go
receiver.
Jets.
Yes, there
All
you
right,
go.
right on, man. Okay. Alex Steele here, alongside
bad
John
for
Tucker
Las
and Paul
Vegas,
Sweeney.
though.
Yeah, that's fine. I don't care about Las Vegas that much. I mean, whatever. I barely care about sports. Okay, so I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we have one of them here with us right now, Mandeep Singh. He's Bloomberg Intelligence Senior Technology Analyst on this ASML news. So let me update you on what we see. ASML has been halted a few times for volatility. The stock dropped like a stone after cutting its 2025 net sales and gross margin guidance, and its third quarter bookings also missed estimates. And these guys make the machines that you need to make AI chips. Mandeep, is this a negative sign for AI chip demand?
I mean, look, when it comes to ASML, again, everything is driven by CapEx. And when I say CapEx, it's really coming from the foundry guys like TSMC, like Samsung. We know Samsung had layoffs recently, so clearly they are not doing very well, but TSMC is. So the fact that their buyers are so concentrated and the geopolitical tensions continue and, you know, the second half estimates, the comps are tougher. To me, this is just a sign of expectations kind of going up to the point where you will not see any positive revisions from the print this quarter. And that's what happened with ASML. Expectations had gone up, and they didn't surprise to the upside. So we could expect the same from others.
The magnitude of the miss on the orders versus the estimate seemed huge to me.
Yes.
Is that typical or not typical? Like when they miss, they really miss?
Well, so that comes down to how semis typically is. When you go back to prior cycles, when these companies miss, they miss big. We have seen that with Micron. We have seen that with some of the other names. But in the case of ASML, the secular drivers are intact. When you think about, you know, every foundry looking to use their machines, looking to go to, you know, smaller nodes, TSMC actually doing very well. So they are their largest customer. And when you think about, you know, how well TSMC has done in terms of their AI revenue, I don't think they are cutting back CapEx, but it's always about that incremental buyer when it comes to these semi companies, especially the ones that are reliant on CapEx spend. And if you take China out of the equation or the fact that they are restricted in some way, those are some of your incremental buyers. So that's where it has an impact.
We have a great function on the terminal. It's SPLC. It's a supply chain analysis. So if you type in ASML and then go to supply chain, you can see who their competitors and their customers are. So competitors are Applied Materials, KLA, Lam Research. So you can kind of see all of them are going to be down on this news. And then to Mandeep's point, Customers are folks like TSMC, Samsung, Intel also, although albeit not a huge customer anymore, but we know the problems that Intel has had. Semiconductor manufacturing, Micron, so watch that stock. SK Hynix, am I saying that right? Hynix,
that's on the memory side.
Yep, and then you have Global Foundries as well. This is a really ignorant question. Where does NVIDIA sit in this story that we're talking about?
Well, NVIDIA is sort of the first derivative. So if TSMC is not buying machines from ASML, that means they are not expanding their supply for the latest CoWoS packaging and the foundry side in terms of manufacturing NVIDIA's chips. So TSMC determines what kind of capacity expansion they are looking for 2025 and beyond. And based on that, they are placing an order for ASML equipment. So it is a very big sign. And to your point about Intel being a buyer, well, Intel is under pressure to curtail their CapEx as well. So you're taking a lot of the incremental buyers out of the equation, even though there is no substitute for ASML. So it's not as if ASML is losing market share to anyone. It's just the incremental buyers are fewer compared to where they were, a couple of quarters back.
Okay, what I know about AI, you can put into a shot glass. So answer this question like I'm a 5-year-old. Does this fundamentally change the AI story for tech?
It doesn't. It's just that everyone is expecting some sort of a digestion period when it comes to AI. We have had, a long up to the right sort of scenario so far when it comes to generative AI, and everyone expects a pause at some point. The signs are, NVIDIA's chip demand remains insatiable despite the restrictions, but when it comes to, semis, the way it works is first, your foundry guys are going to slow down their supply expansion. Then, NVIDIA will see fewer beat and raises. And so there is a derivative aspect to how it flows through. It doesn't all happen in the same quarter. And to me, ASML missing is one of the first signs that, things may be cooling down a little bit. It may not get reflected in NVIDIA's quarter this time around, but 2 quarters down the line, NVIDIA could get affected.
Which then also raises the question, like, which customer is the problem for ASML? Like, what if their customer list are calling them saying, like, guys, look, we don't really need the equipment. Like, we know it may not be TSMC, so then is it Intel? Because that's more of an idiosyncratic Intel issue rather than like a broader AI chip story issue.
Yeah, and Intel and Samsung. I mean, look, Samsung we know isn't doing very well on the manufacturing side. When people talk about generative AI chips and GPUs, everyone is going to TSMC as if they are the only game in town. Samsung isn't able to make that switch to that latest node for generative AI chips, and that's where we heard Samsung doing a layoff. So clearly they are curtailing their costs. Intel is curtailing their costs. So you take out 2 of the top buyers of ASML gear, and we know they sell, multi-million-dollar machines. So these are expensive purchases, and it's not as if ASML is losing business. It's just it won't get reflected in the next quarter or the couple of quarters.
So this ASML U.S. depository receipts down 12%. Is that a reasonable reaction, do you think, in this market?
I think so. I mean, given we are seeing some gross margin compression, and for semis companies, gross margin is huge. Anytime you see gross margin compression, that is your first sign that, things aren't going your way, and it's a sign that the demand is somewhat cooling off or your costs are going up. In this case, I think it is a function of orders getting delayed, and I think the reaction was warranted. Probably we may see an overreaction today.
Sure.
People may realize they still have a strong mode tomorrow and then buy the stock, but I think the reaction was warranted.
We've been looking for this, like a little bit of a hiccup or a little
crack or just something,
yeah,
right?
Something,
like
right.
Not everything is sunshine and roses like all the time. Mandeep, we really appreciate it. Thanks for the hustle, Mandeep Singh. Is there anything you don't know? I wonder if we talk to him about like
he's the most
Adidas, he'd probably have
tech analyst on Wall Street.
For real.
Right? I mean, stuff I was funding back in the day for you, unbelievable.
Mandeep Singh, Bloomberg Intelligence.
He's playing
Senior
wounded, by the way. He's
Technology
got a cast
analyst.
on, so who knows what's going on.
Oh, okay. Well, we'll get that in commercial break.
Yeah.
Taking a look at ASML, as Paul was just saying, the ADR down by about 12%. The stock at a session low, reporting a big third quarter bookings miss. You got 2025 revision lower as well, and operating margin. The whole tech sector now lower, with that NVIDIA leading that move as well on a points basis. We will continue to watch these headlines as we go. All right, coming up, from one problem to another, we're going to take a look at European car makers, particularly when it comes to EVs. Oliver Crook is Bloomberg Europe correspondent, and he has a great big take story on Mercedes and VW getting left in the dust by China. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We have a great Big Take story out for you. We love diving deep into all the topics and subjects that you need. It's a great Big Take podcast, and then you can also get it on Bloomberg.com as well as the terminal. And today's Big Take story is on how VW, so Volkswagen and Mercedes, are getting just left in the dust by China's EVs. The whole industry is getting squeezed by these cheap EVs from China. How do they recalibrate? Oliver Crook joins us now. Oliver Crook, Bloomberg Europe correspondent, joins us. Oliver, it's been way too long since we chatted, so hello.
It has indeed.
It's so good to see you. We know that Volkswagen and Mercedes are struggling and are left in the dust. Just how far behind in the dust are they?
So listen, Alex, it depends kind of where you want to approach this question from. When we talk about the Chinese market, which again is a very key market for Mercedes, BMW, and Volkswagen, this is their biggest market, or has traditionally been their biggest market for a very long time. You look at just the 3 third-quarter deliveries that we got just a couple of weeks ago. BMW alone was down 30% in terms of the sales that they were making in China, and that is their biggest market. So that illustrates the scale of the importance of this here. The problem is that this is not just a question of the Chinese slowdown, right? This isn't a question of just we're going to put some stimulus in, demand's going to come back. The nature of that demand in China is now changing. So what we see now in the Chinese market is that more than half of the cars being sold there are EVs. And so while they still retain a lot of these German car companies, some of that market share, a good amount of that market share, it's really not in the EV section. And they're not even in the sort of top 5 or 10 in the leaderboard for EVs. So the question is, going forward, how do you get competitive again? The problem they have is they had that ICE market share. It's about winning that electric market share, and they're just way behind on the inside of the car and the electronics.
Yeah, the ICE is the internal combustion engine part, which is the hardest part for these guys. Is it actually the battery? Is it just doing it all cheaply? Or is it the bending in the metal for the EVs? Where is the struggle?
I mean, it's a combination of all of these things. There is, of course, there's the battery components, even the sort of the EVs that are sold here in Europe, even the ones that are produced here in Europe, the batteries are still coming from China. All of the components are coming over from China because they've really sort of been very proactive with their raw material policy. Everything from the lithium to this processing, that all goes on to China. The other issue is, of course, the cost base, and we're starting to see that hit here in Europe, where Volkswagen is talking about closing factories for the very first time in its history. They're talking about closing a factory in Belgium, closing a few factories in Germany. And to understand why that's so important, this is a company that has literally never done that before in Europe, in large part because, you know, their supervisory board, half of their seats are held by sort of union representatives. So if they are moving forward and making that decision, it's because things are very, very challenging. The cost base, if you look at the hourly wages of a sort of auto worker in Germany, it's close to like 62 euros an hour. You go to Hungary, just not too far away, it's 16 euros an hour.
Okay, how do they fix it? I know it's a silly question, but like, do they need a massive amount of subsidies to stimulate demand? Or do they need sort of unions to get out of their way? What would make this process a little bit easier?
It's going to be a combination of all of those things. And one thing that makes it even harder, Alex, if we haven't talked about yet, is there actually are new EU regulations coming into force at the end of this year that basically stipulate that 20% of all the cars that they need to sell basically need to be EVs. The problem is there's a mismatch between what policymakers want and what the market wants right now. The market is stuck. These guys are still selling below 15% EVs. If they fail to hit that 20% by the end of this year, they're looking at potentially billions of euros worth of fines. So that's just another sort of overlay there. But this all, you know, I mean, the policy sort of dissonance that exists is one issue, but really these are car makers that have, it's partially their own doing, right? They were just far behind on this. The former Volkswagen CEO, he really wanted to lean into electrification. They weren't into that. They got rid of him. They brought in somebody new, and now they're really paying the price.
Oliver, how much of this is nationalism? We've seen with Apple, with the iPhone, maybe there's some concerns that the Chinese consumer on the margin doesn't want to buy Western products.
So listen, I think that that is going to be part of it. And of course, this is the Chinese policymakers have been trying to gear their sort of economy to not have the kind of dependency that they've historically had. Remember, the Chinese were really sort of welcoming with open arms Volkswagen back in the 1980s when they first sort of started producing cars in the Chinese market because there was no automotive industry in China. What is interesting now is you're seeing some of these European car makers now sort of inverting that sort of same dynamic where you have the partnerships with, say, Stellantis and Leap Motor, a Chinese company, have a joint venture here in Europe where now Stellantis owns 51% so that they are starting to build Chinese cars at their own plants. And that is, so we talked about the sort of threat to the Chinese market. That is also coming very, very quickly and very soon to the European shores as well.
Which is so ironic because if Europe really wanted to green stuff fast, they would just import a boatload of Chinese EVs on the cheap and have their consumers buy them. To your point, then it becomes like a nationalist point. Paul, who's in the worst, who's in the best spot of this debacle?
You really put me on the spot here because we try to get in trouble with
45 seconds.
I mean, listen, I'll tell you this: Stellantis is down 45% this year. They're down almost lost a fifth of their value since a profit warning 2 weeks ago. For thinking about companies that are really well positioned in Europe, you think about Tesla. They've got manufacturing over in Germany, and guess what? They make only EVs, so they're able to even sell some of those credits when those regulations kick in next year.
Okay, you see, you didn't. 27 seconds. Fine. What are you complaining about? He's totally fine. Oliver Crook, thank you so very much. Really appreciate it. Great to chat with you, Bloomberg Europe correspondent, joining us. In the big take story, Volkswagen, Mercedes getting left in in the dust by China's EVs. And you can read more of the story on Bloomberg and at Bloomberg.com/big take.
I didn't even think that would be a risk for the Western. I thought the brands were so strong over there that, and the quality was so much better, but maybe that's not the case.
I think maybe it's just a price point.
Yeah.
I mean, at this point. And like everyone wants a super cool luxury hot EV, right? Like that in essence isn't a problem. Like if you want to pay $1 bazillion for a Porsche that has an EV engine, no problem. But that's not the issue.
I didn't. I went with the gas.
Yeah, but you're not going to buy a Porsche. Okay, you bought your Vespa. This is different.
I bought a Vespa. Yes, I did.
Would you buy an EV Vespa?
No, please.
No, please. Okay.
John's got to draw the line somewhere.
I mean, but that's so easy. It's a little thing. You plug it in. Anyway, much more coming up on the next hour of Bloomberg Intelligence. Of course, 11:30 special BOP. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we got some very important people in the studio today, so we have to keep it tight. John Tucker, I'm looking at you. All right. Be professional here.
Barely say anything, as it is.
All right, coming up in this hour, we're going to get the latest on the markets as well. We've got some movers. We've got some tech movers today with that ASML news. David Auerbach's going to join us, Chief Investment Officer at Hoya Capital. He's a Georgetown guy on the state of commercial real estate business. Greg Jackson, CEO of Octopus Energy, on helping companies optimize energy usage. And then, of course, we have former President Trump will be at the Economic Club of Chicago for an exclusive interview with Bloomberg News Editor-in-Chief John Micklethwaite. That conversation will begin at noon Wall Street time. Our coverage begins at 11:30 on a special edition of Bloomberg's Balance of Power. Listen to Bloomberg Radio and watch on Bloomberg's television or on Bloomberg Podcast, the YouTube channel over there. So we got you covered on all that technology. Let's kick this hour off like we do with Mr. John Tucker.
All right, right now stocks are lower, dragged down by energy, chip makers, and technology. One of the triggers for the sell-off, ASML reporting bookings for the third quarter missing the average analyst estimate. The company lowering its net sales and gross margin guidance for 2025. Bank of America, that is one of the standouts today. Those stocks are higher. Bank of America up 1.4%. Its Wall Street operations performing better than expected. Meantime, Andrew Sheets at Morgan Stanley, who was a guest earlier today, he says a moderating pace of Fed rate cuts ahead.
You know, the 50 basis points that we got in September wasn't some new pace setting. It was a larger kind of one-time adjustment, and that the pace from here is going to be 25 basis point cuts, much more modest reductions. And if the data comes out better than the Fed expects, then maybe they could even do a little bit less than that.
Walgreens Boots Alliance planning to close 14% of its U.S. stores. They're trying to cut costs as consumers pull back. The drugstore chain said it's going to shutter around 1,200 outlets over the next 3 years. And more than 3 million boxes of oranges may have been lost since Milton tore through Florida. Orange juice futures rising for a second straight day. Right now, S&P 500 down 17, down 0.3%, 58.42 on the index. The Dow Jones Industrial Average down 124 points, and the Nasdaq 100, 182 points lower. That is down 0.9%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Did you need to be short? We didn't tell you to be short. We love when you talk.
Oh, okay. Sorry. Never mind.
You get paid the same whether you talk a lot or
That's
a little.
That's actually entirely true. We're also keeping our eye on ASML. That stock down over 11% after cutting its net sales for 2025 and gross margin guidance as well. Let's get some more details on individual stocks. Abigail Doolittle joins us, Bloomberg News Chief Markets Correspondent. Abigail, we're also looking at United Health. That just having a horrific day.
Yes.
Can you walk us through the numbers here?
So it's the worst day since 2008. I'm in the process of getting onto my Bloomberg terminal right now. Last time I saw it, it was down about 9% or so. What
it's
happened?
Got a huge weight in the Dow too.
Yeah. Yes.
It's down the most. It fell the most since 2020. It's the lowest currently since 2024.
Yes, you're right. I was thinking about Walgreens. Which is having actually its best day since 2008. So yes, you're right.
But either way, the soups are something. That's still a pretty nasty superlative.
Yeah, it really is. That the degree of the selling that we saw during that pandemic sell-off, and essentially it was the top end of the range. The guide missed estimates, but what I should say is the stock was recently at an all-time high. So it was priced to perfection essentially, and investors didn't get it, and so now the stock is lower. And it's actually off of its lows again. Earlier it had been down about 10%. Now it's down 6.6%. So investors rethinking that a little bit, but it's weighing on the entire space. We also have the likes of Humana, another healthcare insurer, down, and we have Centene down as well, along with Molina Healthcare. So there's a lot of weakness. As for Walgreens, which was the stock that I was thinking of in terms of 2008, and let's see, using that great SINS function in the Bloomberg terminal, whether or not it's still on its pace. So now it's up 17.2%, best day ever since 1980. That's saying something. That's the best day in 44 years. I mean, it's really pretty incredible. So, this company has been under so much pressure. So just the fact that they basically put up a decent quarter, the guide is where it had been before. And they've also given a little more guidance, as John was talking about, in terms of store closures, investors just liking that certainty.
Also, just the extent to which individual stocks are moving off of numbers. I mean, even just going back to the straight up, JP Morgan and Wells Fargo from Friday. A part of the other scenario we're looking at here is Boeing. How is Boeing responding to $25 billion worth of cash to raise at some point?
Wow, it has held on to its gain. It's up 1.3%. And Alex, you and I, of course, have a weekly conversation on this on Stock of the Hour and the 3 p.m. hour on television. And this company's so beleaguered, problem after problem. But more recently, the company took a bit of an offensive strategy, essentially saying, they fired 17% of the global, or 17,000 people from the global workforce. That's about 10%. Some of them union workers amid that strike, basically sending the message that, your job is not safe. And that maybe you should come to the table. We offer 25% raise, 30% raise. And then they also pre-announced all of that so that they could file the shelf. They needed to basically get the numbers out there to be able to file the shelf. It was bigger than what our Bloomberg intelligence analyst George Ferguson had suggested to me. He thinks that they'll do a 10 to a 15 or a 5 to a $10 billion raise, which would basically, $10 to $15 billion, which would essentially be, it could be up to 2+ quarters worth of cash. $25 billion would basically be a year. So he's saying to those unions, I'm going to have a year's worth of cash. I can outlast you. Can you last that long?
I think that's a great point from George. I wasn't even thinking about it that way from negotiating, but it makes Boeing's position a little bit stronger there.
Stronger, and also 30%. I mean, if you're in a negotiation, be in a negotiation.
I don't know what the bid ask is on that. It's 30% is the bid. What's
40%? 40%. So they want 40%.
Easy. I could solve that.
The other thing that they want is a defined benefit pension plan, which in this day and age, it's not possible. So I think
that's even before my time.
Yeah, which is like the Stone Age at this point.
Exactly.
Yeah, fair enough. All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us on all the big movers of the day. So the Fed is in a rate cutting cycle at this point. How much they cut TBD, but the idea is that they're in a global central bank easing with the exception of Japan. Does it make certain aspects of the market a little bit easier to stomach, like commercial real estate? So I wanted to check in on that with David Auerbach, Chief Investment Officer at Hoya Capital. He joins us from Dallas, Texas. How have REITs done if we're taking a look since the Fed first cut and then the trajectory now for this year and next? How are REITs performing?
Well, in the lead up to the interest rate cut, REITs performed very well. Post-Fed rate cut, the REITs have not done so well. They've given back some of that return because the 10-year Treasury is back over 4% for the first time since August. With the less likelihood of more significant rate cuts on the calendar this year, I wouldn't expect the REITs to respond accordingly. Obviously, if we can get the 10-year back below 4% again, that should bode well. And the reason being the cost of borrow for the REITs as they go to refinance becomes more attractive. REITs would obviously be able to borrow debt, would like to borrow debt with a 4 handle or a 5 handle, let alone they don't want to borrow at a 6 handle. So any movement that the Fed is able to go lower on the interest rates only provide some tailwinds for the REITs as a whole.
David, what was the last Fish concert you went to?
Good to see you, Paul. Thank you so much. I was in Colorado at Dick's in Labor Day, and right now my next scheduled concert will either be MSG New Year's Run or Mexico in February.
How did you know that question?
It's in the notes. You got to do your work here. But and if you come to Madison Square Garden, if you come to the Garden, you can see Matt Miller. He's there with all his brothers.
And McKee. He's a big Dead
right?
fan.
Okay.
Oh no, you're talking about Fish. I'm talking about the Dead.
Kind of same thing.
I mean,
kind of.
Yeah, I thought
The
so.
Dead's kind of, dead.
So, all right, David, do the banks, are they still lending to real estate, David? If I've got a project, can I go to my local bank and are they going to make me a loan?
Well, for a lot of the REITs themselves, remember, they're able to go out and borrow their own debt. They have strong balance sheets. Obviously, on a one-off type basis for the individual investor, the answer is going to be it depends. I think with some of the big banks, the JP Morgans, the Bank of Americas, they might be more likely to lend depending if the borrower qualifies. Obviously, on the regional bank level, that becomes, again, on a case-by-case basis. But the lending window is open. In the past month, 2 months alone, REITs have been able to borrow, take down, frankly, billions of dollars of new debt. Wow. I want to say it's close to like between $5 and $10 billion have been raised by a handful of REITs. And so the money is out there.
What about residential REITs?
Great place to be because of the housing shortage and lack of affordability. It's one of the core focuses of our Hoya Housing Index. And so as a result, when you think about the lack of affordability, it's the residential REITs, the apartments, the single family rental guys that benefit. And also, when you think about some of the other companies that are out there, because a person can't go out necessarily and buy affordable home, they're putting more, work into their existing home. And so again, one of the unique stories of the Hoya Housing Index is because we also include your Home Depots, your Lowe's, your Restoration Hardwares, because again, that affordable product isn't out there for the average consumer.
Can you explain to me how we got to this point, David, where we always talk about a housing shortage. How do we get there? How hard is it to build a multifamily apartment?
Well, obviously higher rates have impacted construction costs. So that's why you're not seeing a lot of new apartment projects underway. I also do blame the COVID run-up taking away some of that housing inventory since we saw, flippers and people taking down second homes, guys wanting to get out of apartments and, taking the first home possible. But, when you look at some of the hottest markets in the country as far as rentals, it's in your neck of the woods, in New York City. It's in Chicago. I saw a story that Detroit is one of the hottest rental markets right now. And so the housing issue is a coast-to-coast nationwide issue. You could point to pockets of areas that have more problems versus others because, again, of that affordability angle. But think about a rental project. I can rent an apartment here in Dallas for a couple of $1,000s, and that same apartment's going to cost me $4,500 or more in Los Angeles or San Francisco. So again, the number one rule of housing or real estate: location, location, location.
When you take a look at, say, the different REITs, is it going to be in large cap REITs, mid cap, small caps? Like, how do you guys look at it?
We skew our high dividend yield index, the RIET, towards small and mid cap REITs. The reason being, REITs as a whole, they only make up about 2% of the S&P 500, or about 7% of the S&P mid cap 4, small cap 600. So we see a lot of opportunities and hidden gems in the world of small and mid cap REITs. That's going to kind of provide that, I'd say alpha, that outperformance that you're looking for. We focus on dividends. And again, it's really those small and mid cap REITs that offer the higher dividend yields. Our high dividend yield fund, I believe, is currently the only REIT and real estate product that's on the market that offers both common and preferred stocks in one wrapper. So with us taking a 10% allocation, or 1/3 of the names of RIET into REIT preferreds, if you add up small and mid cap REITs, mortgage REIT exposure, plus our REIT preferred exposure, we're paying a monthly dividend that's annualized just under 9%. And if you just bought a large market cap weighted ETF like a VNQ, your yield is probably closer to 3.8% because, again, it's really focusing on those big large cap names.
In terms of the dividends, David, what do you guys kind of value more, dividend payout or dividend growth? That's a great question. I mean, I hate to say it's a little bit of both.
I think to the end investor, though, they really want the company to do four things: grow revenues, grow profits, grow dividends, and grow annual guidance. For a lot of the REITs, because a REIT is just a dividend income pass-through vehicle. So they want to make sure that they are obviously maintaining, if not growing, that dividend on an annual basis if possible. So I think you're kind of looking at both sides of it. How do we make sure that we don't have to cut our dividend? And what are the tools in place that we can put there to grow our dividend? And it's both sides of the equation. It's how do we maximize our revenue growth and minimize our expense growth? And for, like you talk about residential, you know, the big issue with residential right now is insurance, what we're seeing in Florida, unfortunately, with the hurricanes, and property taxes, especially for the single-family rental guys. So if they can minimize their expense growth and maximize revenue growth, that should hopefully lead to a higher dividend payment in investors' pockets.
Before we let you go, I want to also get your take on sort of other property sectors within the REIT market. Retail. When I say retail, what am I asking? Is it big malls? Is it like smaller retail presence? Like, how are those REITs performing?
Yeah, they've actually come out pretty well over the past couple of years when they were really kind of not really well received by investors. And I think it's due to a couple of things. Again, lack of new supply. It's not like we're building a ton of new shopping centers coast to coast. You're looking at an evolution of the product. A good example is Tanger, a typical factory outlet mall. The tenant offerings are different today than what you would have seen just a couple of years ago. A lot of these companies, also like the mall guys, are trying to bring in more experiential type offerings, not stuff that you can replicate online. And so the goal is to try to bring the family to the mall, you know, provide them a lot of activities that you've captured that consumer for multiple hours in a day. But really, you know, think about your typical grocery anchored shopping center. We're going to get groceries every single week, right? Obviously, we see the inflation side of it since the prices of a lot of the goods are up. But that anchor tenant, that grocery store, it's not like they're going away really anytime soon. Now, obviously, we've got some stuff with the Albertsons-Kroger merger that is going to kind of send some shockwaves through the grocery anchored industry. But I think with a lot of these REITs, with the relationships that they have and the experienced management teams, these anchor spaces are not going to be dark for very long.
All right, we appreciate it. Thank you so very much for joining us on those REITs. David Auerbach, Chief Investment Officer at Hoya Capital. Speaking of shopping, I can make that pivot.
Go.
Did you see this? Apparently, U.S. shoppers are going to spend less on holiday gifts this year, which would be another blow to retailers. The intention for gift spending fell 3% from a year ago. This is according to a survey of more than 4,000 respondents by Deloitte.
Well, I bet you John Tucker's just a great gift giver, don't you think?
He probably actually is.
Actually, I am. Thank you very much.
I would say he probably is, just not with heating.
No.
Like, he's not going to, like, pay for your heating bill. So apparently, shoppers said they're going to boost their overall expenditures from October to December by 8%, but the spending is going to be on things like experiences, decorations, and entertainment driving those gains, not going to a store and buying a pair of jeans.
So you go buy the cruise lines, you go buy the casinos, you go buy...
Decorations? The decoration store, whatever.
Do we know
that
what the
would be.
big gift is this year?
Why are you looking at me? I don't know.
Well, you're the expert.
Me? No, I shop on sale only. Although I'm obsessed with these one shoes. I like need to find shoes. This one pair of shoes.
All right.
They're called Sarah Flint shoes. They're supposed to be the most comfortable, like 4-inch stilettos.
Wait a second. How do you spell that?
SARAHFLINT.
Wow. What size are you?
It depends on the height of the heel, but they go for like $400 or $500. So thanks, John. Appreciate it.
It's the thought that counts.
It's the thought that counts. All right, much more coming up. We're going to talk to Greg Jackson, CEO of Octopus Energy. He helps companies and people optimize their own energy usage. It's a tech company, really. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Information technology and communication services among the worst performing industry groups in the S&P 500. U.S. traded shares of ASML Holding tumbling right now. They are down 15%. This comes after third quarter bookings missed estimates. The company also cut its 2025 guidance. NVIDIA, those shares right now among the most actively traded, down 4.3%. That comes on news. The Biden administration officials have discussed capping sales of advanced AI chips. The Goldman Sachs Group, profits soaring 45% in the third quarter. This comes on a surprise increase in equity trading revenue and also a resurgent investment banking business. Goldman Sachs shares right now up 0.4%. The firm's stock traders recorded their best quarter in more than 3 years. Dell Technologies will soon begin shipping devices featuring NVIDIA's Blackwell AI accelerators, demonstrating production of the chips is actually back on schedule. And then a little more on this story. Walgreens Boots Alliance planning to close 14% of its U.S. stores. They're trying to cut costs as consumers pull back on spending. The drugstore said it will shutter 1,200 outlets over the next 3 years. The S&P 500, 16 points lower, and that's down 0.3%, 58.42 on the index. The Dow Jones Industrial Average is down 74 points. That is down 0.2%. And the NASDAQ 100 right now down 206 points. That is a decline of 1%. Let me do oil for you real quick. NYMEX crude, American crude, down 5%, 70.14 a barrel. And we check markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Appreciate that. Also taking a look at ASML. That stock is now down on ADR, down by 15% after its orders miss as the chip industry weakens and weighs on that demand. The other stock that actually not as bad as it was before. United Health only down 6-7%. That feels like a modest improvement from where it was. So we were trying to understand what it is about this kind of business model that's struggling right now. You got a lot of people going to doctors, and then United Health winds up picking up the cost, and then how much is their reimbursement worth? So I was emailing and annoying Glenn Losef, Bloomberg Intelligence Senior Equity Analyst. We finally decided to get him on to discuss it. So Glenn, what in essence is the issue here for United Health?
Hi, so basically the 3Q results were highlighted by higher medical loss ratio, which is driven by higher medical costs by the company because of the higher care demand. And Alex, as you correctly pointed out, the premiums that United Health collected are mismatched versus the care demand that they're experiencing.
How does that mismatch happen? And how rare is that?
So this is basically their business. It does happen. And basically the premium rates or premium revenue is set up sort of at the beginning of the year, and health insurers, including United Health, are sort of forecasting what their medical costs will be. Sometimes those medical costs are higher, sometimes lower. Yeah.
Is it unpredictable? Like, can United Health not sort of guide the street to understand it better, or is it just like a random thing that happens?
There are a few things that's very difficult to predict. For example, in 3Q this quarter results, they highlighted that specialty drugs were prescribed much higher than they forecasted, and they said it's because of the Inflation Reduction Act. Although this trend was forecasted, it was expected to begin in 2025 versus now, but drug manufacturers started to push for consumers to get these products as soon as possible.
So when you look at these companies, these big insurers, is one of the things you look at their, I guess, historical ability to forecast these things? Are some companies better at forecasting what their expenses will be?
United is one of the better ones.
That's what I understood, yeah.
And but they also usually underguide and over-deliver.
Okay.
So there's some views, and I kind of think that whatever they commented on sort of expectations going forward, it could be part of the under-guiding and over-delivering over the next few quarters.
So you mentioned the IRA and negotiating drug costs. How much of this is also people living longer and needing more things and more stuff, and that just gets really expensive?
It shouldn't be reflected. It's actually part of it, obviously, but it's not. It shouldn't be reflected in one quarter. It sort of takes a lot longer to sort of, because, if people are getting older, it doesn't happen that, once you turn 75, that's it. You need a hip replacement. It's sort of extended over a few years.
All right, very good. Appreciate it, as always, just kind of giving us a sense of what's happening in that space. Glenn Losov joins us from Bloomberg Intelligence, senior equity analyst there. UNH stock down a little bit more before, but again, it seems like that's certainly a risk for these companies, kind of matching kind of what the costs are versus what your premium revenue is.
Yep, that stock down 6%. But to the main story right now, honestly, of the last hour, let's go to ASML yet again. They're booking estimates for the third quarter, missing estimates. They trimmed their 2025 guidance and operating margin. And then, of course, the read-through to what that winds up meaning from AI. Plus, you have potential chip restrictions coming from the Biden administration. But ... TBD on that.
Yeah, I wonder if this is a tipping moment for this AI story a little bit to the downside, much like the NVIDIA revenue guide up 2 years ago, kind of kicked off the whole AI thing to begin with. Are we going to look back on this and say, this is kind of when we really started to see just a little bit of a peak AI, maybe not in the actual business itself, because a lot of folks were kind of forecasting slowdown, but maybe just the sector.
And just understanding the supply chain is really helpful too, right? Like ASML makes the equipment that like the TSMC needs to make the chips to then give that to NVIDIA to sell Blackwell chips.
Yes.
So like that's sort of the stream there, and Intel sits right in the middle of that. So Intel would use ASML's machines, for example. I'm just using Intel as an example, and we know how much Intel has been struggling there at the end of the day. But that stock really getting hammered.
Supply chain function, SPLC.
It's huge. Awesome. I love that one, right? It's a really big one.
It is a good one.
So Paul and I are wrapping this up a little early today. Bloomberg Intelligence will be back tomorrow because we have a special edition of BOP, Balance of Power, which will be coming up in just a moment. Of course, politics taking center stage here.
Yep, former President Trump will be at the Economic Club of Chicago for an exclusive interview with Bloomberg News editor-in-chief John Micklethwaite. That'll be at noon Wall Street time. And as Alex was just mentioning, our coverage begins at 11:30 on a special edition of Bloomberg's Balance of Power. Listen to on Bloomberg Radio and watch on Bloomberg Television or on Bloomberg Podcast YouTube channel. So that'll do it for Alex and me. Coming up, Balance of Power with Joe Matthew. Coming up right now. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power, a special edition. Alongside Joe Matthew, I'm Keely Lyons.
Half hour from now, former President Donald Trump sits down for an exclusive interview with Bloomberg's editor-in-chief John Micklethwaite, live in partnership with the Economic Club of Chicago.
His proposed policies on taxes, tariffs, the Fed, and more are on the agenda. The conversation taking place exactly 3 weeks from Election Day, with Trump locked in a dead heat with Vice President Kamala Harris.
We'll bring it to you live at 12 Eastern. And as we look ahead, we'll be joined by Betsy Stevenson of the University of Michigan and former senior economic advisor to President Donald Trump, Joe Livornia, with analysis ahead from our signature political panel, Rick Davis and Jeannie Shanzano.
But we begin today with Brad Stone, editor of Bloomberg Business Week, and Bloomberg's Mario Parker, who both went to Mar-a-Lago to interview Trump for a Business Week cover story over the summer. And they are joining us now. Brad, Mario, thanks for being here. Brad, to begin with you, obviously it was a very different race when that conversation happened. It was before the attempt on Trump's life, before Joe Biden dropped out. How should we expect the tenor, the policy ideas Donald Trump may discuss or put forward today be different than what he was talking about those months ago?
That's right. Mario and I went down to Mar-a-Lago 3 months ago, and 3 months is a long time in politics. And frankly, things have gotten a little weird lately, Kaylee. I mean, yesterday in Philadelphia, Donald Trump played music and danced on stage. When he spoke to the Detroit Economic Club, he conjured visions of doom and said Detroit was a failing city. I do expect, because John is there interviewing him, a little bit more of a focused and disciplined candidate. I expect, he'll talk up his economic plan. So that's, of course, higher tariffs, lower taxes, restrictions on immigration, lighter regulation. But look, we're entering a stage in the campaign where both candidates are trying to be tactical. So Trump is trying to talk to, black men, Hispanic voters, conservative voters in the Midwest. So I think we'll probably hear a little bit about how, for example, higher tariffs can fund, for example, childcare, or no tips on taxes or overtime pay. That would be the best version of the GOP candidate, and we'll see if we get him today.
To that extent, Mario, some wonder which Donald Trump will show up. Will it be the one dancing to the oldies for 39 minutes last night in a rally that saw a couple of people faint? Some thought it went a bit off the rails. Or is it going to be the Donald Trump with the economy hat on today, taking serious questions about policy? What is his view of this campaign 3 weeks out?
Well, with this event, it's essentially his campaign with guardrails, right? The campaign feels as though the economy is his strongest issue versus Kamala Harris as we look toward the election, right? So by having a conversation with Bloomberg, no less, right? That's regarded widely as our brand with politics, the nexus between politics, the economy, et cetera. This naturally puts some guardrails up for the former president, right? So we won't see him. There won't be an opportunity for him to dance like he did last night, right? This keeps him more focused on some of those things that we spoke about in our interview a few months back.
It raises the question of the audience Trump will be speaking to today. Clearly, there's one physically gathered there in Chicago. There is our audience here on Bloomberg TV and radio, people who do care about finance and business. But knowing the pocket of voters still have yet to make up their mind, and just a handful of states, what is the messaging going to be to them? How many different audiences could Trump be trying to serve today?
Well, he's going to. That's a great question. He's going to be serving a few audiences, right? The business class that are attending there in person, right? I mean, again, he's in a blue state that Republicans have no chance of winning, but it's also one of the third largest media market in the country, right? So you want to get this message out in the middle of America, right? The biggest market in the Midwest, in between some of those blue wall states, a kitchen table kind of economic message where Kamala Harris has, in some ways, cut into his lead.
Both candidates, Brad, have been criticized for not speaking enough to pay-fors. How do you actually pay for the tax exemptions that have been proposed and some of the other economic proposals that have come from both camps? It's Donald Trump's turn today. Does it behoove him to fill in the blanks for investors who want to know more about how these tax cuts will be paid for, or does that actually make it more difficult for the campaign to say too much?
I mean, Joe, as a voter, I wish he would. As maybe someone sizing up the political landscape, I doubt he will. Because look, we're as I said, we're in the tactical stage of the campaign. 3 weeks to go, a tight election, and these candidates, and particularly Donald Trump, are promising the moon to the voters that he thinks can deliver a winning coalition. And so the inconvenience of paying for the agenda is probably not high on his list. And if you listen to economists and surveys of economists, most think that higher tariffs, the 60% tariff on goods from China, 10 to 20% from the rest of the world, can deliver $2 or $3 trillion worth of revenue, but at a great cost, of course, to perhaps inflation and economic growth, and certainly do not pay for the agenda that he's laid out. So, but no, I mean, I don't expect him to kind of reconcile that, and that'll be John Micklethwait's role as a moderator to kind of hold him to account and try to get some answers on that.
Well, as we wait for both the moderator and the candidate to take the stage in Chicago for this conversation, we do see a crowd fully gathered in the ballroom where this is happening. So certainly the audience is ready, as are we. Brad, as we consider here the kind of candidate that Donald Trump is, knowing Bloomberg Business Week has profiled many business, political leaders over the years, Donald Trump included, as we mentioned, how is this candidate's style and nature different than candidates we've seen in the past that we could see reflected in this conversation in Chicago today?
Yeah, it's a great question, Kaylee. Look, I mean, a lot has been said about how challenging it is to interview Donald Trump. And, Mario and I were at a little bit of an advantage 3 months ago when we went down to Mar-a-Lago. We conducted a print interview. It was not live. We rigorously fact-checked it when we printed the transcript. But Trump is a little bit more challenging, particularly on stage, particularly live. He floods the zone. He talks. He obfuscates. Sometimes he denies. I remember we asked him about comments where he said he would go after his political opponents. He denied having said that. Of course, most recently, he's talked about imprisoning Democrats and going after Adam Schiff. He tends to suck the air and the energy out of a room. I think he's unique. He does not hew closely, let's say, to the facts. And so it will be incumbent upon the moderator, our boss, to try to hold him to account and to, make sure that he doesn't go on for too long and to bring him close to the facts of this national debate that we're having.
Bloomberg Business Week's Brad Stone and Bloomberg's Mario Parker. Thank you so much for the insights. As we turn from politics to the economy, we'll bring in our economic panel coming up next to debate the merits of Trump's known policy proposals with Betsy Stevenson of the University of Michigan and Joe Lavorgna, former senior economic advisor to President Trump. It's coming up next on a special edition of Balance of Power on Bloomberg TV and radio.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when stocks are under pressure, and a big part of the story today relates to ASML Holding. The ADR is plunging after it booked.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
There's no doubt housing and housing supply is the most serious economic and social issue in Ireland. But it's also important when you look at housing supply and how to ramp it up. There are also key infrastructure areas around water, energy, and other areas that are important enablers to the delivery of housing. We're spending, I think, second only to Italy in terms of EU governments on housing supports and housing supply. We will continue to invest more. It's also how do we make sure we can deliver projects and deliver housing more speedily and at scale. We've set up a new land development agency to assist with that, to assist with utilising public land. We're also reforming our planning laws through our offices, through our parliament currently. So investment's absolutely important in relation to housing. There will be more, and I think Apple is an appropriate source of funding for housing, water and energy. But alongside that, government needs to pull other policy levers to more quickly deliver housing too.
Nobody covers the top global leaders like Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you look at the next couple of years, rates on cash are coming down. Now is the time to make sure that you have a bond portfolio because you will get higher returns there over time.
what I'm going to do is something that nobody has ever even thought about doing. No tax on tips. As part of our additional tax cuts, we will end all taxes on overtime. I want to cut taxes on Americans while putting tariffs on China and foreign countries to bring our jobs back home. My plan is to make the Trump tax cuts permanent. They are massive tax cuts, biggest ever, permanent. And to cut taxes even more, a reduction in the corporate tax rate from 21% to 15%. No tax on Social Security benefits. Restoring the SALT deduction, saving thousands of dollars for residents of New York, Pennsylvania, New Jersey, and other high-cost states. As part of our tax cuts, we will make interest on car loans fully deductible.
A collection of the economic policy proposals former President Donald Trump has rolled out over the past couple of weeks and months as we bring you special coverage now of Donald Trump's interview here on Bloomberg. It'll be live from Chicago in partnership with the Economic Club of Chicago, scheduled to begin a bit less than 20 minutes from right now. As we consider what we're going to hear ahead, we assemble our economic panel. Betsy Stevenson, professor of public policy and economics at the University of Michigan, is with us, along with former chief economist for the Department of Labor, a member of the Council of Economic Advisors under the Trump administration. Joe Livornia is with us right now, former senior economic advisor to Donald Trump. It's great to see you both here. Thanks so much for being with us. Joe, I'm going to start with you because I suspect Donald Trump's going to be channeling you a bit today when he is speaking with our own John Micklethwaite. To what extent, and I hate to sound like a broken record, does he need to detail how he will pay for all the proposals that we just heard about?
Not yet. This is there are certain things the president would like to do, and certainly one of them is to permanent the Tax Cuts and Jobs Act of 2017, and he's come up with some other ideas as an attempt to try to keep middle income wages and salaries higher, which they did quite well under his term. And there aren't any details yet on how to specify how to pay for things per se. Some of it will be through tariffs. Ideally, it'll be through faster growth, higher revenue share of GDP, and then we see what happens.
Well, we have seen what happens, though, when Donald Trump has cut taxes before. We saw during his first administration that they did not, in fact, pay for themselves, Joe, knowing that there was a pandemic involved, which brought inflation lower, dragged growth lower as well, led to millions of job losses on a net basis under the Trump administration. How do you expect this will look different? And is it entirely dependent on there not being some other kind of unforeseen event?
Actually, I want to correct you on that. If you look at where this CBO scored tax revenues as a share of GDP before TICJA went in place, when it went into place, actually revenues were higher than what they had expected. So it did pay for itself.
But the deficit still did go up nearly $8 trillion.
The deficit, yes, the deficit last year. Oh, hold on a second. In the last year, revenues as a share of GDP have slowed a bit. And importantly, the deficit is up significantly. We're over 6% deficit in the last year with unemployment under 4%, which has never happened before. So I think you'd be very careful as to who is responsible for driving deficits.
Betsy, talk to us about what you're looking to hear today. There are a lot of investors out there, from what polling tells us, who have yet to make up their minds on who might be friendlier to the markets, never mind who might be better for America. But we're talking about the economy today, specific proposals when it comes to taxes and other initiatives that the former president has rolled out. What does the middle want to hear from Donald Trump?
Well, I think that the middle wants to hear an economic plan that is going to speak to them. Unfortunately, what they've been hearing is proposals, tax proposals that are rolled out, essentially that Donald Trump seems to think of right as he's standing on the stage. And so he doesn't have a lot of information about whether those would actually benefit the middle class, right? So he might say, let's deduct interest on car loans and think that that's going to benefit the middle class. But the middle class rarely itemizes their taxes. They're unlikely to actually benefit from such a tax scheme. And that, of course, people who are aware of one of the problems of the tax code is its complexity actually raises costs for everybody, really cringe at proposals like that are designed to sound good, have very little benefit for anybody, and ultimately end up cluttering up our tax code. I want to step back on TICJA. I think that the facts on the ground are that it didn't pay for itself. If you look at the Trump administration, through the 4 years Trump was president, we had revenue that was well below the historic average, and we actually had spending that was well above the historic average. And that's the simple math. If your spending goes up and your revenue goes down, you're going to run bigger deficits. Now, you might say that was even worse in the pandemic, in the years coming out of the pandemic. But in fact, what we want to do is reduce deficits and get a handle on debt during good times, like we had in the 10 years prior to the pandemic, so that we're able to help each other out during a really tough time like the pandemic. So I don't think you want to compare Biden's last few years with Trump's few years, because Trump came into an economy that was quite strong. He left with one that was quite weak. We can debate how much control he had over the way the pandemic hurt the economy.
Joe, obviously some of the proposals we've seen from Donald Trump are blatantly economic. It's tax policy, it's tariff policy, but there are other proposals as well that do have potentially an economic impact, like, for example, immigration. If he's talking about mass deportation, potentially removing millions of people who have not come to the country with legal status from the workforce, what economic impact do you ultimately expect that will have? The
impact, well, certainly the mass deportations, I don't know if that's going to happen. I can't speak to that. The president and some of his other advisors have mentioned it. The intention is to basically make sure that the labor that comes in is legal, and the intention is to try to raise U.S. worker wages, which, if there is less inexpensive illegal labor, certainly that'll help the U.S. on the U.S. side. In general, I'd say his tax plans, I think, were very effective. If you look, for example, at real median income, it rose for every demographic group, every ethnic group from 2017 to 2019. Of course, we had the pandemic. We had a lot of debt. I think it's unfair and unrealistic to look at that last year, which, by the way, when I was there, we talked about a V-shaped recovery, which is exactly what happened. The economy boomed, and it turned over in 2021 because the economy was very robust those last 3 quarters of the Trump term. So I think you have to be careful in terms of what we're cherry picking, so to speak, the news that makes one side look better than the other. On the polling, I can say, if you look at what households are saying, the former president polls extraordinarily well in the economy. So clearly middle-class voters have a perception that things are actually quite good under the Trump administration. I believe that was totally the case for most of those 4 years.
Betsy, Wall Street seems to think that Donald Trump largely is a friendlier element when it comes to the markets than Kamala Harris. A lot of that has to do with the corporate tax rate. How much of it otherwise has to do with uncertainty when it comes to Kamala Harris's plans? Wall Street spent 4 years with Donald Trump and has a good idea where he's coming from.
Well, they have spent 4 years with President Biden. Now, Kamala Harris has been very clear she is a more capitalist, more business-friendly candidate than President Biden. I think that, one of the challenges you have in maintaining a capitalist economy is that you have existing businesses that like to try to shut out new business formation, because that's how they're going to make the most profits. And so it is the job of somebody who's trying to protect capitalism to try to protect competition and make sure that new businesses can come in and compete, and that businesses that have succeeded don't use their success to try to prevent any other company from coming in and competing with them. Because if you prevent competition, that's how we get stuck. That's how we stagnate. That's how economic growth slows. So, I guess there's sort of two questions. If you are, a current successful billionaire Are you looking for someone to protect your money, or are you looking for somebody to help the U.S. economy grow? I think all of us should be focused on an economy that's going to grow, and the way to do that is going to be to make sure that lots of people have the opportunity to start new businesses, and that's why Kamala Harris is so focused on middle-class capitalism, making sure that middle-class people who have good ideas can afford and are able to start new jobs. You know, I really want to touch on two important things. President Trump has made it clear he plans to do mass deportations, and not just of illegal immigrants, but, you know, he's commented extensively on the legal Haitian immigrants in Springfield, Ohio. He'd like to have them removed as well. These people who've come into the United States, they have taken jobs that have allowed Americans to form new businesses. New business formation has surged in the last 3 years to an unprecedented level. I go to academic conferences where we talk about entrepreneurship, and everybody has been confused and pleased at the enormous, unprecedented growth in new business formation. And that has been enabled partially by being able to hire people, because we've had immigrants coming back to the U.S. after they left during the pandemic. So it would cause enormous harm in terms of hiring. Now, Joe pointed out it's great for American workers. If there aren't people competing for your jobs, you can push for higher wages. We've already seen higher wages, wage growth occur at the bottom. And some of that comes from equipping American workers with new technology, new capital, in order for them to be more productive. Preventing immigrants from coming over and doing low-wage labor is not going to be what gives Americans the good jobs they want. What's going to get them the good jobs they want is an ongoing surge of new business formation.
Betsy was filibustering that response. Let me just say on the polling and on the data, if you look at consumer confidence, consumer sentiment, it's at a recessionary type of reading. I don't want to be political with this, but the data have been very good under President Trump. And one of the reasons that President Trump is polling so well is that there certainly is a bifurcated economy for many people, and the middle class have certainly suffered. If you look at wage growth has risen about 20% in the past 3.5 years, but inflation's basically up the same amount. And for necessities, it's up even more. So clearly there's a lot of pain at the lower income levels, which is why the president is sort of A/B testing these various proposals, whether it's the auto deductibility on the interest, whether it's not taxing tips, which Vice President Harris actually liked as well. I think the Trump economic record speaks for itself, and I think the polling certainly reflects that, and his doing well also reflects that. So we'll see where we go. I would like more, and I say it's nonpartisan, I actually would like more information from the Harris team. I don't think we have a lot. Maybe she's going to be more pro-capitalist. I don't know. Certainly there was talk of a capital gains tax going up to 45%, a wealth tax. I don't know if that's going to happen. I haven't seen many details on it. I'd like to, because certainly when we're trying to predict the economy, we want to know what's going to happen regardless of who's in office. I don't have those details.
Well, she has talked about an increase in the capital gains tax rate, lower than what Joe Biden was looking for, 28% for those earning over $1 million. Betsy, just quickly, and we only have about a minute left here. I expect the Federal Reserve may also come up in this conversation we're about to witness between Bloomberg's editor-in-chief and Donald Trump. Can you just speak a bit about what influence, if any, a president should have on the Fed, and what the consequences are if a president could put a thumb on the scale?
That's easy. The president should have no influence on the Fed. We need independent monetary policy. And that's because when you talk about uncertainty, volatility, the way to eliminate uncertainty and volatility is to have professional experts managing our money supply. And that's why we have an independent Fed. There's a lot of research out there that suggests that an independent Fed is good. I want to put, some data out there. The U.S., since the end of the pandemic, has grown 10.7%. Compare that to the EU, which has only grown 4.4%. The rest of the world is saying, how can we be more like the U.S.? Wages are actually up 24% compared to inflation at 21%. So yes, wages are above, but it's not just wages.
That's a very mild, Betsy. That is a very, very small gap if you watch to see what's happened historically. That's very weak.
Wealth is up more than it was.
That's not true. Betsy, that's fake. That's not true.
Okay.
And by the way, on the Fed, I do think the president should have a say. Why should the Fed be independent and undemocratic? So I think the president should have a say in it.
Because
all right, Joe, Betsy, we appreciate the lively conversation and both of your input. Unfortunately, we're going to have to leave it there. We would love to do this again. Thank you very much for your time. Betsy Stevenson of the University of Michigan, formerly of the Obama administration, and Joe Livornia, former senior economic advisor to Donald Trump. Thank you both very much. And Joe, of course, we are still waiting for this conversation to begin in Chicago.
Yeah.
Donald Trump sitting down with Bloomberg's editor-in-chief, John Micklethwaite.
Let's remind ourselves while we're here, we'll have a lot more coming up straight ahead on Bloomberg TV and radio as we wait for the former president. We'll have it for you live coming up right here on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Presidents of the United States, now you advise CEOs. Where are the egos bigger, in Washington or New York?
In both Washington and New York, you have things that are of high consequence. So there's plenty of both talent, and with that often comes ego also.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
To the world of business. This is Balance of Power. Live from Washington, D.C.
Welcome back to a special edition of Balance of Power on Bloomberg TV and radio. I'm Haley Lyons alongside Joe Matthew. And we are just moments away from Bloomberg's live interview with former President Donald Trump in partnership with the Economic Club of Chicago. Trump will be taking questions on his economic policies from Bloomberg editor-in-chief John Micklethwaite. There are Attendees gathered, waiting in the room in Chicago for these remarks that are set to begin any minute now, Joe.
You said it. We understand that it could be 10 or 15 minutes before they actually get rolling. We're going to bring this conversation to you live and unfiltered no matter when it begins. As part of our coverage of the 2024 presidential race, this is an important conversation, Kaylee. It's one of the final opportunities that Donald Trump will have to flesh out his economic proposals, to appeal to the markets, investors, and, of course, voters who are going to be watching today.
Indeed. So joining us now to discuss the political implications is our signature political panel, Rick Davis, Stonecourt Capital Partner, and Jeannie Shanzano, Political Science Professor at Iona University and Senior Democracy Fellow at the Center for the Study of the Presidency and Congress. So, Rick, just to begin with the point Joe just made, we have seen Trump doing more interviews, a lot of them on podcasts, a lot of them with friendlier mediums, if you will, or at least people talking to him. What are the stakes of this conversation for Donald Trump?
Yeah, I think this is probably the biggest interview he's going to have since the debate. The reality is that John Micklethwait is a serious journalist. He understands how to ask questions and follow up. This is going to be the toughest interview Donald Trump gets, maybe even in this entire campaign. So I hope he's ready because he's sort of shown a disdain recently in answering questions. He cut off a town hall last night after just a few questions and decided dancing to YMCA is better. So I hope John has his dancing shoes on because no telling where this can go.
Not sure there's going to be a musical component to the program today, Jeannie, but when we consider the audiences Donald Trump is facing, how important will it be for him to get granular? These are both campaigns that have been criticized for not providing enough details. We're 3 weeks out. 3 weeks from today, Jeannie, what do you need to hear?
You know, I think it's true. Both campaigns have been criticized. I have been criticizing them. You know, I think back 10, 20 years ago, we would get these really detailed economic plans that people could pore over. They could talk about the cost. Even though we get 82 pages from Kamala Harris, it's sort of patchwork. We don't get that from Donald Trump. So, you know, I am guilty of calling for that as well. But, you know, part of me thinks that in this election cycle, just to go back to our old discussion of vibes, the vibes are important from an economic standpoint. And here's what I mean. You know, if we get Donald Trump as president or we get Kamala Harris as president, what are the vibes? What is the business climate? What's the zeitgeist for business going to look like? You know, maybe that in this case is more important than the details as to what their plans are. You know, we talk an awful lot about Donald Trump 1.0 and his tweeting and sort of the chaos of that environment. Is that what we're going to see in a Trump 2.0, which means it could have an impact negatively on business investment and elsewhere? Would Kamala Harris be a sort of calmer, steadier, you know, sort of guide in the economic realm? That, I think, is really important. And then your conversation just before, I think one of my big questions has to do with the independence of the Fed. That is a big debate here. You know, are we going back to sort of Nixon and Arthur Brooks, where we're going to have a Fed chair or Fed members who are beholden to the political arm? That's something that, you know, most people have frowned upon in capitalist democracies throughout history. But you do hear, and we just heard it, calls for a Fed chair or Fed members of the board who are more beholden to our political actors. I think that's a big, big deal in a country that borrows as much as the United States does. So these are big issues, and I agree with Rick. We are going to hear a tough interview and see how Donald Trump can answer some of these questions.
Okay, so Jeannie Shanzano cares about Fed independence. Our audience here on Bloomberg TV and radio does. I certainly do. Rick, do undecided remaining voters in swing states care about Fed independence? What is the message Donald Trump is going to be delivering to those people relative to the other audiences who may be tuning in today?
Yeah, I think if you put it in the context of Trump supporters, people who are going to turn out to vote for Donald Trump, and even those likely to vote for him have to sort of adopt his point of view. And that point of view is everyone is beholden to Donald Trump. Donald Trump should control every aspect of economic America. If he does, then everything is going to be great. And his track record with a lot of these voters has been pretty good. You know, people seem to enjoy the economy the first 3 years Donald Trump's president. presidency. We hear all the time, okay, well, he was gifted a good economy, and he didn't do anything to get in the way of it, but he did pass, massive tax cuts, and we just saw a very resounding debate as to whether it hurt or helped the country. But the bottom line is there's no downside. He is still seen by more Americans than Kamala Harris as being able to steer the economy the way
So why say anything that makes news today? If we take the economic hat off and put the political one on, you're preparing your candidate to sit down with John Micklethwaite. Don't make news? Is the mission or not?
Donald Trump loves to make news, regardless of whether he believes what he's doing, right? He had just said a couple days ago that he got pinned down on 200% tariffs, and they were going to cause all this economic dislocation. And he said, I don't know if it's 100, 200, maybe 500. I don't care. And the point is, you need to understand that if you're going to vote for Donald Trump, you're buying into that. You're buying into any given day, he could do something that's completely unprepared for, right, and has no economic justification, but he's going to do it because he's got a justification. And if you're a Trump voter, that justification is good enough for you.
So as we consider those who there are Trump voters and those who are Harris voters, and that pot that is still being fought over by both candidates, Jeannie, it does raise the question of Kamala Harris here. We should note that she has been invited to appear on Bloomberg, just as Donald Trump is about to do, for a conversation like this on Bloomberg TV and radio on the economy. Does she need to be doing more of that to counter what we're going to hear from Donald Trump, knowing that the economy is still a weak point for her in her campaign?
She absolutely does. I can just tell you, Kaylee, I was walking into the building and several people said, if Trump's coming on, Harris must, and she must talk about the economy, and here's why. Gallup, over 96%, it's almost unheard of, 9 out of 10 voters say the economy is either very important or extremely important in their vote. And she has got to address what is this gap that Rick was just talking about, where people see Donald Trump as better able to handle the economy. They are looking back fondly at his handling of the economy in his first administration. Now, we should be clear. She has closed the gap, and I heard Mario Parker talking about that. She has closed the gap from where Joe Biden was. But when she goes on The View and they ask her point blank, what would you do differently? And she doesn't point directly to addressing costs, or she doesn't point in another realm like Bill Clinton did the other night to ensuring that people who come over the border are not going to harm our citizens. This is where people get frustrated. So she does need to address this directly. She needs to tell us what she would do on the economy and how it would differ from what Joe Biden has done. Because, we're talking about a group of undecided voters in these swing states for whom the issue of the economy, and I would add to that immigration, remains the most important. And let's not forget, Donald Trump is talking about mass deportation as an answer to economic challenges, including the issue of housing. Somebody needs to explain from the Democratic side why that is preposterous. I don't think it's a hard thing to argue. Most economists agree, but he's out there making that case. You deport these illegal immigrants, and that eases up our housing costs. And then you have J.D. Vance in the vice presidential debate saying, yeah, we'll start with the prisoners. Well, prisoners aren't using our housing, so that doesn't even make sense. But their point is taken by voters because you don't hear Kamala Harris out there saying that that's preposterous. And the real issues with housing are the ones that she's going to address, and that has to do with supply and demand.
Is Kamala Harris capable of making that argument in a forum like this? Rick, would it help her to sit for 45 minutes? Is she well-versed enough in the economy to impress that crowd?
Well, we may find out tomorrow. I mean, give her credit. She's doing an interview on Fox with Brett Baer. I mean, that may be just as tough as today's interview with John Micklethwaite and Donald Trump. So, these next 2 days, today and tomorrow, could be decisive on how voters see this, because all this will turn into memes and various, cut and splice internet communications, and so will tomorrow. And so the American public is going to get an in-depth look at real journalism asking hard questions to these two candidates over the next 2 days. And if Kamala Harris wants to talk about the economy, I have no doubt Brett Baer will take her there. But if she doesn't, she may have to be pinned down to do it. And so today, is going to be economy. What happens with Bret Baier tomorrow is going to be equally interesting.
You make a great point. These two interviews today and tomorrow are essentially the equivalent of what would have been our second debate that we're apparently not going to be getting. Rick Davis and Jeannie Shanzano are going to stay with us through our special coverage. We wouldn't do it without our signature panel as we continue live now in Chicago, where Bloomberg's editor-in-chief John Micklethwaite is going to be sitting down with former President Donald Trump in the interview that we'll bring you live here on Bloomberg TV and radio. Stay with us. Special coverage alongside Kaylee Lyons. I'm Joe Matthew. This is Bloomberg TV and radio.
If you look at Reels, Instagram and Facebook Reels, both immensely popular, both growing a lot, those are really working not because the short form video format is special and new. It's actually been around for a long time. You remember Vine and the early days of short form video. It's because of GPUs, it's because of large models, it's because of advancements in recommendation systems. ByteDance is one of the really great companies at this. We also have made an immense investment in harnessing the power of modern models, large data sets, and modern hardware, NVIDIA's hardware and our own hardware, to build recommendations that make the products better and more engaging. Our advertising system is built on modern AI recommendation technology. So I always think it's interesting when people remark that like AI just arrived. It's actually powering already today a huge amount of the engagement and quality of our products.
Bringing you up-to-the-minute business news whenever and wherever it happens. I'm Ann Riverder in Ukraine, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Thanks for being with us on a special edition of Balance of Power on Bloomberg TV and radio. I'm Joe Matthew alongside Kaylee Lyons in Washington. We have our eyes on Chicago today, where soon former President Donald Trump will be sitting down with Bloomberg to outline some of his economic plans and discuss the state of the U.S. economy. This live interview we're about to share with you is in partnership with the Economic Club of Chicago. Donald Trump taking questions on his economic policy proposals from Bloomberg's editor-in-chief, John Micklethwaite. For those of you with us on Bloomberg Radio, you see the stage is set in Chicago. The crowd is ready. And as we count down to this interview, Kaylee Lyons, there's a lot that we could hear when it comes to taxes, when it comes to economic growth, and when it comes to his record, remembering that he's got 4 years to stand on here.
Yeah, we have experienced a Trump administration 1.0. The questions that will be facing him today involve what a 2.0 could look like. And frankly, we have to keep in mind that many of the things we may hear Donald Trump discuss today, policies he would like to pursue, and the same goes for Vice President Harris, are not things he can largely pursue unilaterally. Congress is going to be required for a lot of this to get done.
That's true. Some might suggest that Kamala Harris would rely more on a friendly Congress for her proposals because he has been so steeped in executive action. But it's why we wanted to spend some time with Bill Hoagland, a familiar voice on this program, Senior Vice President at the Bipartisan Policy Center and a veteran of Capitol Hill. Bill, it's great to see you. Thank you for joining us today at the table. This is an important prospect that Kaylee reminds us of. We're going to hear a lot of ideas today. Many of them will rely on likely a Republican-led Congress, should Donald Trump be elected, to enact them.
Absolutely. I think this is one thing that's lost in this debate. There's a number of proposals out here, both for the vice president and the former president, but it's all that has to go through Congress. Most of it has to go through Congress. Mm-hmm. I will say on the tariffs issue, there is a question as to whether or not the president can, former president can initiate those tariffs through executive order. I think there's some question there, since there was a Supreme Court ruling not too long ago as it relates to whether or not executive action has to go through what we call the Chevron decision.
That's right.
So there could be some decisions there. But overall, no, I think what's left out of this discussion is Congress is the ultimate decision maker in terms of the policies that are being discussed by both candidates.
Well, it does raise the question of what we may be likely to see no matter which presidential candidate wins, Bill. Are there areas of bipartisan compromise, be it on the child tax credit, no tax on tips, perhaps, that could come to fruition regardless? Because 2025 taxes are going to be debated no matter what. You're
right. I think that in terms of there is bipartisan proposals. I think that as it relates to taxes, in terms of whether or not when the 2017 tax provisions expire, whether or not how they are to be extended. I think both sides want to extend some portions of those, particularly for those with incomes of below $400,000 or so, that they do want to go through there. I do think there is bipartisan support for something in the child tax credit area. I think those are also areas of going forward. And obviously there is a support for something in the immigration area on both sides. Mm-hmm. So yes, there's opportunities here in a bipartisan world. If there is a clean sweep, I will say, both Republicans controlling both House, Senate, and the White House, then I think the situation may change in terms of the direction like it was in 2017 when President Trump came in and had a clean sweep, and we go through something called the budget reconciliation process, which does not require bipartisanship at the end of the day.
You're bringing back fun memories here, Bill. You were, of course, a creature of the Senate. If you were Donald Trump, would it not be the upper chamber that you'd be most focused on? You've got the power of the executive when it comes to tariffs. You get the Senate. Now you have nominees. Maybe you can twist a couple of arms in a thin majority in the House to get the rest done.
Well, I think you're right. I think that obviously I will be a bias toward the United States Senate since that's where I spent my career up there. Yes, I do think the Senate has a lot to say, particularly as it relates to the issue you just raised, Joe, as it relates to trade and trade issues going forward. That would be part of it. And then, of course, judicial nominations.
Right.
Bill, you were one of the signatories on a letter from the Committee for a Responsible Federal Budget to both candidates. We have seen the CRFB analysis that says Harris would add $3.5 trillion to the debt in their medium estimate over the next 10 years, Trump $7.5 trillion. If you are a deficit hot, if your number one priority in this election is fiscal responsibility, who is likely to be the most fiscally responsible?
Well, on the basis of the numbers, and I am a member of the board member of the Committee for a Responsible Federal Budget, on the basis of the numbers you outlined, Kaylee, yes, you would have to say that the vice president's proposals are less damaging to the fiscal situation than is the Trump proposals. Both of them, though, are adding to a deficit going forward and are going to both have to deal with the fact that coming early next year, and I haven't heard either candidates talk about this, early next year we're going to have to raise the statutory debt limit again sometime in the spring. That will require 60 votes in the United States Senate. Neither candidate is discussing that. That, along with the tax bill and along with the Fiscal Responsibility Act that expires as it relates to appropriations, all that's going to be, regardless of who wins, is going to be on the shoulders of the next president and the next Congress. So I'm a fiscal hawk. I believe that both of them are not doing what should be done as it relates to the long-term fiscal situation in this country with the proposals that they're putting forward.
All right, Bill Hoagland, we appreciate you joining us here in our Washington, D.C. studio. He was Senior Vice President at the Bipartisan Policy Center. We appreciate it as we continue our special coverage here on Bloomberg TV and radio. Joe, we are just minutes away from this live conversation with former President Donald Trump.
You said it, Kaylee. Coming up, indeed, a live interview in Chicago. Bloomberg's editor-in-chief, John Micklethwaite, is going to be sitting down with former President Donald Trump for this interview in partnership with the Economic Club of Chicago. We'll have it live and unfiltered right here on Bloomberg TV and radio.
You talked about how governments are not looking at healthcare and investing in healthcare as much as they should. What's the message you'd like to send to those governments?
Well, I think a healthier population is always going to be more productive. It's just that sometimes the political will isn't there in some of these countries. So I hope that they can keep this as a priority, because a workforce that is 20 or 30% down during a pandemic or an outbreak, or there's certain diseases that keep spreading, is not healthy, it's not productive. And if you want everyone to perform at their best, and you want healthcare costs to be down, you don't want to be burdened with insurance costs and other costs, I think it's important to invest early in health, in child health, in women's health, and I hope that continues both in India and other parts.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to a special edition of Balance of Power on Bloomberg TV and radio. I'm Kaylee Lyons alongside Joe Matthew as we wait for Bloomberg editor-in-chief John Micklethwaite's sit-down interview with former President Donald Trump in partnership with the Economic Club of Chicago. The audience is gathered in waiting for this conversation, which is expected to begin any minute now, and will focus on a number of economic issues, including tax, tariffs, potentially even Federal Reserve independence, as we've been discussing here on the special program this hour.
You said it, Kaylee. These are issues that we talk about every day here on Bloomberg and in this space on Balance of Power. It is our charge to cover the intersection of politics and Wall Street, the economy. And today, it's actually going to be Donald Trump's turn to speak to these issues. We've had so many economists and analysts join us asking for details. And John Micklethwaite will have that opportunity today. It will be interesting to see what moves the market and what does not.
Well, and it raises the question of how the market is watching this versus how voters at home are watching this, with just 3 weeks to go until Election Day. So back with us for more is our signature political panel, Rick Davis, Stonecourt Capital partner, and Jeannie Shanzano, political science professor at Iona University and senior democracy fellow at the Center for the Study of the Presidency and Congress. As we consider our audience here on Bloomberg TV and radio, Rick, we do know that a lot of people are in business, they're in finance, and they have money available to them. Many in the donor class are likely going to be watching this interview. To what extent does that class still matter at this point in the race, when a lot of the ad buys are in, knowing FEC filings are due tonight for the most recent fundraising period? How much does money still matter here?
Yeah, I think the sense is that even if you got a lot of money in, let's say today is a major milestone for Donald Trump, and Wall Street looks at him in a new way and says, oh my God, we got to place our bet there. The reality is deploying that money becomes problematic, right? Can you buy more TV? Well, it's probably sold out by now. Can you put more people on the ground to work? Well, negligibly, right? In order to hire someone, train them, and put them to work, it's going to be difficult. But I would remind everybody that this election, even though Election Day is 3 weeks away, we didn't know who the winner was for a week after that in 2020, and it may take longer than that. And we know what happens afterwards, lawsuits and things like that. So the need for capital, and this is sort of the modern version of a presidential campaign, is as relevant the day after the campaign as it is the day before the campaign. And so I do think it matters. And I think if donors are looking at it that way, they'll probably want to play.
I'm really glad that you mentioned that, Rick. We all woke up to tip sheets this morning, Kaylee, talking about 100 plus, more than 150, in fact, lawsuits that have already been filed, Jeannie, to contest results when we all wake up, I guess, on November 6th, if we ever go to sleep. Is this not the whole point here? It's time to start raising money if you're going to have to pay all these lawyers.
That's right. First of all, Joe, I'm concerned about you and Kaylee that you're waking up to tip sheets.
You're staying up with us.
No, you're absolutely right. I mean, we are looking at what some people call the judicialization of politics, meaning a lot of the decisions that in a democracy should be resolved at the ballot box, particularly since 2000, so this is a long-term trend, are increasingly being decided in our courts and by judges. And that is, as we know, an expensive endeavor. It also creates a lot of uncertainty that the market will have trouble with. And so it's that kind of chaos that I think should be concerning to all of us. And I was so glad Rick said that, because I think one sort of story that's forgotten in this whole discussion is about the impact of our very troubled political system on our economic system. This kind of uncertainty, this kind of chaos on both sides, the inability, as Bill Holden was talking about Congress to budget, you know, this debt ceiling, all of these things create an environment which is not potentially business friendly and not economically in our best interest. And that's something I would love to hear both candidates address, how they can figure out how to get us out of this really troubling situation politically.
There's a lot we'd like to hear today. Jeannie Shanzano and Rick Davis are going to be watching and listening along with us. We hope you will be as well, as we wait for the live interview in Chicago with former President Donald Trump. Bloomberg's editor-in-chief John Micklethwaite will be sitting down with the former president coming up here in partnership with the Economic Club of Chicago. This is Bloomberg TV and Radio.
And global leadership are on Bloomberg.
There's no doubt housing and housing supply is the most serious economic and social issue in Ireland. But it's also important when you look at housing supply and how to ramp it up. There are also key infrastructural areas around water, energy and other areas that are important enablers to the delivery of housing. We're spending, I think, second only to Italy in terms of EU governments on housing supports and housing supply. We will continue to invest more. It's also how do we make sure we can deliver projects and deliver housing more speedily and at scale. We've set up a new land development agency to assist with that, to assist with utilising public land. We're also reforming our planning laws through our offices, through our parliament currently. So investment's absolutely important in relation to housing. There will be more, and I think Apple is an appropriate source of funding for housing, water and energy. But alongside that, government needs to pull other policy levers to more quickly deliver housing too.
Nobody covers the top global leaders like Bloomberg. The top names in business are on Bloomberg.
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet, we're stimulating. And we're stimulating fiscally. It is not clear that we need more rate cuts at this point. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Nobody covers business like Bloomberg.
Thanks for being with us on a special edition of Balance of Power on Bloomberg TV and radio. I'm Joe Matthew alongside Kaylee Lines in Washington. We're standing by for an important conversation. That's why you're with us. Bloomberg's editor-in-chief, John Micklethwaite, will in a short time be interviewing former President Donald Trump in connection with the Economic Club of Chicago. For those of you with us on Bloomberg TV and on YouTube, there's a live view of the room. A big crowd standing by waiting for the conversation as we are just 3 weeks to the election. We are also monitoring market action ahead of this interview to set the baseline, as always. We go to Bloomberg's Abigail Doolittle in New York. How's it look, Abigail?
Well, we're seeing some weakness for markets today, Joe. We have the S&P 500 down about 0.4%, the NASDAQ 100 down more. But one area that's super interesting right now, and this does pertain to the former president, Donald Trump, who, of course, John Micklethwaite will be interviewing, is China tech. It is down a whopping 5.7%, down more than 15% from the recent high. And this could be in fear of some sort of tariff reprisal, because, of course, he did put a lot of tariffs in place against China before. So I believe that's one of the pressures we're seeing. Now, countering that, very interesting, is that the Trump trade, those highly taxed companies such as Apple and Berkshire Hathaway, they are higher. In fact, we have Apple hitting an all-time high. And one reason to think that this is connected to the markets saying that they think that the former president, Donald Trump, could have a better chance of winning in November. The predicted odds that we've been following since July that have whipsawed up, down. Well, right now, Donald Trump is leading 54% to Kamala Harris, closer to 50%. In addition, if we were to take a look at Republican stocks versus Democratically linked stocks, well, those Republican linked stocks are they are higher. And Kelly and Joe, I think that this has a lot to do with the expectation that the former president may, in fact, want to cut taxes instead of letting it just go up to that 35% that it could if nothing is done next year.
Well, that's definitely something to watch, Abigail. As we consider here, we are today exactly 3 weeks out from this election. At what point would you expect there to be a tick up in market activity other than what you just outlined for us? When are we going to see real attention being paid beyond just the typical Trump trades, maybe what we're already seeing in the VIX? When does it really set in?
I think that what investors and markets really want is certainty. So if there was a true sign that one of the two candidates was going to win ahead of the election, I think that that would actually be a positive for the markets because they would have that certainty. On the other hand, if it stays tight or it gets tighter into November, then you could actually see the opposite, a bit of a sell-off. I would argue, though, Kaylee, we've been seeing a fair amount of trading around this election without it being overt. For instance, the VIX, which we love to talk about, that gauge of uncertainty. Well, the odds around the election, or the curve, the futures, I should say, for the election, hovering right around at 20. So that tells you investors are not complacent. We also have oil selling off, and a part of that, of course, has to do with some of the Middle East tensions and a little bit of a break there. But China last week, of course, they are the world's largest user of natural resources, not creating the policy stimulus that they want. But again, I think that there's a big piece here with China and the former president, Donald Trump. I think that's a reason that we're seeing some weakness there, and that is really bleeding into the markets and has been for a little bit in certain sectors.
All right, Bloomberg's Abigail Doolittle, thank you so much. And as Abigail raises China, we want to talk more about that now and turn to Bloomberg's Michael Shepard, who leads our coverage of technology and strategic industries. And as we consider, Mike, what we may hear from Donald Trump today on China, we know about tariffs and the policy he is likely to pursue. We don't know as much about the kind of tariff policy Harris will pursue. We do know that the administration she has been part of for the last several years has still been pretty hawkish on China, including export controls and chip restrictions that we've even learned more about in the last 24 hours. So China is going to be a focal point for both of these campaigns here.
Very much so, Kaylee, and I'm glad you brought it up in that context because Abigail just mentioned this softness in China tech, but there is a broader question that both presidential candidates need to answer. What will their posture be more specifically toward China? Kamala Harris, for instance, the administration she has been with, as you pointed out, has kept in largely the tariff regime that Donald Trump instituted when he was in office, and the Biden administration has also unveiled a series of export restrictions aimed at curbing China's access to advanced technology. So how much will that be kept in place? And furthermore, for Donald Trump, what will he do beyond tariffs? Will he use some of those kinds of trade restrictive measures like export controls too, or would he seek to roll them back because of business pressure?
Well, I wanted to ask you about that very thing, Shep. Do we have any visibility in that area when it comes to a Trump 2.0, or is that something that John Micklethwaite could actually bring forth? Because we've got a story today saying that the Biden administration is considering clamping down on more than China, on other countries, including some in the Middle East, when it comes to NVIDIA chips, GPUs, and other sensitive technology.
Well, thank you for bringing up that scoop last night by Mackenzie Hawkins. It was a terrific story, and it signals that the Biden administration is not taking its foot off the gas when it comes to trying to manage and control the access of advanced AI technology that's being developed here and produced and built by American companies, and the extent to which other countries and their businesses are able to access it. Now, what happens next? And for the Trump side, they really do have some questions to answer, and we're hoping that our boss, John Micklethwaite, will be able to get some answers there. So far, the Trump campaign hasn't gone chapter and verse on very much of this at all.
I wonder, and especially as we consider the life cycle this interview will have once it is off the air on Bloomberg TV and radio, when it is, say, cut up into pieces and airing on TikTok, if that may come up as well. Do we actually have an understanding, Mike, of how Trump is thinking specifically about questions on TikTok and Chinese misinformation and those kind of concerns?
Well, what he has addressed when asked about TikTok in the past is he has changed his position completely. He has reversed it from his desire to ban the app back in 2020. We remember in the middle of the pandemic when everybody was enjoying the app as a little bit of a respite from being locked down, and that moment of joy even for some people, especially young people. But there were concerns raised about the national security implications of a Chinese-owned company gathering all this information on American users. And he put in an executive order banning the app. It was overturned by courts. Fast forward a couple of years, he has changed his mind, in part because he sees TikTok now as a competitor to other social media platforms, including those operated by Meta, Instagram, and Facebook.
That's the way he keeps Zuckerberg in check, as he's mentioned.
That's what he has said.
Shep, it's great to see you at the table. Thank you so much, as always. Bloomberg's Michael Shepard with us on a special edition of Balance of Power. To that end, coming up, that live interview we're standing by for with former President Donald Trump in Chicago. Bloomberg's editor-in-chief, John Micklethwaite, with the questions coming up next in partnership with the Economic Club of Chicago. Stay with us. We're about to begin here, live in full on Bloomberg TV and radio.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but That is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Look at the next couple of years, rates on cash are coming down. Now is the time to make sure that you have a bond portfolio because you will get higher returns there over time.
Welcome back to a special edition of Balance of Power on Bloomberg TV and radio. I'm Kaylee Lyons alongside Joe Matthew as we await any moment now Bloomberg editor-in-chief John Micklethwait's interview with former President Donald Trump in connection with the Economic Club of Chicago. The stage is set, the audience has gathered, and we're about to see a conversation. Notably, Joe, this is not a speech, as we have seen Trump give at economic clubs in a number of other cities.
That's right.
This is an interview where he could face tough questions about some of the policy proposals he has put forward.
Well, that's right. We're hoping for a spirited back and forth here and maybe some new ideas on how to pay for some of the policy proposals that Donald Trump has brought forth over the past couple of weeks. And as we stand by for both Donald Trump and John Micklethwait to take the stage, we assemble our signature political panel. With us for the ride today as well, Rick Davis, partner at Stone Court Capital, is with us, along with Jeannie Shanzano, political science professor at Iona University, senior democracy fellow at the Center for the Study of the Presidency and Congress. So, Rick, we're about to get started here. And as we've been discussing, there are a couple of different audiences that Donald Trump could be speaking to today and a couple of different strategies. What would be your advice to him for connecting to Wall Street?
I think that he wants to obviously be the guy who really promotes the economic growth of the country, right? And so one of the things I have not heard much of that is a big issue is the rolling back of regulations. I mean, the Biden administration has been the king of regulation. Not only has he been the king of organized labor, but he hasn't seen a regulation he doesn't love. And so you've had a massive increase since the Trump administration in government regulation. Earlier in the campaign, Trump spent a lot of time talking about that. Pledged to roll it back, cut the red tape, allow government to get out of the way of business. But we haven't heard that lately. Nowadays, it's, I've got more tax cuts and I've got more tariffs. And so it's much more on the side of stimulus than it is on the side of getting government out of the way. And I'd love him to give a full-throated, explanation as to how much he's going to go after government regulation in this interview.
Well, one thing we have heard from him consistently is drill, baby, drill. That one of the areas he would like to deregulate more is the energy industry, and that potentially, Jeannie, is a solve for the country's inflation problem, even as we've seen inflation moving back down towards the Fed's target. Do voters need more of a justification or an explanation as to how drilling more may translate into the prices they're faced with, not just at the gas pump, that might be more obvious, but in the grocery store, in housing, and anywhere else in the economy?
You know, I think he has been effective in that messaging, and you guys just interviewed Scott Besson a few days ago, one of his key advisors in this area. He's talked a lot about that. So I do think it has been effective. I think we will hear more of that. What I do think he needs to talk a lot about has to do with calming people who are on the fence, who liked his Trump economic policy in the first administration, but look at the heightened rhetoric this campaign cycle and wonder, is this kind of heightened rhetoric and what he's proposing, whether it is, you know, from the tariffs or mass deportation, whether those kinds of things are going to create a calm business environment in which they can invest in the way they want to. So I think a lot of this has less to do with what he actually says than how he comes across and can assure those people who are still on the fence and want Donald Trump 1.0 but aren't quite sure they're going to get it this time around.
What's going through Donald Trump's head as he approaches a conversation like this, Rick? He spent 39 minutes playing YMCA, Sinead O'Connor, and the DJ routine at a rally last night that was stopped after just a couple of questions. What is his view of this game that we call the campaign right now?
Wow, renting space in Donald Trump's mind is a dangerous thing for Rick Davis.
Put you right in there.
But I think that we can learn a little bit about, just a week ago, he was in Detroit doing the Detroit Economic Club. And he went on for 2 hours espousing a lot of new policy areas. And so I think in his mind, he's in a very similar mode as I believe Vice President Harris is, and that is, piece together some other sort of gimmies that I can put out there for certain groups. In this case, it was Motor City, Detroit, you know, and we're going to get the car business back in. And so I'm going to start putting together tax cuts for, you know, stimulating car sales. And so I think he's very specific in that kind of thing.
Got it. Well, you know, we're going to hear this happen live and unfiltered right now. Rick Davis and Jeannie Shanzano are going to stay with us throughout the hour here. We should mention the vice chair of the Economic Club of Chicago, Claire Babineau-Fontenot, is introducing our editor-in-chief, John Micklethwaite. We're bringing you in the room for this right now, Kaylee. This is going to be the intro to the intro, if you will, in Chicago. Once they get started, we will stick with this. You will hear the conversation live and in full, as we promised here. Let's listen now as John Micklethwaite is introduced ahead of his conversation with former President Donald Trump, live from Chicago on Bloomberg TV and radio.
For presidential candidates, and we're hopeful that Vice President Harris will join us as well. One important note: this program will be live on Bloomberg platforms and on the ECC YouTube channel. We ask that during the program, the room stay quiet while we are broadcasting. Okay, now on to the reason that we're all here today. I will keep my introduction brief so that we have maximum amount of time for today's interview. The Economic Club of Chicago has been fortunate to co-host this event with Bloomberg News, led by Editor-in-Chief John Micklethwaite. Born and educated in the UK, John started his career at Chase Manhattan Bank before becoming a journalist at The Economist, and later its editor, and then Bloomberg Editor-in-Chief in 2015. He is also author of several books, including The Wake-Up Call, Why the Pandemic Has Exposed the Weakness of the West and How to Fix It. There's no better person to lead a discussion about global business, politics, and the economy. Please join me in welcoming Bloomberg Editor-in-Chief, John Micklethwaite.
Thank you, Claire. Thank you. Thank you, Claire. Thank you, the Economic Club of Chicago. Thank you, David, particularly. I want to say two things at the beginning. The first is just for the record and for those people watching on television, the Economic Club of Chicago and Bloomberg both invited Vice President Harris to a similar interview about her economic plans that she has declined so far. And second, just to set some parameters about this interview, which I was just discussing with President Trump, we're going to focus on business and the economy. And that's partly because this is a business audience, but it's also because voters insist that the economy is the main issue that matters when they vote. So on that note, let me invite onto the stage President Trump. Have a seat.
I like that crowd. That's a nice group of people. Thank you very much.
Standing ovation.
Thank you.
President Trump, thank you for doing this, as we said. And you heard the reception there. The business people of Chicago, like everywhere else, they like a lot of the things you want to do in terms of tax cuts and some of the spending proposals. But like many business people, what they're often worried about is the cost. And the Committee for a Responsible Federal Budget, which is a bipartisan outfit, put out some predictions the other day. If you add up all the promises you've made, and your plans would add $7.5 trillion to the debt. That's more than twice the total for Vice President Harris. You're on course to push up debt up to 150% of GDP. You know, this is a very business-like audience.
Yeah.
Why should they trust you with that?
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at, even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like for what company are you talking about, okay? Look, I brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them. And I could give you an example of this if you want. Would you like me to? Because it just
give me
happened.
A quick example, then I will come back.
I just found out about it. So I've been talking about for the last year about Detroit and how horribly it has been. You know, it's just horrible, because we've been talking about Detroit's coming back for 40 years, and it's never come back. And it's very dependent on the car industry. Well, they've lost 60% of the business over a long period of time. And what happened is I found out a friend of mine builds auto plants. That's all he does. He builds auto plants. That's what he's good at. He doesn't want to build an apartment. All he wants to build is, and he builds the biggest in the world. And for the last year and a half, if anybody's heard me speak, I was talking about Mexico is a tremendous challenge for us right now, tremendous. China is building massive auto plants in Mexico. And they're going to build them, and they're going to take those cars and sell them into the United States. They're very near the border, and they're going to have all the advantages and none of the disadvantages. And that's going to be the end of Michigan. It's going to be the end of, frankly, South Carolina. Going to be the end of everything. So I've been talking about this, and I said to him about 9 months ago, I said, you know what? I want you to do me a favor, John. His name is John. I don't want to give his last name because he might not like it. But I said, I want to see an auto plant. I want to go and see one of these. You know, you press a button and everything works, right? I want to see one of the big ones. He said, all right, good. I said, where do we go? I'd like to go to Michigan. I'd like to go to someplace in the United States. He said, no, we can't do that. Why? We're not building anything big in the United States. That's not where we don't build the big ones here. I said, where are you building the biggest ones? He said, in Mexico. We're building giant plants, the biggest plants anywhere in the world. In Mexico, I said, so you mean they're going to make cars cheaply? They have advantages over labor and other things, and they're going to sell them into the United States, and they're going to put Michigan out of business. Is that what? I don't know anything about that. All I do is build the plants. If you want to see a plant, we'll go to Mexico. I'll show you the biggest plant in the world. That was 9 months ago. I saw him, and I talked about it all the time because I think it's a serious threat to our country, because not only autos, but other things. So then I see him 2 days ago. I was talking at another club, very nice club, and like this, except, I don't know, I think you people are probably even wealthier, okay? This was in Detroit, okay, which was appropriate. And I was showing them all sorts of charts about how their car, it's just gone down. It's like terrible. And I saw him, and I said, oh, how are you doing? How have you been? I said, could I ask you, how are those plants that you mentioned, those giant plants that you're building in Mexico, how is that coming along? Have you finished them? No, sir. They abandoned the project when they heard you're running. They abandoned the project when they saw that you were winning and doing well. I said, wow.
All the same.
Because I told them, and I said it publicly, they're not going to sell one car into the United States. I said, if I run this country, if I'm going to be president of this country, I'm going to put a 100, 200, 2,000% tariff. They're not going to sell one car into the United States, because we're not going to destroy our country because I know you're an anti-tariff guy, but I'm the exact opposite. There was no other way I could have stopped them other than, what am I going to do, negotiate with Mexico or China? You're not going to get anything from that. I said I'm going to put a 100, 200, or 300. I'm going to put the highest tariff in history, meaning I'm going to stop them from ever selling a car into the United States. So I just see the guy by accident. I see him. He says, sir, they've abandoned and by the way, they built foundations. They were really rocking. They were going to do it. They're the biggest factories ever built for cars. They're going to wipe out our country. If she wins, and she doesn't know what the hell she's doing. If she wins, she's not going to be thinking about, I couldn't, every speech I made having to do with cars, but every speech I made having to do with tariffs, I'd mentioned that our country is being threatened by Mexico. Now, all of those things, beyond even the car companies, all of those things are now dead. They're dead. I asked him, will they start? Probably not. They're dead as a doornail. If she gets in, it'll start up again.
President Trump, I'll let you give your example.
No,
you talked a lot about tariffs. You look at the American economy, 40 million jobs rely on trade. It accounts for 27% of GDP.
Okay.
If you cut that off, that's also going to have an effect on many, many business people here.
Yeah.
Tariffs also have another side. Isn't that something that you have to acknowledge?
No.
You could be plunging America into the biggest trade war since Smoot-Hawley.
But there are no tariffs.
You're going to stop. There are tariffs already at the moment.
There are no tariffs. All you have to do is build your plant in the United States, and you don't have any tariffs.
People, a lot of places like this, there are a lot of jobs that rely on foreigners coming here. You're going to basically stop trade with China. You're talking about 60% tariffs on that. You're talking, as you said, 100, 200% on things you don't really like. You're also talking about 10, 20% tariffs on the rest of the world. That is going to have a serious effect on the overall economy. And yes, you're going to find some people who will gain from individual tariffs. The overall effect could be massive in terms of the economy.
I agree it's going to have a massive effect, positive effect. It's going to be a positive, not a negative.
Well,
let me just I know how committed you are to this, and it must be hard for you to spend 25 years talking about tariffs as being negative and then have somebody explain to you that you're totally wrong. It'll have a negative. It will have. I'll go a step further. 40
million jobs is a lot of jobs to rely on.
They're all coming back.
Those are 40 million jobs. Those are 40 million jobs in America that rely on trade.
Are you ready? John Deere, great company. They announced about a year ago they're going to build big plants outside of the United States, right? They're going to build them in Mexico.
And you threatened them
with
also tariffs,
build,
and they stopped.
That's right. I said, if John Deere builds those plants and not selling anything into the United States, they just announced yesterday they're probably not going to build the plants, okay? I kept the jobs here, and I'll keep them. John Deere will stay here. And I'll tell John Deere, if you do build outside of the United States, you can if you want. For instance, India. is a very tough country. It's not only China. You know, China is the, I would say, probably the toughest, but there are a lot of tough. You know what's very tough? European Union, our beautiful European countries, wonderful, wonderful. If you add them up, they're almost the size of us. They treat us so badly. We have a deficit. I said to Angela Merkel when she was there, she's not there anymore, I wonder why, but when she was there, I said, Angela, how many Chevrolets do we have in Berlin? Why, Donald, you have none. He said, that's right. How many Fords do we have in Frankfurt? I don't know, none. I said, that's right. You know how many cars we have? Mercedes-Benz, BMW, and all of the different Volkswagen, millions and millions of cars. And then I said farm products. You know, they don't want our farm, they don't want anything from us. We have deficits that are crazy, and we're not going to have them anymore. We're going to put tariffs on them, and they're going to do, and you know what they can do? The Mercedes-Benz will start building in the United States, and they have a little bit, but you know what they really are? Assembly, like in South Carolina. But they build everything in Germany, and then they assemble it here. They get away with murder because they say, oh, yes, we're building cars. They don't build cars. They take them out of a box and they assemble them. We could have our child do it.
Can we come back? Let's come back to the Europeans in a second. What about consumers? People out there.
They're going to be the biggest beneficiaries.
Yeah, critics say your tariffs will end up being like a national sales tax.
No,
because
the country.
If you have America at the moment has $3 trillion worth of imports, you're going to add tariffs to every single one of them. That is going to push up the cost for all those people who want to buy foreign goods.
No. What's going to happen?
That is just simple mathematics, President Trump.
It's not. Yeah, it is, but not the way you figure it. I was always very good at mathematics. Yes. Let me tell you, you're saying $3 trillion.
That's $3 trillion worth of imports.
And they don't have to pay. And if, by the higher the tariff, the more likely it is to have them come into the country.
The higher the tariff, the more you're going to put on the value of that piece, those goods, the higher people are going to have to pay in shops.
Ready? The higher the tariff, the more likely it is that the company will come into the United States and build a factory in the United States so it doesn't have to pay the tariff.
That will take many, as you know, that will take many years.
In fact, I'll tell you, you know, there's another theory is that the tariff, you make it so high, so horrible, so obnoxious that they'll come right away. When I do the 10%, 10% is really, first of all, 10% when you collect it is hundreds of billions of dollars. The numbers that you're talking, all reducing our deficit. But really, so there's two ways of looking at a tariff. You can do it as a money-making instrument, or you can do it as something to get the companies. Now, if you want the companies to come in, the tariff has to be a lot higher than 10%, because 10% is not enough. Guys, they're not going to do it for 10. But you make a 50% tariff, they're going to come in. Let me tell you the other thing about tariffs that's great. Our steel companies, as you know, 3-4 years ago, they were all when I was in office, I saw a man from a big steel company, and he was devastated. I knew him for a long time, and it's been a tough business. It was a great business many years ago, and I would not let U.S. steel be sold to Japanese, by the way. It's psychologically, I think it would be.
That's the Nippon Steel, as you know.
Yeah, I wouldn't let it be sold, but I would stop it if it hasn't been completed by the time I'm president, because I think it sets a horrible tone. But I had a lot to do with steel. We were going to lose all our steel companies because China, as you remember, was dumping steel at levels that nobody's ever seen before. And I put a 50% tax on that and tariff on that, all dumped steel. And it was also bad steel. It was what they call dirty steel. It wasn't good steel, which is a bad thing for structural components of buildings and planes and things like that. They were dumping crap into our country. And I put a 50% tariff. I started at 25, I raised it to 50 because the 25 didn't quite do it. I raised it to 50 and that did it. They stopped dumping steel. And I saved our steel mills by having that. We saved it. We saved our steel. Now, what was left, because we've lost so much, but there are certain companies you have to have. There are certain things you have to have. Steel, you have to have. If you go to war, you know, there's a possibility you go to war. I kept us out of war. I was the only president in 82 years that kept you out of a war, except I defeated ISIS, but I inherited that war. There's no wars. And by the way, and I think it's very important, you can go, you know, I call it the weave. You can call it, you have the weave as long as you end up in the right location at the end. But while we're talking about it, We have never been so close to World War III as we are right now, with what's going on in Ukraine and Russia and the Middle East.
Well, let's.
I had no wars in the whole world. Think of it. And I talked them out of wars. I talked plenty of countries out of wars. I had the whole world, other than ISIS, which I inherited, and I knocked out ISIS in a matter of weeks. It was supposed to take 4 to 5 years. I did it in a matter of weeks. We actually have a great military. We don't know how to use it, but we have a
President Trump, with great respect, I was asking you about tariffs. You've gone off about that. Seeing you brought up tariffs and foreign policy, many people would say the biggest problem with your tariffs is actually geopolitics. You, in your first term, you got some credit for effectively saying that there was a Cold War against China. That's what America was in. You look at the last Cold War against the Soviet Union, America won it in part because it rallied allies to it. You're talking about slamming allies with 30%, 20% tariffs. Isn't this time you're going to end up trying to rally the West and you're dividing it instead? Isn't that the real problem with tariffs, even beyond all the problems due to the economy, where you keep on bringing up these individual examples, but the overall effect is going to be dramatic?
No, the overall
answer first about foreign policy.
Yeah, I'll do that.
How does it help you take on China, turning all your allies against you?
Tremendously, because China thinks we're a stupid country. A very stupid country. They can't believe that somebody finally got wise to them. Not one president, Bush, Obama, Barack Hussein Obama, have you heard of him? Not one president, think of it, not one president charged China anything. They said, oh, they are a third world nation, they are developing. Well, we're a developing nation too. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do. We're way behind them. You take a look at what's happened to our cities. So what I'm saying is
my
this.
question was about your allies, not about China. You are going to annoy the people you need to rally behind you.
But our allies have taken advantage of us more so than our enemies. Our allies are the European Union. We have a trade deficit of $300 billion with the European Union. Our allies are Japan. You know, Abe was a very good friend of mine. He was a great guy, great. And I said to him in Japan, he was assassinated. And he was a great man. He really was. I didn't see too many like him. And he got very sick and he had to take off. And then he was actually making a comeback. He was going to make a comeback and he would have won easily. But he was a great gentleman, handsome, wonderful man, respected by everybody. And I went to him and I said, Shinzo, we have to talk. What? Trade. And he goes, I'll never forget it. I know. I said, what do you know? I knew you'd come to me. Why do you say that? Because I can't believe, I wouldn't tell the story if he was alive, actually. Said, I can't believe how many years it's been that nobody even negotiated with us in America. I said, Shinzo, you have to pay for your cars. You're sending millions of cars. You don't accept a car from us. You don't have one car that you accept, and yet we're selling 3 million, 4 million of your cars. I said, Shinzo, on agriculture, you won't even accept our agriculture. And I renegotiated the whole trade deal from a little disadvantage because I was stuck with a bad deal. I mean, we have trade deals that were so bad that I said, who are the people that are doing it? They're either very stupid or they're getting paid off, okay? It's one or the other. It's very simple. We have the worst trade deals all over the world. South Korea, I love South Korea. They're wonderful people, extremely ambitious. They have a money machine. We protect them from North Korea and other people. North Korea is very nuclear. I got along with him very well, Kim Jong-un. Yes. But wait, they don't pay us anything. And I said, this is crazy. If I didn't put tariffs on, you know, the motor companies, the car companies, they make most of their money at small trucks. I put tariffs on China, but I put 27.5%. Otherwise, we'd be flooded with Chinese cars, and all of our factories would close. We'd have no jobs at all in the auto industry. That goes for electric, by the way, which is a killer, which I've explained, and I don't think I have to bore anybody by talking about it. But I put tariffs on South Korea because they were sending in trucks, and I put tariffs on, fairly substantial tariffs. Do you know that our car companies make almost all of their money with the small trucks, SUVs and small trucks? If I took those tariffs on, you would be inundated. Every car company would be out of business. And I got calls from Ford. I got calls from everybody saying, sir, I can't believe you're doing this for us. You saved our company. They make all their money with this. They make most of their money with the small truck and, the SUVs.
Many consumers ended up with more expensive cars. But let me just come at you on foreign policy.
You wouldn't have a car company.
You have said that Taiwan should pay for U.S. protection.
Yeah.
I ask because this morning you just mentioned North Korea. The Chinese army, literally as we speak, are engaged in rehearsals for a full naval blockade of Taiwan. So I suppose my question to you, if China invades Taiwan, would you send American troops to defend it?
Well, the reason they're doing it now is they're not going to do it afterwards, okay? So it's, so they're doing it now. They want to do it China. Now, look, I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un, who has a nuclear force that you won't even believe. And by the way, today it was announced for those that he just blew up the railroad going into South Korea. That means South Korea is now cut off from Russia and China and various other places. Cut off by rail.
Mr. Trump, you just mentioned.
No, but these are big things. I have to mention them.
Yeah, you just mentioned Putin, though, and there's been this controversy of the past week. Can you say yes or no whether you have talked to Vladimir Putin since you stopped being president?
Well, I don't comment on that, but I will tell you that if I did, it's a smart thing. If I'm friendly with people, if I have a relationship with people, that's a good thing, not a bad thing, in terms of a country. He's got 2,000 nuclear weapons, and so do we. China has a lot less, but they'll catch us within 5 years.
That sounds very much like you did talk to him.
I don't talk about that.
You talk about talking to Netanyahu, you talk about talking to these people.
Russia has never had a president that they respect so much, but more importantly, or less importantly, I guess, I went into Russia, and people said, oh, he likes Putin, and Putin likes him. Let me tell you, the first thing I did was terminated Nord Stream 2. Nobody ever heard of Nord Stream 2. It's a pipeline from Russia to Germany and all over Europe. I said, wait a minute, to NATO. I said, so let's get this straight. My first meeting, I said, so Putin's building the biggest pipeline in the world. He's going to Germany, but all over Europe. And you're paying him billions of dollars a year, billions of dollars a month. Germany's paying billions of dollars a month. And we're supposed to protect you against the guy that you're paying all this money to. So is there something wrong with my thinking? So he's building a pipeline to Germany, and we're spending, and by the way, until I got there, we were spending almost 100% for NATO because we had all these delinquent countries. They weren't paying. When I got there, I said, you know what? And by the way, my biggest fan is Stoltenberg, just leaving, Secretary General of NATO. He said when Bush came in, he made a speech and left. When Obama came in, he made a speech and left. When Trump came in, he made a speech and he said, let me see your books. And I found out in the books that nobody was paying. There were only 7 countries that were paying. We were supporting NATO. They screw us on trade, so bad, the European nations. And then on top of that, they were screwing us on the military. So they're taking a tremendous advantage of us, $350 billion on trade, and we're then supporting them. In other words, it's not sustainable. You can't keep doing this. You can't have that, China, all of these countries. And stupid people made these deals. I saw trade deals that were so stupid that you'd have to be, that was so bad that you'd have to be an idiot to sign them. And we signed them for years. I could tell you trade deals that I have never seen anything. I said, who would agree to this? They had to be corrupt. They had to be corrupt. To make those deals, they had to be corrupt because there is no way a rational human being, I always say either corrupt or extremely stupid, because there's no way a rational human being would ever sign the trade deals that this country signed. And I got out of many of those deals. I told South Korea, I'm sorry, you're going to have to pay for your military. We have 40,000 troops over there. You're going to have to pay. You become a very wealthy country. Just to finish, you become a very wealthy. They said, no, 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 we will not pay. We will not. We haven't paid since the Korean War. I said, no, you got to pay. I said, would $5 billion a year to start off with? No, no. They went crazy. They agreed to 2. I got $2 billion for nothing. And I said, here's what we're going to do. They said, we can't agree to this because we have to go through Parliament. They have the Parliament or whatever their legislature is. I said, that's okay. I fully understand that. Make it $2 billion. But next year I'm going to talk to you again. And I was going to make it $5 billion. And they knew it was coming. The happiest people to see that it was Biden instead of Trump with them, South Korea. You know what they did? They cut off the deal that I made where they were paying us. They backed to nothing because they went back to Biden and they gave it to him for nothing. They were willing to pay. We have 40,000 troops in harm's way, very serious, because you have North Korea is a very serious power. They have tremendous nuclear power. And I said to South Korea, you got to pay. And they agreed to do it. And Biden then cut it back, and it's a shame. And I could tell you 50 deals. And if I were there now, they'd be paying us $10 billion a year. And you know what? They'd be happy to do it. It's a money machine, South Korea. You're going to mention Taiwan. You wanted to mention Taiwan.
You mentioned Taiwan. You said you would defend them. You also seemed to imply that on Putin, you would not. Putin, you seemed to imply that you had talked to him without actually confirming it.
I said I don't comment on those things.
What about, can I ask you a particular thing about the dollar? You talked about wars. At the New York Economic Club, you said that if you lost the dollar as a reserve currency, it would be like America losing a war.
Yeah.
You look at what you're going to do in terms of protectionism, drive countries to use the other currencies, and all that debt is also going to lessen the dollar's status as the world's reserve currency. Do you worry about that?
The dollar is so secure. Your reserve currency is the strongest it'll ever be. And
you say that, President Trump, at the moment there is a thing called the Trump trade in the markets. Do you know what that is? The Trump trade is very simple. People are betting that your policies are going to drive up debt, they're going to drive up inflation, so they're going to drive up interest rates. Are the investors wrong?
Yeah, I had 4 years no inflation. I had 4 years no inflation.
But that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Scam, the Green New Deal, you know, it was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong.
You're trying to turn this. You're trying to turn this.
You've been wrong.
No, you're trying to turn this into debate. There are business people. There are business people.
You've been wrong. You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're go and jump in a lot of different subjects.
Whilst you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you started, right? The reserve currency is under threat. Because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it. Yeah. They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership. They look at this guy, they say, you got to be kidding. And she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe it. This is not what we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. If you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers. But you don't have other, listen to this, you don't have other people that can talk that way. You know, a lot of people say, we love Trump's policy, but we would like to have another messenger because we don't like him. He's a little bit crass. And then, actually, it was Lindsey Graham, I must say. He was a progressive, in all fairness. But Lindsey Graham said, but Trump's policy doesn't work without Trump. And there's a lot of truth to that. Macron was going to, nice guy, Emmanuel. He's a wise guy, but he's for France, and we're for the USA. You know this story. He was going to tax American companies doing business in France, a very substantial tax. And I told my people, I didn't even like the companies, but I'm representing American companies. And this guy, so I said, call Macron and call his people and say, we're not going to stand for that. And I got Mnuchin and, you know, a lot of guys, smart guys, if I can finish. Yeah. I'll go longer if you want.
No, I was going to ask you about the Federal Reserve.
You got to be able to finish a thought because it's very important. You know, this is big stuff we're talking about. You can't go that quickly.
You've gone from the dollar to
So let me just tell you. So I said, no, I'm just telling you basic, it's called the weave. It's all these different things happening. Yeah. So let me just say, so I said to Mnuchin, call him up and say, no way. He did, and he came back to see me. He said, they won't do it, sir, it's too late. I said to somebody else, you call him. Then I said, let me do it. And I called him. And I said, Emmanuel, you're taxing American companies very substantially. You're not doing it with other companies. You must think we're stupid. It's not going to happen. But Donald, I cannot do anything. It's too late. Or it was approved by a legislature. I said, that's okay. Here's the story. Every bottle of wine and champagne that you send into the United States, effective immediately, and I'm signing it as I speak, I'm charging you 100% on every bottle of wine and champagne. You know, they like the wine and champagne, right? Every bottle of wine and champagne that comes into the United States of America has a tax on, starting on Monday morning, this was a Friday, of 100%. And that's better than you're doing, okay? And he said, no, you cannot do that. I said, I've done it. It's already signed. Monday morning goes, may I call you back? Yes, he calls me back in about 3 minutes. We have decided to remove the tax from the companies. I did this all day long, but you don't have, you think Biden does that? I don't think so.
Let me change, let me ask you a very factual question. The Federal Reserve, you say you don't want interest rates to go higher. You've gone backwards and forwards about whether you want to keep Jerome Powell as chair of the Federal Reserve. His term as chair runs on to May 2026. Would you seek to remove or demote him?
Look, I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I mean, before, the guy used to walk into my office, he was like begging. Oh, he was fine.
But you did talk about, you talked about removing him once.
I did, because he was keeping the rates too high. Yeah. And I was right.
And you would do that again?
In fact, he actually dropped them too much when I did this. Because I said I was threatening to terminate him. There was a question as to whether or not you could. And there was an article in the New York Times, 2 half pages. 1 page said I can do it by lawyers. 1 half page said I couldn't. And that was enough for him. And he dropped the hell out of the rates. He dropped them too much. He went so, he dropped them actually too much. Okay. Here's the story. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all, but I've been a very successful businessman. I've done really good, much better. Now people are understanding how good I've done because they're seeing it much better than the fake news wants to give me credit for.
Just on the issue of whether you would replace
I think I have the right to say, as a very good businessman and somebody that's used a lot of sense, I think I have the right to say that, you know, I think I'm better than he would be. I think I'm better than most people would be in that position. I think I have the right to say I think you should go up or down a little bit. I don't think I should be allowed to order it, but I think I have the right to put in comments as to whether or not interest rates should go up or down.
When you looked at the Supreme Court, you came up with a list of people who you thought of replacing, bringing in as Supreme Court justices.
Yeah.
Would you do that with the Federal Reserve?
Well, I no longer need it. When it was a great thing. In fact, a lot of people said I got elected because of that. I was an unknown quantity. I was very known as a business guy, but I wasn't known as a political person or the leader of a country. And people were very worried about, actually they were worried, am I going to be liberal, if you want to know the truth? And somebody said, would you come up with a list of 20 or 25 justices, in this case mostly judges, that you'd put in case it were necessary? Now, it's amazing because I got 3 in 4 years. Most people get none because, you put them in the young. You tend to put them in young. Only stupid people put old. You don't put old in because they're there for 2 years or 3 years.
You're a 78-year-old man running for president.
A lot of judges, a lot of presidents get none. I got 3. And I think they've been 3 great choices, too, by the way. But
just on the Federal Reserve,
by the way, I think they have been really great choices. But I got 3 judges, and you know what they want to do? They want to now put up to 25 justices into the Supreme Court, the radical left, and that can't happen. So I think I've done a great job on putting in justices and 300 judges, and that made a tremendous difference in the country. I was a little lucky because Barack Hussein Obama did not get his judges approved, a lot of them. So I ended up with 125 judges before I got there. So again, most presidents don't even get to put a Supreme Court judge in because there's 9, and they're there for a long time. Most of them are there for a very long time. And I got 3, which is a very unusual situation. I got 3 in 4 years.
Maybe we can change the subject to technology, seeing you wouldn't answer about the Federal Reserve. The U.S. Justice Department is thinking about breaking up Alphabet, as Google likes to be known now. Should Google be broken up?
I just haven't gotten over something the Justice Department did yesterday, where Virginia cleaned up its voter rolls and got rid of thousands and thousands of bad votes, and the Justice Department sued them that they should be allowed to put those bad votes and illegal votes back in and let the people vote. So I haven't gotten over that. A lot of people have seen that. They can't even believe it.
The question is about Google, President Trump.
Yeah, look, Google's got a lot of power. They're very bad to me, very, very bad to me. I mean, I can speak from that standpoint. They only have bad stories. In other words, if I have 20 good stories and 20 bad stories, and everyone's entitled to that, you'll only see the 20 bad stories. And I called the head of Google the other day, and I said, I'm getting a lot of good stories lately, but you don't find them in Google. I think it's a whole rigged deal. I think Google's rigged just like our government is rigged all over the place.
You would break them up, in other words?
I'd do something. You have to have, look, I give them a lot of credit. They've become such a power. It's such a power, and you got to give them credit for that. How they became a power is, really the discussion. At the same time, it's a very dangerous thing because we want to have great companies. We don't want China to have these companies. Right now, China is afraid of Google. Right now, China is a very powerful, very smart group of people. I will tell you that from very personal experience.
There's an example of a Chinese tech company at the moment, TikTok.
Yeah.
You initially wanted to ban TikTok. Now you like it, apparently for some reason to do with Facebook.
Yeah.
There is a decision coming up, if you became president, its Chinese parent would have to sell it, I think it's by January the 19th. Would you force them to do that?
So I originally had it all done, and then I said to Congress, your decision. I said, I'm not going to, pull any strings, nothing. Your decision. You make it. But I had it all done, and I said, you make it. And they decided not to make it. I didn't care if they made it or not, because to me it was a flip of a coin. You have some real First Amendment problems. You have a lot of problems.
You just talked about Chinese technology, the need to defend against it. TikTok and the threat people see to many kind of American children and things like that.
Yeah, but
why do you no longer see TikTok as a security threat?
I think it is a threat. Frankly, I think everything's a threat. There's nothing that's not a threat. But sometimes you have to fight through these threats. You can't just, like Google. I'm not a fan of Google. They treat me badly. But are you going to destroy the company by doing that? If you do that, are you going to destroy the company? What you can do without breaking it up is make sure that it's more fair. They do treat me very badly. Oh, and he told me, no way, you're the #1 person on all of Google for stories. I mean, which probably makes sense, to be honest with you. I actually believe most of them are bad stories, but these are minor details, right? And it's only bad because of the fake news, because the news is really fake. That's the one we really have to straighten. We have to straighten out our press because we have a corrupt press. That's the one we really.
Can I ask you? Can I ask you about Silicon? I was in Silicon Valley recently. You talk to the tech bosses there and the tech people, and there seems to be a real fear that what you would do with tech is you would hand it over to Elon Musk and say, "You sort it out."
No, I have great respect for Elon. Look, I saw that rocket ship come in yesterday and go right back to where it took off, to the gantry, I guess they call it. And I said, what the hell? I was on a phone talking about probably politics, and the television's on, and I'm seeing this big thing where the white paint was burned off it from the, thousands of miles an hour, the heat. And I see this big, massive tube that's 10 stories, 20 stories tall come down. I told the person on the phone, wait a minute, I'm seeing something I don't believe it. Neither does anybody else here. And I said, wait a minute. I forgot the guy was on the phone. He waited for a half hour. And I watched that come down. And I watched it come down and come right in between those big levers. And I said, and it looked to me like it was going to crash. It was coming in hot. And all of a sudden, boom, you see the motor, the fire kick in. And I called Elon. I said, that's the most incredible thing. I said, can Russia do that? Nope. I said, can the United States do it? Nope. He's the only one that can do it. And I said,
you now want to put him in charge of deregulation.
Not deregulation, cutting.
Cutting wasteful spending.
Cutting.
Every single
which
president,
would include
including
deregulation.
Every president comes in and talks about cutting wasteful spending.
Oh, there's tremendous waste.
Give me an example of something you will do that will get rid of government spending.
Well, let me give you an example. When I came into government, I was the first thing.
An example going forward.
Well,
not what you did in the past.
This is going forward because it's the same thing. When I first sat down, a general came into my office and he said, sir, it's nice to meet you. Would you please sign this? I said, what is it? It's a contract for a new Air Force One, which is actually 2 planes, not one, 2 Boeing 747. And I said, how much is it? $5.7 billion. So it's a hell of an expensive plane, but there's reasons for that. He said, nope, I'm not signing it. I said, who negotiated it? Barack Hussein Obama. I said, I'm not signing it. Why? Because there's a lot of fat. He said, I'm not signing it. It's got to have a 3 on it. Anyway, long story short, some of you have heard this. I got it down to, because first week they cut off $400 million. He said, I'll cut. I met with the head of Boeing. Wait, Dennis. I said, Dennis, you got to have a 3. 5.7 is too much. 5.7 billion. He said, the most I'll take off is $400 million. I said, well, that's not bad for one conversation. So he got it down. I said, nope, I'm not accepting. Then he took off 2 more. Then he took off. Anyway, 2 months went by, 3 months went by. I thought we blew the deal, and it was okay with me. I didn't care. But we should have a new Air Force One. When we see these planes from Saudi Arabia, from different countries, brand new, and ours is like 32 years old, and it's a very different plane. It's a much smaller plane, the whole thing. The United States should have the best plane, I will tell you. Not for me, but we should have.
Let me give you an example. Would you?
So he said, he calls up after like 2-3 months. I didn't call him, which is the best way to buy something. Don't call back. And he goes, in fact, when he called me, I said, I wonder what the hell he wants. That's a good way to negotiate, let me tell you. So he calls back, he said, sir, $3,999,999.99 cents. 1 penny below $4 billion. So I said, You got yourself a deal. Then I said to him, let me ask you a question. So you had a deal at $5.7 billion, and in a period of 2 months, I got $1.7 billion off. That means you were going to make $1.7 billion profit on an airplane. Did nobody ever negotiate with you? Well, not really, sir. They just, this is the price, and they said, we'll take it. And I said, you know, and then I learned, that was my first experience, you know, from that. But then I learned everything is like that. There is so much waste. So I'm getting, think of this, the exact same plane for $1.7 billion less, except I have a better paint job. Okay, much better paint job. A different color, red, white, and blue is beautiful. And if you look at every contract, that's one contract, and relatively small compared to most. Think of it. You save $1.7 billion because you negotiate. Every deal is like that. We're building ships that are costing 2-3 times more.
Can you give me an example of
There's
something
tremendous waste, fraud, and abuse in our country. And if you could cut it, you would have a surplus without even going into growth. But growth, we will grow. We're going to bring companies and jobs in at levels that you've never seen. And you would never be able to do it because you're not a believer in tariffs.
I'm not running for president.
Let me tell you, the only way you can do it is through the threat of tariffs. It's the only way you can do it.
Can we come back to one thing on that? Deal making. You look out across this room, there's some big businesses, but a lot of small ones. You look at the way you've given us a lot of examples of things where you've negotiated with the heads of big businesses.
Right.
Give you an example. When you put the tariffs on China, much smaller than you're planning to do at the moment, when you put them on, Apple came, you negotiated a difference for them.
I did.
That's much harder for small business people. Isn't the problem with the way that you do these kind of deals? You're bound to deal with the big companies. It's the small companies who get hit by all these different things and can't find exceptions.
Oh, we have exceptions. No, we had an exception rule. I gave Apple an exception. Tim Cook is a great business.
Apple is not a small company, and please don't give it Tim Cook.
But here's what
happened. The question is about small businesses.
Yes, but
what will you do for them?
No, but we have a very talented group of people. Bob Lighthizer did a very good job. We had great people. We had central casting. These are great, and a large group of people. We made exceptions. In the case of Apple, they needed an exception. You know why? Because of Samsung. He came to me and he said, Samsung makes a product similar to ours, very good product, the phones and other things. And because they're in South Korea, they don't have the tariffs. Because we're in China, we have the tariffs. I said, you happen to be right. You're not going to be able to compete. I said, look, I'm going to give you a 1-year break, but I want you to start building your factories in this country, whether it's Texas or any other place, anywhere in the country. And he said, what does that mean? I said, you have everything in China. I want you to move it from China back to our country. And he started doing that. And he built a factory, a big one in Texas. He built another one. And this was all a process. It was all happening. But I did give him an exception, and the reason was, he said, as soon as he said Samsung, I said, how is that product compared to yours? He said, it's a good product. I said, then you really can't compete. You can't have a 25 or 50% tariff and compete, right? Yeah. And I said, I'm giving you an exception. And I did it for many companies.
But what happens if a small, how do small businesses come and see you? That was the question.
But we do it for small businesses, too. We do it for small business. I'll give you who I didn't know, but he came to me. He was at a meeting, and he built kitchen cabinets. And he was, pretty big in the business. That's all he did is build kitchen cabinets. He said, sir, China and South Korea are building kitchen cabinets for 1/3 of what I can make them. I said, what's the quality? They're not as good, but they're good enough. I can't compete. I'm going out of business. I'm going out of business. I put a 25% tariff still on kitchen cabinets. I saw the guy 3 days ago. He said, I'm the man that saw you about kitchen cabinets. You saved my company when you did the tariff, and you saved thousands of jobs, and my company is now doing very well. And he started to cry. And this guy hasn't cried too much, I will tell you. He said, you saved my company. There's nobody that could have done that.
Maybe I can ask you then about something else. Yeah. Business people here in this room, business people, capital markets, they all like the rule of law, they like certainty. The Chinese, who you mentioned, other dictators, right. They don't like it when things go wrong. They like it when things go wrong in America. If you look at the events of January the 6th, 2021, it showed to many people America's democracy was unruly and violent. Only 3 weeks to go to the election. Will you commit now to respecting